at analyst moves in Target, UPS, Kroger, and more. Stay with us because Morning Trade Live will be right back.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. Trading has begun. The bells have rung. So here's a look at where the market's opening up. Well, we're only seeing a little bit of green, and that's from the Dow, although it's just barely above the unchanged line. The others are in the red. NASDAQ getting more firmly in the red, down about 0.5%. S&P down only about 0.1% right now. Russell basically flat, although just slightly below break even. So on track for a losing week, although lots of time left in the session, so we'll see where they go. Now let's look at some stock movers with Jeff Pierce, contributor here on the TD Ameritrade Network. Good morning, Jeff. We have a bunch of analyst moves this morning, so let's start with Target, which got an upgrade at Gordon Haskett, and it looks like Target's on the move higher today, 1.6% up.
They are, yes. The Gordon Haskett moved them to a buy from hold with a price target of 300. That's up from 255. The analyst said that traffic trends in February and March have been remarkably consistent in Target, and with the later spring Easter shift still to come, these trends could inflect higher in the coming weeks. The analysts also expect multiple appreciation for the shares as higher market gains more confidence with Target model in the post-COVID world. He believes sentiment is too negative on Target right now. You know, if we look, you were just talking previously about some of the consumer experience, the customers out there shopping. Look at comparable sales in the last earnings report. They increased 8.9% in the fourth quarter for Target. That is below the expectations, but combined traffic in the store increased 8.1%. They did see the average transaction amount rise just under 1% compared to a year ago. At the same time, that sales through same-day service, think about order pickup, delivery, that still grew 45% for the fiscal year. Now that's compared to 235% in 2020, but nonetheless, that is still a moving factor for the company right now.
Yeah, it's interesting. The analyst said he believes sentiment is too negative on Target, although Target is outperforming the broader market. It's actually positive on the year now, up about 0.4% or 0.25% this year. But when you look at Walmart, which of course I immediately think of as the biggest competitor, that's up 8.5% year to date. And based on this $300 price target, analysts seems to think it should move higher.
Well, I think what we're seeing out here from investors right now are a couple things. For one, Target certainly, was a winner. Their change to their models during the pandemic certainly helped drive revenue, helped drive customer growth as they, really added to that kind of same day store pickup, to that delivery method. But the other part of it is, as we kind of move forward and we talk about consumers' habits changing as prices continue to rise. I know right now we're still seeing consumers out there buying. But are these consumers considering Target kind of an everyday product or essential store? And that's one of the big questions out there. We know that they've got these multiple shopping experiences. We know they have low cost, and they've talked about having higher inventories, which could definitely help as we watch, some of these shipping issues really cause the shelves to be a little bit lighter these days. But investors are trying to figure out whether or not it's the right time to get into Target, and if consumers are going to continue to go to Target, if this new model is really going to pay off, if we do start to see that consumer behavior change.
Now, this next call goes against that strong consumer demand a little bit. B of A downgrading UPS, and it's because of demand, deteriorating demand. What's behind that?
Sure, they moved them to neutral from buy with a price target of 204. This was among other downgrades, 9 of the 28 stocks in their transportation coverage. And they talked about it, deteriorating demand, just as you said, rapidly falling freight rates. They said freight market signals have turned increasingly softer and suggest demand is waning and not due to capacity being added. They said, meanwhile, the firm's truck capacity indicator that measures the abilities for shippers to find capacity jumped to its highest level since June of 2020 in their last survey. We've seen other analysts come in. JP Morgan also lowered price target to from 262 to 229. They maintained overweight. The stock's down around 13% coming since last Tuesday, coming into today. We've seen several kind of long streaks where the stock has declined in this year, one right before earnings, the other right after. There isn't really any company-specific news causing this downtrend, right? It's really has a lot to do with the particulars around freight, also the concerns of the slowdown in the economy. Less activity from consumers could mean less shipments. On top of that, there's certainly the difficulty around expenses and some of the logistics with the supply chain right now.
Yeah, it's just adding to the mixed signals. We're hearing about a consumer who's willing to spend, pent-up demand, but then we're hearing about deteriorating growth on shipments. So such a mixed picture, but I should add UPS down 2.3% right now, median price target of 246, and it's trading at 188. So still ultimately, it sounds like there's some upside there, according to analysts. All right, let's talk about the next mover, Kroger. It's about 3%, almost 3% higher today after an upgrade from B of A. Why are they bullish on the grocery store chain?
Sure, they moved them to buy from neutral, set the price target 75. That's up from 61. The company's reached all-time highs at 62.58 last month after earnings. They've got elevated levels of grocery inflation they expect should continue at least through the first half of 2023. They said, though they see the U.S. consumers as accepting the bulk of these prices, really, because they're expecting higher prices in these commodities. They think that the consumer is going to accept the bulk of those price increases, given the U.S. hourly earnings are up 6%. And that broad-based inflation is driving consumer to retailers with a variety of individual shift to their consumption. The suggestion here really is that, companies like Kroger have these pricing that they can put in, but even higher pricing, a lot of the consumers out there are willing to accept it. They're really looking for a retailer that has a lot of product available, and Kroger has been kind of a winner in that area. If we look, at their earnings, Kroger had gross margins that rose 22% in their last earnings report. They beat on sales, earnings per share as well. They had a fairly decent outlook for 2022. So this is just another win here as we see these analysts start to come in and raise these price targets.
Do consumers have a choice but to accept those higher prices when it comes to groceries, though? Because obviously if flights are higher, we can decide not to go away. If furniture is higher, we can decide not to redecorate. But we have to eat, right?
Well, that's the interesting part about this, right? As we see, a lot of investors have really applauded these companies that have had to raise prices, right, in order to cut some of these costs, in order to keep their margins good. The question is, at what point does the consumer start to change? You think about being in a grocery store. To your point, it's a much easier choice to look down the aisle and potentially find something that's a little bit cheaper. We talked about it on another show about ConAgra the other day, and the different companies out there that are producing these foods. At what point do the price hikes start to actually hurt these companies because the consumer says, I'm going to find something that's a little bit cheaper, or maybe I'm going to scale back a little bit on some of these purchases?
All right, well, we'll move on. But Kroger up about 3.4% today at 61.93, so at B of A's former price target, and up 37% year to date. Meanwhile, Boeing is 1.5% lower today. It got a price target cut at Morgan Stanley, but they're still bullish on the stock.
They lowered the price target to 230 from 288. They kept the overweight rating on the shares. They told investors they recognize they may have been too optimistic coming into the year, confident that positive catalyst for Boeing would occur by April. Events in the past weeks, including the Boeing 737 accident in China, have pushed these milestones to the right, but they still believe the stock's risk reward as skewed to positive, given that they do not expect the industry to revert back to global shutdowns. Overall views of aerospace recovery post-COVID-19 is still only halfway through. They still expect Boeing to be free cash flow positive in 2022. Of course, we're talking about that 737 800 next generation plane carrying 132 people that crashed in China last month. We know that China's reported their third annual loss in a row in January. They disclosed about $5.5 billion in costs tied to manufacturing flaws. So this is this has really been a continuation for Boeing of, I think, investors and analysts out there hoping that the turnaround is coming and things continue to slow down.
Well, analysts overwhelmingly bullish on that one. It has 22 buy ratings, 5 holds, and just 2 sells, median price target of $250. So about $75 upside. From here, your last stock is a look at the rails. B of A downgraded Union Pacific. In turn, Union Pacific down 1.6% today. What's behind that move?
Yeah, it's really along with the same note that we saw with UPS, right? They downgraded Union Pacific to neutral from buy with a 258 price target. This was among those downgrades, those 9 of the 28. Really, again, just referencing that deteriorating demand outlook and the rapid falling rates. Again, JP Morgan recently raised the price target of the stock 276 from 267 with an overweight rating. We know that we've seen North America freight rail traffic slip by about 0.5% recently, and that wrapped up a down month for the 6th straight week decline. You talked about some kind of mixed views here on this. We were talking about UPS earlier. I mean, UPS, when they had their earnings report, they forecasted revenue of $102 billion in 2022. That beat estimates. They also expect their margins coming in at 13.7 in 2022. That was above 2021 levels. So a bit of a mixed kind of review from some of these, freight style companies. As we know, the consumer's still buying. The question is, are we going to start to see a slowdown of that? And also, of course, some of the logistic parts when we talk about the supply chain, how much of a weight is that going to put on these companies?
Well, it seems like B of A is in the minority for Union Pacific. I'm just looking at the analyst breakdown, 22 buys, 8 holds, 1 sell, median price target of 271, so it's trading at 241, so $30 upside. But Jeff, I've been talking this week about the Dow transports. I'm just taking a look here now. They're lower again today, down 1%. And this being sometimes looked at as a leading indicator of where we're headed, not to keep bringing recession back into the show, but some look at it as a possible recessionary signal. How closely do you look at the Dow transports and what some of these stocks are doing specifically?
Well, I definitely think it's good practice to look at those, right? And to try to see if there are any sort of kind of leading indicators to that. The question right now is it's so complicated as we kind of get into the changes that we're seeing in interest rates, the effect on these prices out there, and what we're going to see out of some of these companies, on top of the fact that we are, I guess you could say, coming out of this real supply chain issue, albeit, likely fairly slowly, we're still coming out of it. So there are so many factors at play that it's harder to look at some of those, kind of old leading indicators that maybe we were using three years ago or so, and really put too much weight on them and suggest that this is what this is telling me. Right now, we're looking at these companies. I think you made a great point earlier. As we open up into more earnings season, hearing what these companies have to say, hearing about what the consumer is doing, and the cost related to these supply chain issues is really going to be one of the factors I think that's going to weigh a lot on investors, as it has in these previous quarters as well.
Also, we know the market's forward-looking, but I guess how forward-looking is it? Because we just had our last guest saying 18 to 24 months we could see a recession. Well, when would that start to be priced in? Now, or until we get a little bit closer? And can the market rise regardless?
Yeah, that's a really good question. And I think, he talked about the different type of investor out there, right? For him, 18 months seems like tomorrow. For other investors, that seems so far away. And I think we also have a lot of new investors out there into the market. So the question is, are they pricing something that may seem that long-term into the market already? It is really tough to say, especially, again, with all the factors, the geopolitical, the interest rate issues, the supply chain issues, to say that, that all of these investors out there are pricing in, out that far. And I don't necessarily think that we can really say that that's what's going on yet. We've watched investors move so quickly from sector to sector, industry to industry. I think they're certainly trying to price something in, but we don't quite know how far out they're looking right now.
Yeah, and just finally, I should just add, I was talking to the Invesco's global chief market strategist for the investor, not the trader. She said you shouldn't be worried about economic cycles anyway because you're invested for the long term, and you should basically be well diversified in multiple asset classes regardless. So we have to leave it there. Jeff Pierce, thanks so much for breaking it all down for us. Appreciate it.
Thank you.
Next up, Inside Out, and we'll trade some stock picks, including Medtronic and Starbucks. That and more ahead on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
I'm Jenny Horn. Here's a few more of this morning's analyst calls to keep on your radar. A Deutsche Bank analyst maintained a buy rating on Apple with a $210 price target. This follows news that the tech giant is looking into offering a hardware subscription service for its devices. The analyst said a hardware subscription service would be financially beneficial to Apple, although likely only modestly on a short-term basis. He said the long-term opportunity to reset consumer expectations of frequently refreshing their iPhones and to get users to try more Apple subscription services is more meaningful. Credit Suisse downgraded Alcoa to neutral from outperform, saying it sees inflationary pressures weighing on the shares. The firm said London Metal Exchange aluminum prices are nearing a peak, and Alcoa continues to deal with inflation, and CapEx should start to accelerate meaningfully for decarbonization targets. And Walmart announced raising the pay for its fleet of roughly 12,000 truck drivers. This means Walmart drivers could make up to $110,000 in their first year with the company. Plus, drivers who have been with Walmart longer can earn even more based on location and tenure. Walmart added it launched the first ever private fleet development program. Over the course of a 12-week program, supply chain employees in various cities can get their commercial driver's license and become private fleet Walmart drivers. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Caroline Woods.
Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. Let's bring in Craig Basinger now, Chief Market Strategist at Purpose Investments. Good morning, Craig. Thanks for being here.
Morning, Caroline. Thanks.
Before we get started with your stock picks, I'd like to ask first how companies in the durable goods space are positioned in this current market. What are your thoughts?
Yeah, I was listening to your last guest. It's been really challenging in sort of some of the changes of behaviors that this pandemic and then subsequent inflationary environment are causing people to undertake. But I think one of the broader trends that we've seen during the pandemic with less mobility, people just spent more money on durables. I mean, everybody was spending more money on whether it's cars, home improvements, Apple iPhones, the list goes on and on. And what we're starting to see now and increasingly is that, that is starting to pivot back to normal, back to more normal trends, which from our perspective means that it's, starting to be increasingly a headwind for a lot of those companies that benefited from that changed in consumer patterns previously and starting to sort of pivot back more towards service companies and away from more of the durables or goods producers.
Yeah, we've seen it with Wayfair and Restoration Hardware, or RH, as well, with analysts saying customers, if they're going to have limited funds, they want to spend it on trips and not necessarily furniture. But I know you have a few stock picks with you today. First up, Medtronic. Why is that on your list?
Yeah, we've been sort of pivoting back away from the durables and the goods and into sort of services, which we kind of bucket healthcare in as well. And where Medtronic kind of fits in even a little better is, with the reduced surgery and hospital capacity over the last couple of years, because it's obviously been taken up on for other reasons, a lot of elective surgeries have been sort of postponed. And, the fact is people have been aging and requiring a lot of those elective surgeries at an equal pace. That didn't go away. There's a fair bit of catch up to be done. And I think that just sort of outlines for this company just a pretty healthy growth trajectory in sort of the quarters and years ahead.
All right, Medtronic down about 0.5% today, but up 8% for this year. Another one of your picks, not necessarily a service, but some would say a staple, and that's Starbucks. Despite Howard Schultz coming in and getting rid of the share buyback program, that's a buy for you?
Yeah, I mean, well, so this is a recent buy for us, and a lot of it is on sort of the upheaval on the leadership side. And I mean, Schultz is fantastic, but you know, that's a temporary position. They're going to find somebody else, but whether internal, external, time will tell. But it's really on sort of the share price being beaten down. And there's no question, like there's a lot of headwinds for this company. It's got some labor issues, obviously. I mean, doesn't everybody have labor issues? But you know, anybody who employs a lot of people seems to at the moment with wages.
Well, it has unionization issues as well, not just labor issues.
Yeah, in little pockets, the unionization as well. So, you know, it's got sort of these things, these headwinds for the company, which clearly in our minds is reflected in the beaten down share price. And so again, like a lot comes down to, you know, there's bad news, but then, you know, what are you paying for and how much is priced in? And, you know, if you sort of look past this sort of this period, I think what you'll find is that, you know, they really culled a lot of their stores over the last few years, and they reduced the share, the store count, which, you know, was the right response when many areas of high traffic just weren't seeing the people walking through them anymore. And what we're starting to see now is obviously the traffic patterns are again getting back to normal, which I think it also opens the door for a number of those stores to sort of reopen or reappear in those areas. And I think that'll just sort of fuel growth in the coming quarters ahead. And given where the share price is, I think it's you've got a bit of a safety margin.
Yeah, it's down about 1.25% today, but down 30% year to date. Just finally, want to just ask in terms of your strategy. Obviously, you talked about this pivot away from goods to services. I saw in your note that you think the first correction may be over, but expecting a second correction later this year. So knowing that, with the risk that's in the market, the uncertainty, what's the best way to position yourself to take advantage of some of the up days, but to kind of limit some of the downside risk?
Yeah, I mean, you know, I think this year is I think this year has already proved to be extremely challenging, not just because we're, you know, obviously we have an inflationary problem, we have a war problem, we have central bank pivoting problems. I mean, all these things are sort of piling on the markets, which I think is going to, you know, when the year started, we were expecting to cause a fair bit of gyrations, both up and down. And right now, I think we're sort of just coming out of one of the down periods, and hopefully, knock on wood, we're getting a bit of a reprieve here. But we also think, you know, as growth slows down, and it's really amazing how quickly the market has pivoted from, you know, thinking the central banks were going to remain dovish for much longer to this period of extreme hawkishness, and already starting to price in like the risk of a recession on the horizon. Like, it's just so amazing how quickly the markets jump onto a theme in this day and age. But, you know, I think this expansion isn't over. Like, I mean, for sure, the economic growth is going to slow down, but calling a recession now, I think is just extremely premature. So I think as the data sort of wanes back and forth as this year progresses, and that could be inflationary data or growth data, we're going to see sort of markets go back and forth and have a fair bit of volatility, and probably actually end the year roughly flat. We don't see a recession at this point. There are some canaries out there. I mean, the yield curve, the spike in oil prices, consumer sentiment. But then there's also a number of sort of really positives out there as far as the health of the consumer, the balance sheet of the consumer, the balance sheet of corporations. So you sort of put it all together, and I think we just sort of have a slowing growth environment, which means certainly tilt more towards services, certainly tilt a bit more towards defensives. But again, I don't think the cycle ends, certainly not this year, and I think it's a little premature to say it's going to be 2023 as well.
All right, we'll leave it there. Roughly flat, I should say, is actually higher than where we are now, so I guess that's a little bit glass half full. Craig Basinger, Chief Market Strategist, Purpose Investments, thanks so much.
Thanks, everyone.
All right, now let's trade some of those picks, Craig's picks, with Alex Coffey, host of Next Gen Investing. Alex, good morning. I'm going to start with Starbucks because I know you're a pumpkin spice latte fan. You told me that once on Next
Cold
Gen,
brew.
and I think pumpkin spice cold brew. Okay, noted. But tell us how you trade Starbucks. Or how one would trade Starbucks, I should say.
Yeah, so some who are following kind of the narrative that your guest laid out and optimistic on Starbucks may understand that it's going to take a little bit of time. Patience might be essential here with Starbucks. We might have to wait until that pumpkin spice season before things really shake out here in Starbucks. Of course, things could turn around in the near term as well, Caroline. But what I did is I wanted to illustrate a way that you actually could use options but still add duration to a trade. The way that I did was going out buying an in-the-money September call. So this is way out in terms of duration for some of the trades that we talk about on a daily basis here across the network. But buying the September 70 call, and in order to chip away at that cost, selling something closer in terms of expiration date, and then also out of the money to give it some room if Starbucks does get a bounce here. And so selling the 90 call in May. Many traders or investors who use this sort of strategy, which is referred to as a cover or as a call diagonal, or in some circles referred to as a poor man's covered call, as it's a little bit more capital efficient, it's a little bit more risk defined than actually buying stock and selling the call, but it's going to have similar performance in terms of how it will perform to the upside if the stock rallies. Many of those who implement this style strategy, Caroline, as those calls in May fall off or expire, if they do, may consider re-adding additional premium against this position over time. But of course, we don't know what's going to happen. We don't know if the secondary market will really allow us that opportunity or not. But assuming it does, typically we would look to, from month to month or week to week, continue to sell premium against that 70 call in order to chip away at that 1375 net debit. That 1375 net debit represents our risk. So in this case, $1,375 in risk. That takes place if Starbucks stock finishes below 70 out into September. But also, Caroline, that helps us find our break-even point in September, which we simply add that debit to our 70 strike and get 83.75. So to get to our break-even, we don't need much movement, only about $1 higher than where we're currently trading.
Yeah, 82.24 is where Starbucks currently is. All right, thanks for that, Alex. In terms of Medtronic, how should one go about trading that?
Yeah, so again, if you're looking at this one, similar to how the guest was talking about it, optimistic but maybe cautious because it does have that healthcare exposure, and your guest talked about kind of elective surgeries being a little bit slower over the last few years. What I looked at here was a neutral to bullish strategy going out to May, so a little bit over 40 days to expiration, selling the 110 put, buying the 105 put to define that risk, and looking for about $1.25 credit. Of course, we'd accept more credit if possible, depending on what the market allowed for. But whatever that credit is, that's the max profit. So in this case, if it's $1.25, we can make $125. That'll correspond with a break even of 108.75 on that expiration date. And then, of course, the difference in that $5 spread and our credit, which leaves $3.75. That's our total risk on this trade in terms of max loss, $375. That takes place below 105. So this is one of those style strategies, Caroline, where if you have a particular outlook on a particular stock or company or index or product, but you ask it to come and beat you as opposed to needing something to happen to be profitable. If the stock just stays here, holds this value, and time passes, we could expect that this one, as long as it's entirely out of the money, would expire worthless, and that would be, of course, the max profit scenario. So defined profitability, defined risk, and neutral to bullish in its construction.
All right, appreciate those trades. Alex Coffey, thanks so much.
Thanks, Caroline.
We'll see you later on Next Gen. Coming up next, we'll look more into the big winner of yesterday's session. That's HPQ. UBS downgraded the stock today. We'll break it down and trade it next. So stick around on the TD Ameritrade Network. Morning Trade Live. We'll be right back.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust the time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh, wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Welcome back to Morning Trade Live. I'm Caroline Woods filling in for Oliver Rennick. Here's what we have for you in hour 2 of today's show. We'll trade HPQ following a downgrade at UBS this morning. This coming after the stock's big rally yesterday, 11% following that 11% stake from Berkshire Hathaway. We'll dive into the world of NFTs and what lies ahead in that space. And the Chartmaster will look at analyst moves in Toast, SoFi, and Coinbase. Before we get into all of that, let's take a quick check at where the markets are trading 30 minutes into the session. Still a mixed picture, although the Dow really just clinging barely above that unchanged line. The NASDAQ worst performer once again today, down 1.2%. Russell not far behind it, down about 0.3%. And the S&P posting a bit more modest of a loss, down 0.4%. Let's bring back in Ben Lichtenstein, host of Future, is here on the TD Ameritrade Network. Ben, we touched on a lot with you at the top of the show, but wanted to dig more into the commodities, specifically to start crude oil, seeing a move higher, up about 0.5%, still below that $100 a barrel, but as you reminded me yesterday, still at uncomfortable levels.
Certainly at uncomfortable levels. I think that goes without saying, Caroline. And we are a little bit higher this morning, but for the most part have been coming off. We're below 100, as you mentioned, well off the $130 level we saw in reaction to some of the geopolitical tensions to begin the month of March. Let's take a look at the move lower over the last couple weeks as we've seen strategic petroleum reserves released, not only from here in the U.S., but also the IEA. this week announcing their own efforts to kind of ease some of the pressures at the pump we've been seeing. Now, I want to point out here, as you take a look at some of the intraday, this is the 30-minute time frame, the move we've seen over the last couple weeks from 114 down to 93. You mentioned again that I pointed out how prices remain elevated, still just below the 100 level. And again, this run-up started, if you remember, bottom of the December, or we bottomed out in the beginning of December around 62, 63, and have really yet to look back. You can see the move higher here. And I oftentimes talk about other products to keep an eye on. For example, gasoline, RBOB. This is the futures contract. In this instance, the candles, we've got crude in the purple line here. You can see both track each other very closely, as you expect to see. So prices at the pump have been on the move higher, as crude oil futures have been on the move higher as well. We talk about the inflation pressures those create, and a reflection of that, again, we were talking about rates earlier, the TNX up and through the 2.7 level this week. But in terms of pressures at the pump and at the checkout counter, for example, I think commodities in general have been a focal point here. I've got corn, for example, on the move higher. You can see it's been continues to be relatively elevated. Now, I did note here that, well, we have a couple things playing out here, which I think will add to some of the pressures that we've seen and support in terms of commodity prices. You've got, tied to the ongoing war in Ukraine, the EU agreeing to ban Russian coal imports, as well as Russian ships and trucks from entering ports. The UN Assembly voted to suspend Russia from the Human Rights Council as a result of some of the images we've seen coming out of some of the cities in Ukraine this week. And then, I took note of the world food prices hitting a new record high in March. We heard from the UN Food Agency this morning. They said the Food and Agricultural Organization's Food Price Index, which tracks the most globally traded food commodities, averaged 159.3 last month versus an upward revision from a 141 in February. Now, that 141 was a revision from 140.7, which was a record at the time. So, again, we're up 12.6% from February, a 33% increase from March of 2021, Caroline. So, I mean, these are some staggering numbers. I just want to point out here, it's not just crude, and while crude prices have eased a little bit as some of the tensions out of Russia, potential Putin snapback responses have kind of been shelved, again, commodities in general remain at historically elevated levels, and this is what's kind of feeding into the Fed's narrative in terms of trying to combat inflation, rates on the rise, and what's weighing on the indices.
Yeah, and as Bob Iacchino reminded us yesterday, prices at the pump move a lot faster on the way up than they do on the way down. So it seems like we'll be continued to be squeezed from every level with these higher prices. Ben Lichtenstein, thanks so much. Moving on, HP was the big mover of yesterday's session after Berkshire Hathaway revealed an 11% stake in the company. But today we're seeing some negative analyst reaction on the stock, and in turn, a little bit of a downward move, down 1% today. Let's bring in Michael Keeley, a contributor here on the TD Ameritrade Network, to break it all down for us, including the move and that analyst action. UBS downgraded it today. What's behind that call?
UBS is not the only one that has a more pessimistic view of the business conditions that HP is facing going forward, Caroline. But you named it in terms of the big reaction to yesterday's disclosure that Berkshire Hathaway now has an 11% stake. I find this really interesting on several levels. First, it's not unusual for Buffett and crew to swoop in on a stock that's deemed to be trading very cheaply by the consensus of analysts out there, trading 7 times last year's earnings, 9 times next year's earnings. And there's a lot of reasons for Buffett to look into this. Part of it is to diversify the technology sector holdings that Buffett holds. He's got Apple, and that's the singular biggest holding, having bought into it big time in 2016. It's the biggest holding that Berkshire has that it doesn't control. And they've done exceptionally well. But when we take a look at Buffett, in his proclivity toward cheap stocks, that doesn't always pan out. And when we look at his enterprise deals that he's made recently in the last, let's say, 7 years, Caroline, that includes IBM, which was deemed to be a big miss. That includes Oracle, where he was not quite the Oracle on that one. And so when we look at HP, business conditions are not deemed to be all that strong, with the commercial sales that HP's been making up through January very strong, but noted by analysts as waning quickly and not likely a real area of strength going forward, low single-digit growth rate anticipated there. And HP is really trying to expand its own business by buying firms like Poly, and that gets them into the gaming space with peripherals, if you will, headsets for gaming and that sort of thing. And that was an interesting purchase, I think, for HP because it enables them to flex their muscle in terms of their command of the supply chain to unload a big backlog of sales that had been made by Poly, which should be rather immediately accretive. So those are, some back and forth views. But when we take a look at this secular shift away from print products, that's definitely problematic. HP does need to do something, and they've got some credit for cleaning up the print business, but it's still seen as an area of weakness. And we take a look, just for context here, at HP versus Apple, for instance, then just three recurring business lines for Apple, which include advertising, iCloud, and Apple Care. An analyst over at Bernstein said that generates a combined $31.2 billion in revenues, which is more than double HP's entire print supply business. And so you've got Apple with the cachet that is likely going to foster more sales going forward. HP seen as more of a stalwart that is buying back loads of shares. I think that's why the earnings is double digits. Meanwhile, the sales has been low single digits, including the projections going forward. So it's generating cash flow, but it doesn't quite have the products that competitors like Apple do have that can sustain them on a go-forward basis, with, the analysts being a lot more optimistic on some other names in this space.
Yeah, Michael, sticking with the analysts, obviously I would never bet against the Oracle of Omaha or claim to know more, but when I look at what the analysts are saying, it has a median price target of 36, HPQ does, and it's currently trading at 39.75. So if it is such a value, why don't analysts expect it to move any higher from here? If anything, they expect it to move lower.
It's a good value. You're absolutely right in terms of the PE ratio relative to others, but that's a reflection, Caroline, of the very muted business prospects for HP as we go forward. You would think, it's a great question, and I've been of that thought process looking back at, for instance, 3D printing, which has such buzz and such hype, but you take a look at that space, and HP really hasn't made serious inroads to the point where analysts are feeling as if that will offer a lot of future growth prospects, and HP's having to go out there and buy other firms that expand its product reach because the printing side has been doing so abysmally, and that's expected to continue. So they're trying to pivot like competing firms, Asus, Lenovo, to create remote workstations for folks. But a lot of that business was thought to have been pulled forward so dramatically that they're not likely to see a real uptick on that level. And the uptick is likely to be out into the fall for back to school shopping, when people are saying, hey, we need laptops for the kids and for the college students. And, that's a ways away at this point, with the market being pretty choppy in the meantime.
My first desktop for college was a Hewlett-Packard, but I should say, well, that might be why. This UBS analyst has a $40 price target and says shares likely to tread water. So let's I guess wait and see. Michael Keeley, thanks so much. All right, now let's do some trading and welcome in Dan Deming, Managing Director of KKM Financial. Good morning, Dan. Happy Friday. Talking HPQ today. UBS on hold with a $40 price target. How would you want to trade HPQ, especially given that Warren Buffett believes in it?
Right. Yeah, we got some countering opinions here, don't we, Caroline? When you look at some of the analysts versus what Buffett sees as a value play moving forward. And, I think that when you look into some of the fundamentals, as Michael went through, he really hit on some key points as far as the commercial side being the driver of the business in the last earnings announcement. We are seeing earnings expectations being lifted for from a yearly standpoint. Yet again, a certain amount of that has to do with the aggressive stock buybacks that HP has been initiating. So, there's some headwinds here. There's no question. But overall, I think that when you look at just the general valuations and the fact that even with analysts kind of projecting the mid-30s to maybe a $40 price target, as you mentioned by UBS, I still think that the general trends in place, even though we might see a little bit of a lull here over the next quarter or so, that longer term, I still think HP has some upside in it. And I think that it's going to benefit short term from just the general concept that there's a potential that, any weakness that Buffett could be adding more to his holdings. So I think it's going to find buyers on any kind of weakness. And I do think that it's still going to have the opportunity to push into the mid-40s here in the next couple of months.
Yeah, I mean, Buffett certainly had people were certainly positive on it yesterday after that announcement. So in terms of the particular trade, what would you look to do?
Yeah, so I'm looking at to define my risk, first of all, in this trade example, because the fact is that there are so many kind of headwinds and unknowns out there that, this is not something that I think that you just want to dive into without having some risk definition. So really what I'm looking at is just a call spread looking out over the next month and a half. And I'm looking at the May 39.44 call spread. You can put that on for about $1.85 here with the stock trading around $39.60, excuse me. And, again, you're paying a little over intrinsic for the premium in this call spread, but nonetheless, it wouldn't have to go up too far from here for it to really go into the money and have intrinsic value relative to the price of the stock. And you got risk definition. And I think that, we are seeing from a technical standpoint, when you look at it from a purely technical standpoint, it still looks pretty good here as we are seeing an upward trend. And now we're seeing some plateauing, but we're also seeing a slightly higher high. So I do think that if there's any further upside momentum, that we would push through that 41.5 level and could see it push up to the 44 level here in the next 6 weeks.
All right, we'll leave it there. Dan Deming, Managing Director,
Right.
KKM Financial. Thanks so much. Have a
Thank
great
you.
weekend.
And not all the transport data is negative. If you look at rail volume, actually accelerated through the first quarter. We think that turns positive for the first time in about 12 months here in 2Q. And historically,
Analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watch List live from the New York Stock Exchange.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. It's now time to talk some NFTs with Jonathan Victor, NFT gaming lead at Protocol Labs. Good morning, Jonathan. Thanks for being here.
Morning. Thanks for having me.
So NFTs really took the world by storm last year. There's been calls that the bubble has burst, that the bubble is deflating, but you say it's not a bubble at all. Make your case.
Yeah, I mean, I think NFTs are an extremely broad category. So just using that as a general catch-all term would sort of be like talking about tech as like one monolithic entity. Of course, you have like fintech, you have health tech, you have many different subsegments inside of there. NFTs as well. I would say you have NFTs as gaming assets, you have NFTs as like these communities, you have NFTs as art, tickets. And so I think when we think about NFTs in totality, it's really hard to just look at the market and say, oh, this is all a bubble. It'd be like arguing that paper is a bubble. So from that perspective, I think maybe just looking at just the sales numbers is maybe the wrong way of evaluating things. As an example, NFT storage, which is a project I work with, we've seen a 2.5x increase in the number of NFTs that are just being minted. We're seeing them for totally different applications. And so I guess from that perspective, it's one of those things where maybe the pricing and the enthusiasm in the market is slightly different from the actual applications and the utility, but I would say neither are really going away.
Okay, so I'm going to need to ask you about NFT storage in just a minute, but when I think of NFTs, I think of digital collectibles. So I'm kind of lumping, I guess, those into one category for the sake of time, and we are seeing signs that demand is cooling if you look at the numbers. So what do you attribute that to, and I guess what reignites demand going forward?
Yeah, so I think that has to do a lot with the market overall. I think cryptocurrency obviously has its own swings. And so as a result, you'll see different amounts of like enthusiasm and participation. But again, I think this really actually comes down to just the utility. As an example, Bored Ape Yacht Club, they've recently announced that they're building their own metaverse. And so when we start thinking about the utility and the applications, obviously this is just going to keep growing and growing as people find more and more ways that they can use these digital objects. One little clarification, I think you had mentioned NFTs as digital collectibles. I think that might be, again, just like one way of framing this, but really NFTs are just digital objects. And we've had digital objects already. NFTs are just a way of doing this with additional superpowers involved. Namely, the users are the ones that are in control of these objects rather than them being locked inside of walled gardens. And I think that composability actually unlocks a bunch of the use cases that we're starting to see, especially when we start thinking about gaming, these like interplays inside of like metaverses, and when we start seeing them for actual more like utility-based functions.
So for people who are interested in entering this world of digital objects, I correct myself, what's your best advice? Because obviously this is a new space. It's kind of uncharted territory, and there's a lot to learn for so many people. So what should they be considering if they want to get involved?
Yeah, what I would say is try to just do as much research as you can. I don't think this is one of those spaces where there are like clear metrics that you can easily look to and just say, this is of course like going to be a rockstar project. This is something like we're all collectively discovering the different ways that we can use these tools together. And so from that perspective, I would say the best way that you can get and form your own opinions is to immerse yourself in what are the different places that people are building, where they're creating. I would suggest folks like find projects that resonate with them, spend time in those communities, in those discords, trying to understand what people are trying to do with these different tools. And then it will become clear what theses that you can draw for yourself about what you feel comfortable participating in. Maybe to give a concrete example, I'm working with a team they're building like a game universe, they're building their whole lore. And for a lot of what they're trying to do is think through, well, what are ways that we can actually empower our users with these objects? How can we create experiences that are more delightful? Because it's something that you can take across different platforms, whether it's in this specific game or if this becomes something that other games want to implement as well. And so I think it really requires, when you're talking about like the bleeding edge of anything, it requires going to the people who are creating at the edge to really understand what's going on.
Okay, so bring in NFT storage. How does that play in, and what specifically is that?
Yeah, so NFT storage is a platform. Maybe the one-liner is it's trying to be the internet archive for NFTs. When we start thinking about NFTs as these public goods that are privately owned, you run into this interesting problem where it's not like you're defaulting to a specific company that's going to say, hey, this content is necessarily going to be here. There's like no specific assumption that these networks are making about how do we make sure this data is around. And when we start saying, like, we want these digital objects to be something users own, the thing that NFT storage is trying to solve for is really just say, how do we make it really easy for people to make sure their content doesn't go away? And how do we actually build public infrastructure on top of this data asset that's collectively owned? So NFT storage is a project. We have a number of partners that are working together. This spans from developers who are just indie developers by themselves. This spans to community members from different blockchain ecosystems who are helping archive the NFTs in their ecosystems. This spans to marketplaces and other infrastructure providers who are trying to build services. And I think this is one of those hallmarks of the Web3 community coming together collectively to solve a problem.
All right, we have to leave it there, but thanks so much for helping us make sense of it all. Jonathan Victor, NFT gaming lead at Protocol Labs. Have a great weekend.
Thanks for having me.
Thank you. Coming up, we'll hit the charts with the Chart Master. We'll look at analyst moves in Toast, SoFi, and Coinbase. Morning Trade Live will be right back. Stay tuned.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
We're back on Morning Trade Live. It's time for the Chart Master, and for that we welcome in Ben Watson. Good morning, Ben. Thanks for being here.
Yep. Good morning, Caroline.
Ben, let's start with Toast. It's a company you probably don't need. I follow you on Instagram, and I know you cook all of your own delicious meals. No need for restaurants, but the payment stock saw a price target cut at Goldman to $25 from $34. They kept a neutral rating on shares of Toast. In turn, it's down today about 1.2%. What are you looking at in terms of the chart?
Well, I'll tell you what, Caroline, this stock seems to be moving much the same way a lot of not only the payment space, but also that food delivery and restaurant space, but really technology in general, stocks have been moving this kind of long downtrend, but building a little bit of a base here, in this case on Toast, that pattern building along that 16.5 support level, and a bit of a rally in the last few weeks, although a bit of a pullback again down towards that support. Gap down rally today on this price target cut, bringing that analyst target to the 25 level, which is realistically a couple of bounces higher here. If the price of the stock does start to bounce, that 25 kind of right up at that previous high. But maybe this sentiment indicator at the moment, that short-term and intermediate-term sentiment, the solid line in the lower panel, leaving Toast investors a little bit dry here. Longer-term sentiment, though, moved quickly towards that overbought range. Not quite enough to burn the Toast yet, but perhaps enough to lift it on a support bounce up off of this 16.5 level.
But wow, Toast down 46% year to date. So does it look like it can get anywhere near? I mean, it looks like November, it was trading as high as 70. I mean, so what's the next level, I guess, that it can get to on its way maybe up? I mean, this analyst only thinks it's getting as high as 25.
Yeah, and realistically, that 24-25 level, that's that previous high off that little bit of a bounce. It would take some significant move to the upside and some significant effort on the part of the stock to get back to those lofty highs. Now, to be fair, this is a stock that has a reasonably short history, maybe not quite going stale yet, but at the same time, not seeing a lot of earnings history. We're 2 cycles into this release. The potential is there. I mean, we're now a few weeks away from that next earnings cycle, and that announcement could be enough of a catalyst to perhaps drive the price higher. If it breaks down, you might look at that 16.5, and then below that level, maybe a symmetrical target down around the 10 level if it consistently moves the way that it's bounced up from there. But at the same time, it's got to get through some of these previous highs in order to start that uptrend again.
All right, I think I counted 3 Toast puns there, so congratulations times 3. In terms of your next stock that you're looking at the chart, SoFi, Citi's cutting its price target on SoFi to 17 from 20. They're still saying buy it, but this I think has to do with the student loan moratorium extension. It was supposed to end in May, now it ends in August, and it's good news for people who are, have student loans still, but bad news for a company like SoFi.
Sure, absolutely, and I think you're absolutely right. Those political impacts weighing certainly on this stock, and again, seeing a lot of those same types of patterns here, kind of this long extended downtrend. However, building this sideways oscillation, and that's kind of been the theme that we've seen in not only these fintech, but also just general finance stocks as well as technology, is kind of building these basing patterns over the last few weeks. In this case, it's a fairly narrow range, that sideways oscillation coming between about the 775 mark and the 10.5. We get a little bit of a gap down sell-off that puts it right back down onto that support level. If we get a bounce on the stock, the bounce potentially back up to that 10 mark, then 13 is that next previous high. If it breaks down below this support, Again, you might look at a symmetrical target down around 6 just from that width of the oscillation range here. And again, these aren't predictions. These are simply technical areas where price support or resistance has perhaps occurred in the past. But look, combined sentiment, those two lines kind of being down in that oversold range at the same time, kind of in the same space, suggests that sentiment may be getting to an extreme, and that primes the pump possibly for a little bit of a bounce here. Not a guarantee, but oftentimes with price at support and those sentiment lines coming together either in the overbought or the oversold range, that can be an indicator that there is a bounce possible. So no guarantees of that, but it certainly is at that point. And again, earnings a couple of weeks away here.
A bounce, but not quite up to $20 or $25 where it was trading last year. In terms of SoFi, though, I was looking, analysts split in terms of 6 buys, 6 holds, 0 sells, median price target of $13.50. Do we look at this one as a tech company, so a growth company heading into this interest rate hike cycle, or do we look at it as bank stock, which maybe could perform a little bit better because of a higher rate environment? It's kind of both.
Yeah, it really is kind of both, and that's why it's it's kind of being influenced by those influences in both places. But again, think about the landscape politically going forward. If that student loan repayment becomes the political football ahead of midterm elections, that could spell some downward pressure, some attenuation for the price of this stock.
Very true. Good point there. Lastly, Coinbase price target cut at Goldman Sachs to 240 from 250, but they're keeping a buy rating, so still bullish on Coinbase, but lowering price target. It's down about 1.5% today. What's the chart show you?
Yeah, again, another long downtrend that's really kind of building this kind of sideways pattern. And in this particular case, you're starting to see perhaps a bit of an inverted head and shoulders pattern. That left-hand shoulder coming right about the 165 level, the head of the pattern down around the 150, and then this right-hand shoulder building about the 161 level where it's testing today on this price target cut. The price target cut bringing it down to 240. The bounce potential is back up to that neckline right around 212. The target actually puts it up around that 240, 250 range if it goes to the pattern extent. And again, that's simply measuring the technical analysis levels of support and resistance here, not predicting anything. But long-term sentiment starting to rise, intermediate-term sentiment flattening out down there in the oversold range. And so as it sits at a support level, you might say that kind of in between earnings cycles here, it's a bit of a coin toss.
I knew I could count on you for another pun, but Coinbase is down 35% year to date. So would that indicate that we're approaching a bottom at around these levels right now?
Yeah, and that's what this pattern tends to indicate, is that it's a building basing pattern. You have a higher low followed by a lower low right there in the middle, followed by a higher low, and that's what it's creating today. Now, if the price breaks below that 161 level and then even tests down to that 150 support, this pattern becomes somewhat invalidated. Still perhaps sideways, but the potential for this to indicate some upward movement, especially if it breaks out of that 112 neckline, becomes a little bit less significant if it violates this right-hand shoulder support.
All right, we'll leave it there. Ben Watson from Salt Lake City, thanks so much. Have a great weekend.
Thank you.
When we return, it's market meetup time. We'll look at today's market action and look ahead to next week's earnings and economic data. Stick around on the TD Ameritrade Network. Morning Trade Live. We'll be right back.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CNE Group, where risk meets opportunity.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back. Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CNE Group, where risk meets opportunity.
I'm Jenny Horn. Here's a few more of this morning's movers to keep on your radar. Morgan Stanley lowered its price target on Spotify to $225 a share from $300 while maintaining an overweight rating. The firm said underlying growth appears to have been strong during the quarter. It also noted that recent competitor price increases support its view that Spotify's average revenue per user can continue to grow long term. But the price target reduction reflects the higher rate environment and long-term gross margins. Raymond James started coverage on Procter & Gamble as Outperform, saying the stock is well positioned to navigate increased volatility. The analyst said that while the backdrop for consumer staples has grown more challenging as the market digests growth and inflation post-COVID, they believe Procter & Gamble's ability to navigate the headwinds against costs with its own initiatives and focus more on innovation to sustain its momentum. And Morgan Stanley reiterated its overweight rating on Peloton, but noted it sees third quarter subscribers well above consensus. The firm added, however, that other accelerating trends still remain concerning for the fitness company. Shares have shed over 7.5% week to date. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Caroline Woods hosting.
Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. It's time to bring in our market meetup panel. Joining me is Nick Theodorakis, Financial Risk Management Director at TD Ameritrade, and Michael McCurr, Director of the Trading Services Offer for Charles Schwab's Advisor Services. Thanks so much for joining us, Nick and Michael. Let's start with you, Nick, just in terms of your takeaway. Looking at the markets here, we have a higher Dow up 0.4%. We have a lower NASDAQ down about 1%, modestly lower S&P and Russell, but regardless, at this point, we're on pace for weekly losses. What's your takeaway from the action this week?
You know, Caroline, it's. I'm trying to get a chart to work here. My toss is moving a little slow on me. Sorry. You know, we're basically we're lower right across the board, but I think it's a little bit more of the same when we've seen these sell-offs that seem to be inflation and interest rate related, where the NASDAQ really is leading the way lower. We're kind of closest to unchanged in the Dow and some of the staple stocks, and then in the tech we're down 3% on the week with another almost full day to go here. NASDAQ down 1% plus again today. So I think it's going to be really fascinating over the next couple of weeks to see where can the market find its footing. Right? And I feel like I've been a broken record this week, but the inflationary concerns, I think, have again sort of taken the number one position, if you will, over the war in Ukraine right now, and kind of the risk space. We talk about the unknowns becoming known, right? We talk about if this shock is completely out of left field and we didn't see it coming, it's going to have a real big impact on markets and volatility. And that happened with the war. And unfortunately, this is still dragging on and seems like it will for a while. But there hasn't been any real new developments. And it's allowed people to really focus back, I think, on domestic and international inflation and then understand what central banks are doing and talking about being willing to do. I think my biggest takeaway is hearing all the Fed speakers this week, Mary Daly in particular, who's been very dovish, typically getting into this sort of the hawk camp and saying we have to do more. So just a fascinating kind of time to watch all this and think about how it's going to play out, because if interest rates really do continue on the trend that they're at, and mortgages and all this, and we really see this uptick, things are genuinely more expensive at a time where the supply is really, really tight, and that's a tough thing for markets to digest positively.
All right, we'll talk about rates and the Fed in just a second, but Michael, turning to you, Nick was talking about where is the market going to find its footing. When you look at the charts, what specific levels are you looking at in terms of where it could possibly, or at least where it is now?
Yeah, and honestly, where rates are, it's impressive in my opinion that equities have held up to the degree that they have. If you had said 6 months ago, if the 10-year was at 2.7 and 1 year out, the Fed funds rate market was pricing in the Fed to be 50, almost 100 basis points above what the Fed considered neutral, where would you have said the S&P was going to be? I would say the majority of people would say markedly lower. Yet here we are, the S&P's continuing to really oscillate around its 200-day moving average, right around 44.95. I think, after we've let some of the air out of the tires, as you and I discussed 2 days ago, given the really hot overbought breadth momentum that we saw after that 11+% rally in the course of 2 weeks. The equities specifically, I'm going to reference the S&P and the NASDAQ 100, are really oscillating between their 200-day moving averages and their 50-day moving average. Now the 50-day moving average is flattening after really descending over the course of a couple months. The S&P is continuing to try to hold that 21-day moving average and the 50-day moving average, which I would view as a positive. And both of those are between 44.20 and about 44.40. So those are the downside supports in the S&P. When it comes to the NASDAQ, 14,350. That's the 50-day moving average. That's basically the low today. I would say loosely that needs to hold for the at least near-term uptrend to continue and the bulls to remain fairly in control. Ultimately, the NASDAQ needs to get back above the 200-day moving average, which is at 15,150. I wouldn't expect that to take place until at least a couple weeks, if not a month or two of sustainable footing. But the S&P, I think, is probably going to lead us higher if we do move higher, and it needs to get back above that 4,600 level. But the supports continue to hold as rates continue to move higher. So I would say that's pretty positive.
Well, S&P just turned a little bit positive, although it could change in a second. But Nick, Michael proves a good point there. We focus a lot on the losses, but maybe we should focus on the fact that the losses aren't as big as you would have otherwise thought. Dow and S&P down about 4 to 5% this year. NASDAQ still in correction territory, down about 12%. But do you think we're doing maybe, I don't know if we want to say as well as we are, because there really is no other alternative?
Well, we've been talking about that sort of equity positioning for a long time. I feel like Mike and I have had these conversations lots and lots of times. It's sort of the inability for equities to really just wash out, because there's not a great place still to go and get another a return. And yes, rates are ticking up, but if you look at the very long-term zoom out historical picture, rates are still extremely low. Mortgages are still extremely cheap. I know it doesn't feel like it month over month and week over week, but I think that is definitely part of why you're not seeing this sort of washout in terms of equities, because the Fed has telegraphed what they're doing. Right? And yeah, like Mike said, we're looking out and saying rates are going to be even higher than the neutral rate, and fine. And markets are predicting, right? If you look at the CME FedWatch tool, predicting even more of an aggressive hike, but they're still extremely low, and staying in this sort of 3, 4, 5% range, right? I know 5% from here's a long ways, but a 3, 4, 5% range is very, very different than being at a 10, 12, 15% range. So historically speaking, I think there is the ability for equities to maintain a bit. What's going to obviously shake that is this, and I think the next earnings season are going to be key. Now we're actually in a higher rate environment, but we're in a flat yield curve environment. So higher rates good, flat yield curve bad for financials, not great for a lot of other companies that invest along that curve either. So how that shakes out, and now that the rates have actually started to move, hearing what the CEOs and CFOs are saying on these conference calls, I think is going to drive a lot of the market action over the next couple of weeks for sure, and the next couple of earnings cycles, because most investors and analysts too just aren't used to being in a rate environment like this. How is it going to impact these companies that are going forward? And we're going to get a much better insight into those sort of forward-looking earnings projections. I think that's going to ultimately help the markets figure out what the right level is here.
All right, so we'll have some new catalysts next week. We have to leave it there. Nick, Michael, thank you both so much. Really appreciate your insights. And thank you for joining us. I'm Caroline Woods, and I'll see you this afternoon on Market on Close. But first, Trading 360 with Tom White is up next. So stay tuned and have a great day.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Wow, I gotta take off. Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
Welcome to Trading 360. I'm Tom White, filling in for Nicole Petalides. Good morning, and we're 90 minutes into the trading day, and equities are struggling but are now mixed off of session lows. Treasuries deepened losses following earlier declines, sparked by the Federal Reserve's plan for aggressive monetary policy tightening. Stocks have had a little bit of a harder time this week, digesting the fact that interest rates are going to be higher, with the 10-year yield at its highest level since March of 2019. Meanwhile, U.S. officials warn the war in Ukraine may last for weeks or even years. Now, let's take a quick look at the markets. The S&P 500, the benchmark, up 0.2%, further off of those lows that we saw early on in the session. Dow Jones Industrial Average leading to the upside, up 0.7%. The NASDAQ 100 still in the red, but down only 0.5%, but bounced severely off of those session lows. And the Russell 2000 peeking its head into the green, up nearly 0.2%. But let's take a look at the top futures products, including the dollar, which hit the highest level since May of 2020 earlier on in the session. Bitcoin futures reversing losses, up 1.1% now on the session. Gold up 0.5% despite that rise in the dollar. Crude oil futures now in the red after being up more than 2% earlier on in the session, above $97 a barrel, now just below $96 a barrel. And the volatility index futures down 2% on a strengthening equity market. But let's get some insights on the biggest news that's shaping the markets thus far. And for that, we're going to welcome in Ben Emmons, Managing Director of Global Macro Strategy at Medley Global Advisors. Welcome to the show, Ben.
Good morning. Welcome. Thank you for having us.
All right. So, the equity market's been taking its cues from the bond market this week as yields have spiked. But what's your outlook for equities here as volatility remains fully intact at this point, and it seems like it's just a roller coaster of a ride for investors at this point?
It certainly is. I don't think that necessarily will change, for the broad index, because you outlined, like, you have a war that may last longer. You have a Federal Reserve that really now tries to get ahead of the curve and unwind that balance sheet faster. You have inflation data coming out next week. That's not going to be looking very pretty, and And then we get earnings out too, right? Which starts with the financials, and as you can tell from bank stocks, they've been down of late. In part, despite rising interest rates, I think that's really a reflection of people getting worried about that the economy at least is slowing down. So broad index will be under this spell of volatility, but within there's a lot of opportunity though. I don't think you can play offense, defense in this market between, say, reopening type trades that are still ongoing, and take the defense side on the commodity side, particularly given the conflict of Ukraine is put so much pressure on commodity prices.
Yeah, and Ben, if you take a look at some of the areas within the market that are maybe outperforming, we've seen a lot of strength in healthcare, utilities this week, consumer staples. That typically, to me, is a warning flag that, hey, the areas of the market that typically lead us to the upside are not right now. We're getting a little bit of a reprieve here as the markets turn green. But at the same time, is that the theme that's going to play out for investors moving forward, that they're going to continue to go into dividend playing or safety plays at this point?
Very much so. I think it's because of the uncertainty, particularly I think related to Ukraine, because you just don't really know how that conflict exactly will play out. And above all, the risk that Europe will fall into a recession sooner than the United States is a risk to the U.S. economy and U.S. markets too, right? And I think this is why people are moving more defensively. And, and as you mentioned, the Treasury market is under significant pressure currently. So that's not why you can play really as a defense. You got to go into lead staples, higher dividend-paying stocks, or materials perhaps. Or otherwise, I'd say food-related industries that are now going to stand to benefit from this major food price shock that we're going through. So I think that's the way to do it. And as you show out there on the graph, you can average it all out in sort of an equal weighted way. That red line that you show on the graph is the portfolio I'm looking at for myself each day, that can outperform the indices. And I think that's the environment we're in. You don't play the index, but you play in these different sectors equally weighted to try to get ahead of the game.
Yeah, and you mentioned that offensive defensive portfolio that you've been hitting on here. Is that that theme that you have in there? You like some maybe emerging markets. You like some stuff in the consumer staples. But if you look at the areas like discretionary, which has been under pressure this week, is that a warning signal for the overall market that, hey, you know what, the consumer, which leads most of the economy or 2/3 of the economy, that starts to wane a little bit? That's going to be a telltale sign or a canary in the coal mine for potentially more volatility and weakness.
That's definitely true. I think consumer discretionary stocks is where the real pain for the markets could be ahead, because if high gas prices persist and higher interest rates start to come about and put pressure on people's mortgage payments or pressure on the housing market, confidence itself has already been waning on inflation itself, people are unhappy with inflation, then yes, consumer discretionary stocks can decline. That said, though, there are some sectors in that consumer discretionary that are still very cyclical, reopening related. I think, for example, the airlines that I favored a lot for a while. It's a bumpy ride since I started getting in that trade last year, and despite the fuel costs that they face, the travel season is wide open. I do think that's one sector in that area, the consumer discretionary, that can outperform. But the bigger risk, of course, is that we tilt into this softness in consumer discretionary that leads us to this path down, ultimately to a recession. Don't think the U.S. recession will be this year at all, but it is a warning sign, no question.
Yeah, and I like the fact that you brought up airlines, Ben. I just flew, and trying to book other stuff for the rest of 2022. Prices are about triple what they were at the end of 2019 and pre-pandemic. Even with the rising fuel costs, rising wages for these airlines, it seems to be this is the area of speculation. So do you barbell that off? I noticed that you have some other more stable names that have greater balance sheets like Microsoft and some others. Is that how you have to approach this market moving forward, because the volatility will continue?
I think that's exactly right. You really want to barbell it that way, because those big names, as you mentioned, like Microsoft as an example, that is a name that doesn't really go through major contraction, and unlike maybe some of the cyclical names. And then if you take advantage of what you mentioned, what's so interesting about those airlines is that, yes, the airfares are up, but airlines have been so deep in the hole from the pandemic that they're actually reflating, so to speak. Their revenues will go up quite a bit near term. So the earnings of those companies, I think, will be outperforming, for example, earnings on banks that we see next week that may not be so rosy anymore given the volatility of the market environment. So I think indeed play it out that way. Keep your portfolio somewhat, what I say, equal weighted. Like don't be like a say 70-30 idea or 90-10, be more 50-50 between defense offense, because it just shows you that it really isn't a year to be in this index. If you take a 60-40, it would be too index exposure, right? Let's say equity index or bond index. If you go the other way, you gotta kind of spread it out. That seems to be the environment we're in.
Yeah, I like that setup where you're in these names that have better balance sheets, better growth prospects, but then also you have to have some exposure to areas that might continue to do well in case there's no recession. And historically, equity markets have risen during a rising interest rate environment like we're seeing right now. So we'll have to wait and see how that plays out. But I wanted to get one more quick question in for you on Twitter. Their association now with Tesla, with Elon Musk taking a huge stake in there. He was passive, now he's activist investor in this company. This probably means there's going to be a lot of changes, and I think that's what a lot of investors are excited about, and I think Twitter is due for changes. What's your outlook here for that stock?
Yeah, definitely. You know, that was a major change, really quick, and it's amazing how, you know, the Tesla and Twitter stock are correlating positively. They already were, but that correlation's picked up. So I took that more like, if you're getting someone like Elon Musk being activist on a company like Twitter that has significant influence on, say, you know, views about not only social media, but also tech in general, then I think that could be potentially a positive. Now, to be seen exactly how this plays out, what Musk is able to accomplish on that board. You know, some people speculate that the former President Trump will get his Twitter back, right? Who knows? But it's more about, I think, this is a company that can turn around with some leadership from him, given what he's done for Tesla. I think that's the confidence behind the move in the stock that you've seen of late. Will it be, you know, back to the highs from where it came from? I'm not so sure, but I think this initial pop shows confidence from investors that Musk can turn things around.
Yeah, and monetizing those daily and monthly active users might be the first thing on his agenda moving forward. All right, Ben, thanks so much. Have a great weekend.
Have a good weekend. Thank you very much.
All right, that's Ben Emmons, Managing Director of Global Macro Strategy at Medley Global Advisors. But there's plenty more to come on Trading 360. Tim Lesko from Mariner Wealth Advisors covers airlines on the 360 Spotlight. And Patrick Dahan from Gas Buddy will break down fuel prices. And for the 360 round, we are covering the FANG stocks. But up next, it's the big three. 3 stocks, 3 charts, and 3 trades. Ben Lichtenstein goes through the technicals, and Joel Hawthorne from MorningSnapshot.com takes us through his trades in Roblox, Meta Platforms, and CrowdStrike. That's coming up next right here on Trading 360.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Tom White, filling in for Nicole Petalides. But it's time for our big three stocks, 3 charts, 3 trades. Joining us is Ben Lichtenstein. He's going to take us through the charts. And here to take us through the trades is Joel Hawthorne from morningsnapshot.com. Welcome to the show, Joel.
Thanks for having me, Tom.
All right, so first stock we're going to talk about is Roblox, the gaming platform where users can kind of go back and forth and create new games and new alternatives on those games. The stock's down nearly 70% from all-time highs that we saw last year. Joel, remains under pressure. What are you looking at as far as trading goes in this name? Because it's been pummeled with a lot of these growth and tech names.
Yeah, I think when the news came out, the whole metaverse kind of inciting news came out here just several months back last year. I think Roblox was one of those names that everyone just really thought would be an immediate benefactor of that news. And I think that stock had a lot of optimism priced into it. I am guilty myself of thinking like, oh, wow, this is going to be great for this platform. Even talking to some younger people that are into video gaming, this is something that I thought that really would take off based off some of the information I got there. Needless to say, we see the chart has a screaming downtrend, just going into a longer dated chart. Even if we go back to the highs back in about November when they traded 141, because of that screaming downtrend, I think there's still some more pressure to go to the downside. I'm actually bearish myself right now.
Okay, so when you look at this, you've got volatility in the overall markets elevated at this point. When you're looking at, taking directional plays in names like this that have been beaten down now, it has bounced off of those 52-week lows from a few weeks ago below $40 a share. How do you want to look at this? Because implied volatility is still relatively elevated in this name.
Yeah, definitely looking at IV today. I mean, if we look at it right now, it's very high right now, over 100, about 114 or so. So right now, I'm actually, when vol is high, I like to sell options. I don't want to pay the price of buying if I want to be bearish and buying puts. So in this case, I'm actually going to sell the 44 call that expires next Friday, while simultaneously taking a call that expires next Friday at 47.50, taking a credit of about 128, risking $1 to make 45 cents. And my break even here is 45.36. It's a bit aggressive, but I think that definitely if the overall market is weak, we could definitely see some momentum to the downside in a name like this. So right now, if we stay where we are or even drift lower, I stand to potentially make a profit.
And I like that setup, Joel, when typically I'll look at maybe selling out of the money verticals. This is a lower price stock. Maybe you don't collect as much premium, but this is a directional play where you're selling options, taking advantage of positive time decay. But it's more aggressive because you actually need this stock to kind of top out here and continue to move lower, right?
Absolutely. And I do like to sell out of the money options as well, just because to start the trade with better probability. But I think that just with the climate of the market we're in, with the overall vol in the market, we're seeing some wild swings. I think this is just another way to be a bit aggressive and just kind of go along with that momentum. Because if I'm right, obviously I collect more premium. And then if we kind of price in those levels by the time of expiration, even if I don't get full, even if I don't keep all of that premium, I am still making more money than I would maybe with starting to trade with a higher probability ratio.
Right, and you've got a risk of about $2, over $2.20 on that, collecting just over $1.25 on that. Now, Ben, let's go to you. Take a look at the charts on this name. Finally bounced off of those 52-week lows, still below its 50 and 200-day moving averages. What are you seeing on the charts here for Roblox?
It is below the 200 and the 50-day moving average, Tom. And as Joel mentioned, this is a stock that, well, for the most part, we thought it'd be a beneficiary of some of the metaverse energy, but the optimism really kind of came out of it quickly. And take a look at the 30-minute time, the hourly, first and foremost, in the range that we've seen basically since the end of February. You can see a pretty well-defined upper extreme around 54, a lower extreme around 35. And while you look at this range kind of isolated all by itself. It doesn't really mean much aside from having, again, a pretty well-defined upper and lower extreme, so that gives you a gauge in terms of directional conviction one way or the other as we break out. But when you bring this into view, and again, this is that same range we were just looking at a minute ago relative to the price activity we've seen as Joel was talking about. Well, this goes back to the beginning of the year, but take a look at the daily time frame. Here you can see, again, migration of value to the downside, so this area of consolidation, just one of 5 that's now forming at a lower extreme. Here's that 200-day average you mentioned, Tom, the 50-day moving average in the blue line. And RSI kind of struggling to get anything going to the upside. That move that we just looked at, part of a bigger move off the 141.60 level. So a trend environment to the downside, and one that's really yet to take out anything or show any signs, I should say, that it's bottomed out at this point, or definitely hasn't taken anything out in terms of significance of what was established on the way down. So this is one that continues to remain under pressure.
Yeah, and we'll have to wait and see. A rising interest rate environment for companies that are high growth names might come under pressure. So Joel's trade selling that out of the, or basically at the money call vertical to take advantage of maybe a reversal and some more pressure on that name. Now, Joel, let's go into your second name here, and that's Facebook/Meta Platforms. I still am not going to say Meta Platforms only. Always got to throw Facebook in there. This one's struggling right around its 50-day moving average, Joel, but this one has really been underperforming due to the fact that they lowered guidance moving forward last quarter. A lot of people like this, 2 billion active users on a monthly basis for this company. How do you look at Facebook here that continues to underperform out of all the FANG Plus names?
Definitely. I think that this is just kind of piggybacking on what you said. Just kind of getting used to calling it Meta. All right, it's just Facebook. That's just how we know it. And it's just one of those things where I think because they're such a behemoth in regards to just data, users, and have been for so long. We understand. We also know they own Instagram and things of that nature. You know, as an investor, we're waiting to see this thing kind of really get some rocket fuel to the upside. Maybe have some optimism. You know, maybe they need to take a more colorful approach, maybe like an Elon, right? Like this guy, he really knows how to get, some of his companies on the move. This one here has just kind of been treading water and really, on any day, really having that standstill moment. I'm optimistic, though. I think that maybe we get a breakout. I think maybe if the overall market kind of gets a bit of movement to the upside, I think Facebook does get some movement there as well. Because of that, I'm definitely looking to sell some options and collect some premium as it may rally.
Now, we've got implied volatility just below 52-week highs in here, so option premium has expanded as the uncertainty continues for the overall market. They've got earnings on the 27th of April, so you've still got a few weeks. How do you want to set up your trade here in Facebook Meta Platforms going into that report? Because historically, we'll see a run-up, or maybe some analysts come out with some positive commentary ahead of the results, but you're avoiding this earnings event with your trade, right?
Absolutely. I don't like to really sell any options, or for that matter, really trade very aggressively in the face of any economic data, earnings news, or anything like that. So in this case, I want to sell those options that expire next week, selling at $225 while buying at $220, and collecting a credit of about $2.15, risking $1 to make 75 cents, and having a break even about $222.85. This trade is really structured around. And really, another point of it being aggressive is if the overall market, which today kind of option paper says that there is some optimism there right now, some risk on paper. If the overall market gets to move, and I think Facebook is a direct benefit of that movement, and I think that this is a name that can really just close above that $222.85 by next Friday. So we'll see.
Yeah, and Facebook Meta Platforms above that current break-even have here of $222.85 at this point, risking about $285 to make $215. Really good risk-reward setup on a short vertical like this, but you do need the stock to move back above that $225 at expiration in just about a week. Ben, what do the technicals tell you? Because it seems to me that it's hovering around some key support or resistance levels at this point.
Yeah, I'm watching the resistance levels at this point, Tom. Considering the move that we saw off the March lows, let's begin there. the 30-minute time frame and how we kind of double bottomed around 184, and the strong run up, much like the broader market, throughout the month of March and into the beginning of April. Facebook traded all the way up to $236. Now, take a look as we move away from just this move up throughout the month of March and look at where things stand, going all the way back to the beginning of December. And I can understand why Joel's trying to avoid the earnings or participating in the earnings release here, because take a look at the selling we saw and the volatility tied to the last round. That sent them lower all the way down to 184. Again, the rally is what we just looked at off those March lows. But here I'm noticing, as we looked at the broader market, the NASDAQ, the ES, the Dow, the Russell, for example, they were able to take out those February highs. But look, Facebook unable to take out the Feb highs. Now, partially due to the fact that that was tied to the earnings and the swift move lower that they saw there. But I just wanted to point out, in terms of taking another step back, look at the daily time frame, kind of struggling with the 50-day moving average, the blue line. They've been holding below the 200-day moving average basically since, well, breaking down below it back in the beginning of the year. And RSI even at this point kind of rolling over. So I think there are some headwinds right now for Facebook as we head into these results.
Yep, I think it's on a lot of people's radar, digital advertising spend going up, but the amount that they're investing in this metaverse, you know, I always think of this stock and maybe this area that, hey, I wasn't aware that the internet was going to be as big as it is, but at the same time, I just don't know how they're going to monetize the metaverse. But a lot of investment moving into that particular space, but to wait and see on that. Pretty aggressive put vertical for a neutral to bullish stance for Joel on Facebook Meta platforms. But let's move, Joel, to our final stock, and that's CrowdStrike, cybersecurity. It got some price target hikes today, but the stock is actually outperforming the overall market. It's up to over 7% so far this year. How do you want to look at CrowdStrike here, Joel?
Absolutely. I think that this is just another name that's going to stay on the tip of investors' tongues just for
future. Next Gen Investing, weekdays only on the TD Ameritrade Network.
Welcome back to Trading 360. I'm Tom White, filling in for Nicole Padalides. Let's take a quick look at the markets here. The four major indices, the NASDAQ, still the only major index in the red, down nearly 0.7%. Dow Jones Industrial Average up the same amount. S&P 500 off or up about 0.25%, and the Russell 2000 up 0.2%. All four of the major indices still down on the week, but the Dow attempting to go flat at this point. But now it's time for our Trading 360 Spotlight today, and now we're focusing on the airlines. And joining us is Tim Lesko, Director and Senior Wealth Advisor at Mariner Wealth Advisors. Welcome to the show, Tim.
Hey, thanks for having me, Tom.
Hey, before we get into a discussion about the airlines in particular, I just wanted to get your take on the overall market. We've seen some weakness. Volatility is still elevated. It seems like the bond market's kind of dictating what the equity market's doing at this point. Do you see any reprieve, or are we going to see continued back and forth action here over the near term?
I think we're going to continue to see back and forth action. Pretty hard to get a clear picture of what's going on when you have, war in Eastern Europe and you have higher interest rates and high inflation. So until one of those things seems to break for the positive, I think the market's going to be in for a volatile time trying to figure out, 6 months from now, what does the situation look like?
Yeah, we will continue to see that bond market maybe continue to affect the equity market at this point. But one area that you cover quite extensively is the airlines, of course. They've been under pressure over the last 52 weeks. Tim, it seems like inflation pressures, jet fuel prices going up, doesn't seem to stem demand at this point, but it doesn't seem like the airlines can right the ship just because of the uncertainty out there as far as inflation. And will we see some demand destruction on those flights that are in high demand at this point? What's your take here on the overall sector?
Well, I think you hit the nail on the head with the demand destruction question, right? We saw some demand destruction coming out of the Delta variant into the Omicron variant, and now we seem to have very, very strong demand for flights. We've had each of the airlines has talked about, higher demand, higher future bookings. So particularly domestically, you have a tremendous demand for travel and plenty of cash in people's pocketbook. As inflation remains more persistent than people expected, you begin to eat away at that cash sitting in people's bank accounts and perhaps start to, see future demand wane. And that's why investors have really taken a pause on airlines, particularly over the last year, but more acutely over the last 3 or 4 months.
Yeah, you bring up a good point there, because I've been trying to book flights overseas, and they're at triple the price levels that we saw at the end of 2019, early stages of 2020, the last time I traveled overseas. Is that going to, negatively affect the demand picture, where it's almost like what the Fed has kind of laid out for everybody? If you start raising interest rates, trying to get inflation under pressure, the consumer will take care of it itself, because you can't keep buying tickets that are triple the price if you travel on a regular basis, correct?
Correct. And, what you're really seeing as well is that most of the demand has come from consumers, the leisure sector going on vacation, right? And we're entering the high season for that. So airfares are high, demand is high. What does it mean come fall when business travel is supposed to take over for that? Will we continue to see communication services like we're doing, Skyping with one another rather than going on business trips? What is the overall outlook for steady state demand in airlines? And nobody really knows what that is. Inflation is going to hurt airlines because they have higher fuel costs and they have higher labor costs. And they took on a lot of debt during the pandemic crisis. So really nobody knows what normal run rates are for these guys and what normal earnings are.
Yeah, it's almost like that breaking point, Tim, for the consumer, what they're willing to pay to finally get out there and do travel again, because we've already seen the drop off in a lot of the consumer discretionary and brand names, especially if you look at Home Depot and some of the other retail outlets where, hey, they're pulling away from that. They're going into experiences at this point. That's right up their alley. But you did mention business travel, and I think that's a huge key for not only the domestic carriers that we have, United, Delta, and American, which rely on the revenues from that. But have you seen that starting to pick up a lot more lately as the economy's opening up?
Well, that's, I think, the hope is that as the economy opens up, people will long for those types of business meetings. Certainly, we thought after Omicron that you really had the green light to begin seeing cross-Pacific and cross-Atlantic flights, which are really, really expensive to run. So you need high seat capacities and you need high utilization. And what's going on in Asia has put a little bit of a question mark as to whether we're going to see that return of business travel this summer. Expectations are that's still going to happen. People are not going to want to work with one another in 2 dimensions for the rest of time. But those with complex route structures, multiple different aircraft types, have a hard time running a business in this environment versus the domestic carriers who tend to have simpler business models, simpler routes, and the ability to expand and contract routes where you really don't have that internationally.
Yeah, getting back to that semblance of normality for a lot of those companies. And as I mentioned, I just traveled last weekend, and the Admirals Club was just full of business travelers. I was down in Texas, so maybe that equates to more people traveling actually for business at that point. But if you look at it another area, the discount airlines, you know, there's this fight over Spirit Airlines at this point. JetBlue making a bid. The Spirit board thinks they could probably get more. Do you see any regulatory issues? Because just looking at it from the outside, Tim, I think this deal has no way of passing the regulators at this point, just due to the Northeast corner. Your take here on this potential deal in more consolidation in the industry?
Right. I think the route map is going to be very important whether or not the deal passes through federal regulators. The deal on its surface, when you have 2 airlines that are merging with one another that actually fly the same aircraft and have the same pilot training and the same systems, tends to be an early accretive type of acquisition. But who knows whether in this environment you're going to get that approved. You do have some new airlines popping up in the form of Breeze and in the form of Avela. So you're starting to see people replace what used to be the budget airlines that have now become these really large domestic airlines. So if you do have enough other competition, perhaps the deal could get through. But those again, you have higher interest rates. Higher interest rates means that planes become more expensive. So the growth of those other airlines may be challenged if the financing on aircraft gets more expensive. This
A lot of concessions probably coming down the road if they want that deal to get through, Tim. But if you look at this area, are there any specific names within the airlines that you like more than others at this point?
Well, I think we just think more broadly is that we particularly look for those airlines that are more wholly domestic and have the simplicity of business model. So it's really not this environment that we're specific to that. It just tends to be, as long-term investors, you're trying to find more repetitive business models and more consistent recurring revenue. So we tend to stick towards the domestic-only kind of simple carriers. Put it that way.
All right, great discussion. And I follow a lot of option activity, Tim, and it just seems every day there's some speculation to the upside in a lot of these airlines, but they're going out in duration out to June, July, August, September, with the expectations that we're going to see better days for these stocks moving forward. All right, great discussion, Tim. Have a great weekend.
Thanks for having me.
All right, that's Tim Lesko, Director and Senior Wealth Advisor at Mariner Wealth Advisors. But coming up next, Patrick DeHaan from Gas Buddy joins us to break down the outlook for fuel prices. Trading 360 will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Trading 360. I'm Tom White, in for Nicole Petalides, but let's get to our next guest, and that's Patrick Tahan, the head of petroleum analysis at Gas Buddy. Thanks for joining us, Patrick.
Thanks for having me, Tom.
All right, so we've got crude oil under $100 a barrel, thankfully, Patrick. What is that equating to as far as the fuel pump? Because I always see it this way, that they'll hike it at 10-cent, 15-cent increments every time oil goes up. And then it's like an escalator down where they'll cut it by 5 cents or so. Where are you seeing fuel prices now nationally?
Yeah, Tom, we're starting to head down. As you indicate, prices come down a little bit slower than they go up. And there's a lag time on both sides of it. Stations are now recouping the losses when prices actively spiked a few weeks ago. The national average is down to $4.14 a gallon. Actually, now we're just a little bit under that. That's the lowest price we've seen since March 6th. The price of diesel is coming down as well. It's at about $5.06. The good news there, looking at all the metrics, we're down from yesterday, from last week, and now we're down from a month ago. And we should continue to head south. In fact, the national average will likely fall under that $4 a gallon mark in the next couple of weeks.
Now, do you see that, Patrick, because we're heading into prime driving season, do you see this holding, or will this all just depend on the volatility that we're seeing due to the Russia-Ukraine issues? Demand is still there. Do you see it picking back up quickly, or just remaining volatile at this point?
Well, I think there will be a lot of volatility. I mean, the situation remains fluid between Russia and Ukraine. Oil prices have been all over the map. Now, we have sustained the sub-$100 level for WTI as we progress through the summer. It's going to be subject to the whims of what happens geopolitically, especially Russia and Ukraine. The EU has obviously continued to mull over sanctions on Russia's oil, but that's still pretty unlikely. So this summer could be a bumpy ride, but there is the potential that the national average may have peaked for the year, barring unexpected developments in the Russia-Ukraine situation.
Yeah, those geopolitical risks are going to remain. Now, I'm here in Chicago, Patrick. It's just dismal when I go to the gas pump. If I can get into Costco, which I usually can't near me, I might pick up a few pennies here or there. But do you see the major areas like California or the Midwest or the major cities where it's typically higher tax states remain, or will they be the first ones to see some relief at the pump at this point?
Well, at least so far, Tom, most of California has slipped back under that $6 gallon average. Now, it remains sky high in California, well over $5. In fact, it's still closer to $6 than it is $5. But areas of the West Coast had been hit hard, not only by the rise in oil prices, but refinery kinks. They should see some relief in California. LA is back under $6. But some of those big cities you mentioned, LA, Chicago, they have stringent gasoline requirements along with higher taxes than normal. So I'm here in Chicago, too, and we're just under $5 a gallon. We'll see a little bit of relief, but the major cities are now on a more stringent type of summer gasoline for the summer, so don't expect any sub-$4 prices in these major areas. And for California, we'll be lucky to see prices slip under $5 a gallon, if that happens at all the rest of the year.
Yeah, that'll continue to hit the wallet of the consumer. We've seen discretionary spending starting to pull back pretty significantly. Maybe that inflation takes care of itself as the Fed wants it to. But just give me your outlook real quick, Patrick, on crude oil. I know you mentioned geopolitical risks that are out there, but demand is also still out there as people want to travel and get out there and do experiences. Is that the key to keeping oil probably range bound between maybe $95 and $105 a barrel?
Yeah, I think that's the range we could settle into, maybe a little bit higher, depending on how hot demand is this summer. As you mentioned, we are coming into a time of year that oil consumption is going up. Look at jet fuel. Americans want to get out and about. The economy is broadly reopened, the global economy, that is. We're starting to see some of those wide-body planes take to the skies, as you discussed in your previous segment. So that could be bullish for oil. We'll have to see how high it gets, but I would say somewhere between $95 to $110 a barrel for most of the summer. And if there are escalations between Russia and Ukraine, or if the EU does put sanctions on Russia's oil, we could head more north, closer to $150 a barrel temporarily.
Oh, yeah, definitely some additional volatility coming down the pipeline. And jet fuel reserves at some of their lowest levels that they've ever seen in history as demand continues to rise. All right, Patrick, great discussion here. Have a great weekend.
Thanks, Tom. You as well.
All right, that's Patrick DeHaan, the head of petroleum analysis at Gas Buddy. But coming up next, it's a 360 round, and joining us to cover the FANG stocks is Angelo Zeno from CFRA and Mark Mills of the Manhattan Institute. Trading 360 will be right back after this short break.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh, wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Another volatile session for stocks and stock index futures products as we try to add to the gains from yesterday with inflation, rates on the rise, and geopolitical tensions have investors reconsidering their risk tolerance. 3 of the 4 majors are positive. The S&P is around 4,500, it's fractionally higher, while the NASDAQ still down around 0.75%, with the TNX at 2.7, the 30-year yields at 2.73, and the hawkish tone from the Fed minutes this week still fresh on the minds of traders. Sights remain set on earnings and eco data next week. CPI, PPI, and retail sales are scheduled for release. Commodities at the root of many of the inflation concerns investors have been expressing, and while crude has come off some this week, the WTI briefly traded back down below 94 to 93.81. We're back around 97 and up over 1% on the day. Natural gas to levels not seen since 2008 this week, with decreased production, increased exports from the U.S., and a larger draw than anticipated this week sent futures to 653 overnight. And lastly, keep an eye on grains, corn, wheat, and beans with the WASDE report due out this morning. The World Agricultural Supply and Demand estimates expected to show slightly lower ending stocks for corn and soybeans. Ahead of the release, wheat is up 2 3/4%. Corn and beans are both up around 1.5%. This has been your futures market update. Now back to Trading 360 with Tom White.
Welcome back to Trading 360. I'm Tom White, filling in for Nicole Petalides. In today's 360 round, we're going to focus on the FANG stocks, and joining us for that discussion is Angelo Zeno, a senior equity analyst at CFRA Research, and Mark Mills, the author of Cloud Revolution and a senior fellow at the Manhattan Institute. Welcome, guys. Angelo, I'm going to go to you first. I kind of want to break down the overall market before we started getting into individual names. NASDAQ still under pressure this week, but it seems like it started to get some traction previously last week and the week before. What's your outlook here for the overall sector as a whole moving into the next quarter here?
Yeah, listen, I think it all depends on the type of investor you are, short, long-term in nature. It's going to be tough here in the immediate near term. I mean, clearly there's kind of a risk-off sentiment in terms of some of these higher beta names within the tech sector, and even some of the more cyclical oriented names when we start thinking about some of the semiconductor stocks out there. But that being said, we continue to like a lot of the larger cap, big tech oriented names, whether it be kind of within tech or even services, if we would kind of throw it all in together. But the secular drivers attached to those type of names out there, we think on any major pullback should be bought. So overall, we remain very constructive on the space, but we do think over the next 3 to 6 months, it could be kind of tough sailing.
Yeah, we've definitely seen some divergence between a lot of those names that make up the NASDAQ 100. But Mark, if you look at the interest rate environment, and that's what everybody's tying a lot of this weakness in these growth names to, is that what's going to dictate the NASDAQ 100 or the tech space in general, the moves that we're going to see?
Well, I think obviously interest rates matter, but I think the bigger macro here is inflation. We're clearly in a cyclical inflationary period, and inflation has two causes, as we know. There's too much money and what happens because of that, and too much demand for too little supply. There's only one fundamental way to improve supply when demand keeps growing up. It's always technology, and it's no mystery that the big tech plays are in software and automation and robotics. So I'm pretty bullish, and again, I agree that it's not going to be an easy ride for a few months. A lot of volatility and chaos and uncertainty, but the macro for the next couple of years is very much a lot of tailwinds for both. We'll call them cloud stocks. FANG is sort of a cloud cut, if you like, and the underlying semis. I'm extremely bullish on the semis. What the Bank of America team has called the Mango stocks, which is a nice acronym.
Yeah, I did see that Mango acronym that came out about a week and a half ago. A lot of those semi names in there. But Angelo, one of the names on your list here is Google Alphabet. It's definitely outperformed most of the other FANG names, still down about 7% on the year. The different silos of revenue generation from this company and their margins that they get from a lot of these businesses kind of dictates where this stock's headed and why it's at the top of a lot of people's lists. Why do you like Google Alphabet here?
Yeah, so we have a strong buy recommendation on Alphabet. Clearly, we think it's way underpriced here. I mean, trading less than 20 times on a 2023 outlook, and you definitely have to have more of a longer term outlook, forward outlook when thinking about these type of names. But I mean, there's really three near-term growth drivers when you think about Alphabet, right? It's their search engine, continued ongoing shift from kind of traditional sources to more digital-oriented means, and that's going to drive mid-teens growth. We think low to mid-teens growth in terms of their search engine. Then you've of course got the cloud-oriented business, a much smaller business, 8% of their revenue, but growing at an enormous rate. We think 30% plus here in each of the next 2 years. And then you've got YouTube again. That's going to continue to grow at a very nice pace. So at the top line, things look very strong here. Secular drivers remain intact. You got some of those moonshots that are sitting out there for some of those investors kind of thinking of that 3 to 5 year longer term outlook, whether it be Waymo or other assets that they've got within there. So we value it based on about a 25 times earnings, which is typically their longer term average PE multiple. We think at some point, once we kind of get in the clear here, better visibility, I think it starts gravitating and you see that multiple expansion.
Yeah, definitely. At historical lows or near lows as far as valuation goes for that company moving forward. But Mark, when you look at, you mentioned those Mango stocks, and we're talking the AMDs, the Broadcoms, and on Semiconductor, among others. Why do you focus on that specific area, and do you see that kind of helping the tech space turn around?
Well, I think building on the Google play, if you think about where the growth is on their cloud play, they're a smaller utility cloud player. They have a lot of room for growth. They are working very hard at it. They're extremely good at data center utility function, and you need to build them. The building blocks are the semis. So there's a lot of competition in the cloud space to build out the services for SaaS. That's going to pull all the semi stocks, and on top of that, everything related to the industrial sector and the automotive and transportation sector is moving towards more automation, not self-driving. That takes a lot longer, but all the automation features, All the efficiency features are driven both by logic chips that are on board, but also the power semis, which the Mango stocks include. And that's sort of been out of the limelight. That's a very big piece of the automation, if you like, and efficiencies in the industrial sector. A lot of growth potential in that.
Yeah, definitely in that space. And if we get through those supply constraint issues, because the demand is there. Now, Angelo, if you look at a couple of the other names, you like Apple a little bit more than Facebook Meta here at this point. Give us the breakdown on that.
Yeah, so just really quick on Apple. I mean, I think it's going to be a great earnings season overall. I mean, I think they have been better positioned than others in terms of the supply constraints that are out there, rightfully so, because they're just so important to that ecosystem there. But at the end of the day, I mean, they continue to take some massive share within the China market. I am a bit concerned about the consumer right now as far as Apple is concerned. They are the ultimate kind of consumer play, right? 90% of the revenue tied to the consumer. So a little bit concerned on that side of things, especially with some of the issues we've seen out of the China smartphone market here in January, February, and March. But nonetheless, I mean, the share gains there, the fact that we expect them to announce a $100 billion buyback, increase their dividend 7%, capital allocation definitely critical ahead of this earnings season. And then just what they've got in the pipeline here for the rest of this year and into next year, I think looks great for them. I think really quick on the Meta side of things, I think expectations have really kind of been brought down significantly. I think it looks really interesting here in the near term. I'm not necessarily a player on near-term trends here, but when I think about Meta and where they've kind of guided here for the March quarter into the June quarter, I think it looks pretty interesting given where the valuation is.
All right, great look at that tech space. Got to wrap it up there, guys. Thanks for being here. That's going to do it for Trading 360. Stick around, though. Fast Markets up next.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
It's the first full week of April. That brings golfers and patrons to Augusta, Georgia. But for us, Friday, welcome to a tradition unlike any other. No, it's not the Masters. TD Ameritrade Network proudly presents the Friday edition of Fast Market. I'm Kevin Hinks. I'm your host for the next hour. We'll be taking you through. I've got a really good cast of people coming on today to explain some key trades and key ideas to you people. First and foremost, Joe Mazzola, the Director of Trader Education here at TD Ameritrade. And then a special guest today, Mr. John McNichol, a contributor across the TD Ameritrade Network. He used to be on shows with me in the past. He's going to help us out today and fill in the A block. We'll get to that in 1 minute. First, let's look at the four major indices and see where they sit here at 11 o'clock Chicago, 12 o'clock Eastern. The S&P 500 now up 0.25%, 11.5 points at 45.11. The NASDAQ 100 down 0.9%, 80 points to 14,451. The Dow Jones Industrial Average, we'll call it up 0.7%, 249 points to 34,832. And the Russell 2000, we'll call it up 0.1%, $2.90 to 2012 and some change. Now let's bring in the guest that I just mentioned, the Director of Trading at Charles Schwab, Joe Mazzola, and John McNichol, coming to us live just outside Salt Lake City, Utah. Guys, welcome to the show on a Friday. I'm going to make you both a solemn vow. I will not watch the Masters during this show. I promise. I will not be distracted by the leaderboard just off to my right here. I promise you. Guys, Joe Mazzola, welcome to the show. It's a Friday of what I would prefer, or I would describe as a pretty bumpy week for these markets. Lael Brainerd did a number on the markets Monday, Fed minutes on Wednesday, but yet this market seems to be able to take a punch and keep standing, Joe. Now 3 of the 4 major indices in the green.
Kevin, I have to concede to your rosy optimism that you bring to the table every day and just say that, look, the markets are holding up. I mean, you look at kind of where we've come from the March lows. S&Ps are up about 9%. You got the NASDAQ up about 11% from their March lows. And you're seeing these, rise in the face of some adversity, or at least some headwinds that you would think would cause some market pullbacks. Notwithstanding what you're seeing, as you mentioned, from the traditional dove, Brainerd coming out this week and basically saying, hey, inflation has to be tackled. I think the Fed has really done a number this week in terms of getting those governors out there kind of talking down, or what they were hoping to do is kind of talk down the markets a little bit and talk down some of this asset inflation. And I think, the markets have held up fairly well. So I don't know. I think, I guess my question would be whether or not this rally has kind of priced in, the potential for declining economic and earnings activity, but that's something that we're going to see over the next couple of weeks as earnings kind of kick off in earnest.
John McNichol, welcome to the show. Yes, coming to us live from just outside Salt Lake City, Utah. John, we've got an interesting market this week. It's been a roller coaster ride, right? With several, for a week that we didn't have any top tier economic data, the Fed minutes certainly caused a big stir. They were everything we thought they would be, John. They were as hawkish, between that and Lael Brainerd's comments on Monday, this has been about as hawkish of a week as I've seen in quite a while. John, your comments on how you see the market finishing this bumpy week.
Yeah, well, concur what Joe was saying there, and as obviously you, Kevin, as far as things being rocky. It was earlier around the middle of the week where we were setting up for a weekly reversal on a lot of these major market indices. And some still may be setting up that way. But this seems to be a kind of a battle on what's been happening over the near term on trying to work out, more of this bottom in formation. As Joe had mentioned, those lows from March there. The market is still battling back and forth, kind of more in a neutral range there. Still to be decided, but as we go into the end of the week, we are potentially seeing some of those higher lows that after this pullback on the week trying to hold. In fact, this chart kind of illustrates, I kind of call it the battle of the head and shoulders. You can see a higher high followed by a lower high coming into February or January of this year, and then we had the sell-off, and now prices kind of rallied back up, kind of forming another head and shoulders, kind of standing on its head. So it's kind of the battle between the longer term, where we know that there's concerns for inflation and as far as growth, but the market still seeing that there may be some sunshine there as far as with what the Fed is doing. If they are able to slow down some of the inflation, then that could be more of the growth story here. But I agree with Joe is saying, this is probably going to take a few weeks to play out, particularly looking at those highs. Traders want to see those highs be taken out to be more of a continuation of this reversal.
Joe, when I look at the heat map for the S&P 500 in today's trade, I like to divide it by top and left, right, which are all the big high profile names, and then the bottom and the right. And the bottom right today, the side of this heat map is showing fluorescent Kelly green across the board and really taking the leadership today. Now, Joe, we've got a big week coming up next week. We've got CPI, PPI, retail sales. We've got beginning of earnings season with the banks coming out. JP Morgan on Wednesday, then Citi, Wells Fargo, Goldman, and Morgan Stanley on Thursday. Joe, this is going to be a pretty big week coming up here. How important is the end of this week as we look forward to next week, Joe?
I mean, I don't know about the price action, today. I think given the fact that we've recovered from what we saw on Tuesday and Wednesday, I think that's very positive for the week. I think the markets, to be honest with you, I think the markets are kind of setting up for next week expectations the next week. Because when I look at next week, and as you mentioned, what's coming out, I mean, one of the things that we really need to look at, and you mentioned the big bank earnings, I mean, those to me are pretty pivotal at this point. Why? Because net income for the six biggest U.S. banks are expected to be down about 35% from a year earlier. That's a combination of a couple things, right? You had 2021 earnings that were basically off the charts, so the comps are going to be harder.
Right.
You got to understand that the comparables will be harder for 2022. You've got declining investment banking. A lot of that happened in this first quarter when a lot of that activity kind of slowed down in the European markets. Trading revenues have gone down a lot because you're really starting to see kind of, the bonds have had that massive pullback that they saw in the first quarter. So I think a lot of those things, now you add in wage expenses that are hitting some of these banking and financial institutions, and you got to wonder what that's going to look like. So you are starting to see some of the analysts kind of revise those earnings expectations downward a little bit, and that'll be really interesting to see kind of how that plays out over the next couple of weeks, especially in the financial sector. Oh, and the last thing, Kevin, fewer stock buybacks too. So I think that's something to kind of keep an eye on.
John, what Joe was just mentioning about the financials coming out with earnings next week, you would think, right? Your Economics 101 book tells you that higher yields on the 10-year should be a windfall for some of these banks. But yet, they find themselves under pressure going into earnings season, and the outlook is not exactly great going into there. There's a lot of hesitation in some of the financials. That and the fact that these CPI numbers, when they come out, might be video game type numbers in terms of CPI. How do you see next week starting up, John?
Well, Joe also hit on that as well, as far as on the financials, as far as, there's still the growth story. And when you had that market snapshot up with, the Kelly green there, when we look at things relatively speaking, and this is setting up going into next week, those sectors that have been outperforming over the last week and going back over the last month are still looking at the inflationary front when it comes to energy stocks as well as materials, but also defensive, as we've seen outperformance in the staples, healthcare, utilities, even in the real estate area as well. So there's that posturing going into next week, probably anticipating, once again, higher inflation. And obviously looking at the yields here, we're seeing them continuing to push their way higher, which you're right, Kevin, you would expect to see financials get a lift from that, but that's only half the story.
Yeah, right. Because, I mean, I'm sure, Joe, that some of that euphoria or some of that net interest margin is being kind of, wiped away by a flattening yield curve, right? I mean, it's not enough to have higher rates. That is good. Make no mistake, net interest margin is still a good number, but a flattening yield curve will suck away some of that positive from those higher yields. Joe, we've got, let's now pivot and start talking about our first stock of the day, and that is Kroger. Now, Kroger is the largest grocery chain in the country. They own several major brand names. I don't know about the San Francisco area, but around Chicago, it's really Mariano's is the key subsidiary of Kroger that infiltrates our area. They're everywhere out here around the Chicago area. Kroger not only is the largest chain, but they also have a massive investor in Berkshire Hathaway and Warren Buffett. Give us your first take of, like I said, the United States, the U.S.'s largest grocery chain, and a pretty big upgrade today.
Yeah, so they got a really nice upgrade, pushed the price target up. But one other thing, too, is the UN actually today came out and said that when they look at food inflation across the globe, it's soared 13% in March. So, I mean,
crazy.
Kroger's a company that can benefit from that food inflation. I think the real question is, though, at what point does that start to hit some of that elasticity, right? I mean, can consumer wage growth support these steep increases in food prices? Up to this point, they have. But another key metric that I noticed coming on the last couple of weeks is that credit card debt. It's really starting to pick up again in the consumer side. So a lot of the savings that had occurred throughout the payments that we saw, some of the fiscal payments that we saw last year, those are dried up. And so some of these payment spaces are kind of moving into some of this credit card debt. And I think that's something to kind of keep an eye on. I think when the reason that you see companies like Kroger, tend to do okay in this type of environment is because they are staples and people still need a grocery shop regardless of what it is, but they might make some rotations out of some of those choices that they've made in the past. So, I look at a stock like this and I think, especially kind of given the charts, and I'm sure John will point those out in a minute here, it's positioned to do potentially well should that food inflation occur or at least abate and stay within a range.
John, your strength is in technical analysis. You've brought us a chart for Kroger today. Give us your presentation and what you're seeing when you look at a chart on Kroger.
Yeah, well, much like as we've already talked about with the sectors, particularly in staples, getting those lifts as people are looking for some stability there. And as Joe mentioned, people still need to eat, they need to shop. And as we look at the chart, that is reflected in Kroger, particularly since their last earnings when they gapped up. Now, if you look in gold, that represents the longer term channel that's formed over the last few years here. And with the gap today, we are actually in the upper part of that channel. Although the trend is still very strong, as you can see with those rising moving averages, the 50-day and the 200-day. When you see those averages running like railroad tracks, that certainly points to that stronger trend. And with the upgrade from Bank of America, and if we go to the next chart as far as the longer term, you can see as far as where some of that potential is. I believe they have a price target of somewhere closer around 74. If the price action was to stay within this channel, particularly in the upper half, that would project out to that price point towards the end of the year. However, and I know Joe looks at this indicator as well, the RSI is a bit extended. It is in the upper zone, so that could point towards some nearer term overbought conditions. It wouldn't be surprising to see the price kind of pull back and possibly retest that last breakout there, but the trend continues to be strong.
Yeah, John, we have a chart on my Thinkorswim platform of the RSI, and you see the overbought nature of Kroger. Yet, really strong comments from B of A today on how food inflation will actually benefit Kroger, like Joe was mentioning. Joe, what is the trade-off? For our viewers, what is the trade-off? Is it restaurants to supermarkets? Is it higher priced food to more moderately priced food? What's the trade-off? If this economy starts to slow, does that make people transition from restaurants to grocery to cooking at home? Is that what we should be looking for? That favors Kroger, obviously, but
I'm one of those.
Is it more discount that? Go ahead.
No, I think you're right, and I think that it does kind of force the at-home trade, I guess, if you will, as opposed to going out to the restaurants.
Yeah.
Although, look, I mean, we're going to talk about this in a couple moments. In our next segment, we're going to kind of look at travel plans, and at some point, you're right. I mean, there's got to be a trade-off. So if people are traveling and they're going out to restaurants there, but they're not, dining at their own restaurants at home, then that probably does favor Kroger. And I like the way that John looked at this and said, look, it's overbought right now. I mean, or at least some of the indicators point to that, but it doesn't mean that the longer term growth story can't continue. And look, the Fed made a mistake earlier last year by assuming that inflation was transitory, as we're all dealing with right now. There's nothing to suggest that inflation, while it might pull back a bit, is going to subside dramatically over the course of the next, say, 6 to 9 to 12 months. Kroger can benefit from that. So even if you do get a pullback to levels that kind of pull you back into that $65 or $60 level there, you have a chance to where this stock can really find some footing and then maybe take off for a longer term trade.
Yeah, Joe, it's interesting that you mentioned that, because part of B of A's note on Kroger was saying food inflation could last another 6 to 9 months and stay up at those elevated levels. Now, John, one last thing before we get to the trade. I want your comments on this. Warren Buffett owns, currently right now, the last bit of investigation I could do to this, he's got about 61.8 million shares, about 8.3% of Kroger. But he keeps adding. He's adding to his position in Kroger. So what does that do for the overall price of Kroger? This is another one of those companies that has a very high profile investor in Berkshire Hathaway, John.
Yeah, that's right. And I think just part of it is just them being the biggest in their space. And, certainly investors would keep track of what Mr. Buffett does. And, he's into those moat stocks, and Kroger is one of those, multiple brands. Out here in Utah in the Intermountain West, we got at least 2 major brands, Smith's Food and Drug, and we got Fred Meyer, which are huge retail stores out here. And, likewise, these are the companies that are going to be able to stomach some of those higher inflationary concerns. Even though I was looking at the numbers, I think their net profit is like 1.8%. I mean, this is a type of business that there are not high margins. And so grocery stores are going to do every bit they can to scale to be able to squeeze out what profit they have. And in the case of with incomes rising, they feel they can go ahead and pass that on, at least over this next year.
I remember the price action in Kroger when Amazon bought Whole Foods. There was a 2 or 3 day swoon in this stock that was really turned out to be an incredible opportunity to trade this stock. But guys, the trade that I have for this is relatively simple, right? There seems to be a ton of good news right now in Kroger. And that doesn't mean this stock can't back off, because it is in overbought territory. And we don't know. We're not analysts, so we don't know. But if you think that there's a bullish tone around this name, what I've done here, guys, I've gone out to the May 20th expiration. They don't have earnings till June 16th. So they're at the tail end of earnings season. So we won't see their earnings for quite a while. But what I did was just went out to the May 20th, which gives you plenty of time for this to happen. By the way, Kroger, if you notice, low premium name in terms of the options. So I can go all the way out till May 20th, and then sell next Thursday's expiration and do the 65 call calendar for basically $1, right? Which, remember, May expiration, May 20th, gives you 42 days of this happening. Now, when you look at this trade, it's got not a catastrophic upside move. It's only to 65, and the stock is currently north of 61. But Joe Mazzola, when you look at something like this, this isn't a home run trade, but it's certainly one in a low premium name like Kroger that can hit you a couple singles along the way, Joe.
And it fits the narrative of what we were just discussing. It fits the narrative that the stock has rallied pretty hard. It could pull back. You know, there's the potential, kind of given the overbought situation. Gives you an opportunity to let that kind of get in maybe that $60 range, that $58 to $60 range, build some momentum, and then see if it can kind of move up above that as you head into kind of that May expiration. So it gives this trade some time to work out, and you're financing buying that long call by selling that front call against it. It makes a ton of sense if you think that this has longer term potential. But in the near term,
and let's face it, this is not, as far as some trades go, we do some trades that are on the more expensive side in bigger price names. This is a reasonably priced name. This is a reasonable debit for an underlying. That doesn't mean it'll be successful. Matter of fact, make sure you understand what you have at risk on this trade is the debit that you paid, in this case, $1. Now, you can extend duration on those short options and roll them down the page if liquidity allows you to do that. You can extend duration and chip away at that net debit. And when you do that, you also chip away at the break even. But great start to the show, guys. John McNichol, we always appreciate you coming on. I haven't seen you in a while, John. Great to see you. Joe Mazzola will stick around for the rest of the show and hang out with me. I appreciate that, Joe. We'll take our first break of the day. Come back in 2 minutes with Megan Brantley from Likefolio. We're talking travel on a Friday. Take a quick break. Come back in 2 minutes with more Fast Market. See you then.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs in the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait for it.
I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Welcome back to Fast Market, everyone. Kevin Hinks back here for our middle segment of the show. Joe Mazzola, Director of Trader Education at Charles Schwab, has agreed to stick around for the rest of the show. Now I'd like to welcome in Miss Megan Brantley. She is the Vice President of Research at Likefolio.com. And Megan, it just feels good on a Friday when we can talk about travel and traveling. And by the way, Megan, it appears that everyone else in the country is talking about it too, because everything about travel seems to be exploding. You're talking about some of the booking companies like Bookings Holdings and Expedia. What do you have for us today, Megan?
Yeah, so I don't know about you guys, but here in Louisville, it is still technically spring break. So whenever I look out in this parking lot, it's really sad. There are very few cars because everybody is traveling. Everyone is at the beach or in the mountains or on a trip. And I don't think that that is, an isolated event. Whenever we look at our travel data, we see continued strength on a year-over-year basis, just of these, high-level macro trends. So consumer mentions of booking a flight, consumer mentions of booking a hotel, even international travel mentions are continuing to improve and continuing to, start to normalize to those pre-pandemic levels. And I think what's interesting is, the only travel trend that we see that's starting to show some weakness are those taking a road trip mentions, where we're really starting to see those gas prices weigh on consumers whenever they're considering how they're going to travel and where they're going to travel. But overall, whenever we look at these companies, I think that, we're really highlighting Booking and Expedia today. And it's interesting because a lot of times whenever, we come on this show, we have a lean. We say, okay, well, this company might be outperforming this other company. But whenever we look at Booking and Expedia, if we were to calculate the earnings signal today, they're both exactly the same, which is very rare. It's a +7. So for us, that's definitely leaning bullish, but we are starting to see some, just a little bit of slowdown in momentum. And I think that that's, to be expected as consumers, really surged and returned to travel, that rate of growth is starting to slow down. But long term, we are still seeing signs of normalization. We're still seeing signs that the consumer is getting out there and definitely willing to travel and absolutely is traveling.
Yeah, Megan, look, these travel stocks rocketed in 2021. Yeah. I mean, they just had big moves, extremely well. All I think in this setup that 22 would be a return to normalization kind of, in the U.S. and globally. And things have, shifted a little bit. You talked about the rising gas prices. There's other hidden costs too, right? I mean, the rising jet fuel prices are up about 130%. year over year, and that's going to make its way into ticket prices. It's going to make its way into some of these booking prices. So, how does a company like Expedia or Booking, how do they maintain that kind of demand? Because they're not completely inelastic, right? At some point, you would think that companies like them and then some of the hotel companies and travel companies in general, you would start to see some of that enthusiasm wane, would you not?
Yeah, I think that, one of the things that both of these companies have going for them is they both have a very diverse, array of offerings. Whenever you look at something like Expedia, they've got, the traditional booking site under their umbrella, but then they also have names like VRBO or Verbo, I guess that they would call it. We see, those mentioned specifically for that brand underneath Expedia doing really well. I think Expedia also has another brand excelling, which is interesting, is Hotwire in our data. It has some of the highest from a volume perspective and also overall growth perspective of potentially consumers who are starting to seek out those deals. They want to travel, but they want to save some money while they're traveling. So I think that, those are some brands in Expedia's back pocket that can continue to help them, lure consumers in and keep things relatively affordable. On the booking side of things, I think it's interesting because Booking has this international segment, Agoda, I believe, and we're seeing some really strong strength out of that. So as international travel resumes, I think that that's one area of improvement that Booking may be able to, point to. In addition, underneath Booking's umbrella is Open Table. So, as people start returning to restaurants and things, that's another indicator for us of, okay, how comfortable is the consumer? Is inflation really weighing on the consumer? Are they starting to change those purchasing habits? And so far for us, we're not seeing that the consumer is reaching a breaking point quite yet. We have, Open Table mentions underneath Booking's umbrella are up 77% year over year and rising even faster on a quarter over quarter basis. We have mentions of going to a restaurant also rising at a similar clip. So I think that consumers, at least for right now, are definitely still getting out there and they're still traveling and they're still spending. And so we'll just be watching really closely to see if and when that starts to slow down.
Megan, I want to focus on one of your charts. It's the year-over-year percentage change 30-day moving average. And I think this is the screaming trend chart of a reopening U.S. economy. The fact that every bit of travel, is up and taking a road trip is down. That tells you that there's a fundamental shift back to the way life used to be and away from the way we were forced to be. Now, that's what that signals to me. First, I want to know if that signals to Likefolio as well. And second, I want to ask you, Uber has made some news this week talking about you can start to book other things through their app. They've added New York City taxis. They intend to offer more. Have you seen Uber pop up on any of your metrics in terms of travel yet?
It's interesting because we saw that. I think aren't they calling themselves or trying to call themselves the Amazon of travel, of booking? It's interesting because Uber has been outperforming Lyft, at least in our data, because they do have kind of a larger menu of offerings for consumers. Now, so far, we didn't record any enormous spike from the consumer's standpoint. However, you can see that, and Uber knows that the more touch points that you can engage a consumer, the more likely they are to use your platform. So, that's part of the thinking behind Uber Eats and also Uber driving is that, if you have the app open already and you're using it to get you from point A to point B, you're also more likely to order food and really start to build this whole ecosystem. That's a common theme. So I think it makes sense that Uber would want to get into this arena because they're in the business of moving things, and moving people is certainly one of them. And so, this is definitely something we'll watch moving forward, but from our data, we haven't seen it move the needle like super significantly from a consumer side of things.
Yeah, I think
Megan, finally, go ahead, Joe. No, sure, go ahead, Joe.
No, I was just going to say the follow-up point. I think is when you look where the Uber CEO came from, right? I mean, you look at these relationships and this idea that hey, if you can have a one-stop shop for everything, where you keep people engaged at all levels of kind of that vertical integration, then that's a working system. So yeah, I just wanted to add to that. Thank you.
Yeah. No, it makes complete sense.
Yeah, I mean, I think Uber, let's face it, their relationship to this conversation is they're involved in people moving from one place to another, and they've got to keep finding ways to get closer to profitability, right? So that's, I think, Uber's role and why they continue to try to expand their footprint in what they do. But Megan Brantley, always appreciate you coming on a Friday and brightening up Fast Market with your presentation. And the fact that you did travel even made it better. Megan, have a great day. Always a pleasure to have you on.
Yeah, thanks, guys. Enjoy.
All right, Joe, now you brought a trade here, a trade idea, an example trade in Expedia. And, in your notes, Joe, you focused part on, number one, the PE, and number two, the PEG ratio. Now, PEG ratio is a little bit of a higher end usage because it's the PE versus earnings growth. Take a minute, and for our viewers, Joe, explain to them what PEG ratio is so they can look at it when they look at a name.
Yeah, it's basically just as you said, Kevin. It's the PE ratio, right? So the price of the stock versus the earnings. But instead of just looking at it just kind of at that flash number, it also takes into consideration what the expected growth rate is over the next 3 to 5 years for earnings. So how much are you paying relative for growth over the next 3 to 5 years? Anything kind of sub one is considered really, really undervalued, right? When you would look at a stock and it's one or less. When I looked at Expedia, it was right around 1.4. So that you're still talking about a growth company in a space where there's the potential for more and more movement, literally, right? Movement, but also in terms of kind of where you're starting to see these names kind of take off and what we've seen from the stock. I mean, look, the stock's down $35 from its January high. It's pulled back. The forward PE is about 26. So, between that and then looking at that PEG ratio of 1.4, it's not overly expensive, especially when you look at the expected annual growth of about 16%. So when I look at those kind of factors as they look in, or as they factor into the valuation of the stock, I'm looking at something that's kind of mid-range, right? It doesn't look, it's kind of like a Goldilocks where it's not too hot and it's not too cold. And when I see things like that, it's hard for investors to kind of place a bet one way or the other. And what you can do when you look at something like that is, if you've seen some volatility in the stock, kind of given that $35 pullback that we've seen, you can look for kind of time spreads that will allow you to kind of play within a certain range on these names, and while you're waiting for the next event to occur. And that next event for Expedia would be our earnings in May. So if you're looking to say, okay, well, what's a way as a trader where I can kind of position myself for a move up or down while I'm still waiting for that exogenous event, and like I said, that event being earnings on May 2nd, we look at a double calendar as a way to do that.
All right, let's get into that double calendar. I'll throw it up on the screen here. You've got basically the May 20th versus the April 22nd, and you've got the 190 on the call side and the 170 on the put side, Joe. What made you choose this area, and tell us what you're thinking here with this double calendar? I get it, right? If you can't figure out a direction, this gives you an opportunity to be successful in either direction.
Yeah, no, I mean, that's kind of spot on, Kevin. I mean, it's right at the 181, 182 100-day moving average. You got a little bit of support there. RSI on the stock is, as John and I were talking about a little bit earlier when we were looking at Kroger, RSI is 40. So, it's kind of in that middle range also. It's a little bit below what you would consider, outperforming the index, which would be around a 50 or higher. So it's kind of a middle of the road type of trade. And I look at this, and the way I structured it the way I did is, if I can sell that April expiration before earnings come out, right, and take advantage of some of that time decay, that can help give me a little bit more information as we're going into the May expiration on the options that were long. So it's possible that we can sell those 22s and then go ahead again and sell the 29s if we can, get another roll out of that, and then that way kind of decreasing the cost of what it will eventually be a long strangle And then at that point, we can kind of make a decision on whether or not we want to keep that position or not as we're heading into earnings, kind of based upon some of the information that you're going to gather over the next month. Just like we talked about with bank earnings and what we've seen over the last couple of weeks, as you've really started to see analysts kind of start to come out and make some predictions on what those earnings would be, upgrades and downgrades, you're going to start to see that in every one of these sectors, and that'll provide you a little bit more information as you're moving into this trade.
Yeah, as we move to next week and the beginning of first quarter earnings season, the conference calls, the guidance, how they see the U.S. economy going forward is going to be so vital for this name or for stocks in general. I love earnings season because earnings season is a big economy made up of a bunch of individual stories, and each company and how they present their earnings, how they present their outlook for the overall U.S. economy is really gonna, it's really gonna affect the way the stock trades. And this market is bumpy already. So, all right, Joe, we're gonna put on one of these on either side, and we're gonna take our final break of the show. We're gonna go a little early because we got a big discussion coming up in our final segment. We're gonna focus on Google Alphabet, but what we're gonna talk in general is stock splits. You've got Amazon, you've got Google Alphabet, you may have Tesla coming up in the near future. It's a great discussion, and we're gonna go through it. So take a quick 2-minute break, come back with our last segment on Fast Market. See you there.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is a trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to Fast Market, everyone. Kevin Hinks back here with Joe Mazzola for our final segment. Joe Mazzola is the Director of Trader Education at Charles Schwab. He stayed with us the whole show. Nice enough, Joe. I appreciate that. Now, Joe, I wanted to get into our final segment. I wanted to do a kind of a dual discussion here because I want to talk about Google Alphabet, but I also want to talk about stock splits because there's a bunch of them coming up relatively soon. You've got, here's the dates. You've got Amazon on June 3rd. That means it'll start trading on, it does it on Friday, but it starts trading on June 6th. Then you've got Google Alphabet on July 15th. Then that'll start trading the different price on July 18th. But Joe, stock splits are confusing to people, and people get worried about them. And if we can help them ease some of the fears about a stock split and trading options around a stock split, I think we could do a big service to our viewers. Joe, tell me what you think about Some people, it's definitely a corporate action, but some people just call it financial engineering because the value of the company, Joe, doesn't change.
No, you're absolutely right. Basically, you have more shares at a less price. So when you look at the accounting value, it really stays the same. On the option side, it depends on kind of how the split is generated, right? If it's just a normal, 3-to-1, 2-to-1, 10-to-1, whatever it is, stock split, then what you're going to see is the strike price, will adjust to the new strike price. And just like the stock would adjust, down to, let's say it's a 2-to-1 stock split at $100. So now you, instead of having 100 shares at 100, right, you have 200 shares at 50. So the accounting is the same. And then you'll see the strike price adjust down to 50. And instead of having, one call, if you owned one of the $100 calls, now you own two of the $50 calls. So the accounting is the same. Where things get a little bit confusing sometimes is when they start to announce things like stock dividends, and that affects the strike price a little bit. But none of these have mentioned anything like this. These have all been just your kind of traditional run-of-the-mill stock splits. Now, the Tesla one's a little bit different, right? The Tesla one's a little bit different, and we'll kind of see how that plays out if they do actually give out that stock dividend. But for the ones that you mentioned, kind of Amazon and Google, these should be your run-of-the-mill stock splits.
Yeah, it's interesting. In August of 2020, Apple split 4-for-1, right? A much more smaller number than we're seeing from Amazon and from Google Alphabet. Now, that stock went from 540, Joe, to 135. Okay, stay with me, because how about this? If Google splits at 2,700, it will come out at $135, right? 20 for 1. So that $135 number seems to be a little bit interesting. But it's interesting in another way, because clearly people will make the case that, well, this allows a bigger sample size of investors to trade the stock. It adds liquidity because it adds open shares. There's a lot of reasons why people like it. It'll just be a smaller number. It'll be more attractive. Less people can buy a $2,700 stock that can buy a $135 stock. But you have to be careful of exactly what you're happening. Joe, think about this. On February 1st, Google Alphabet announced their stock split. The stock was trading, that closed that day $27.57. Next day, traded $30.42. And now, Joe, is lower than it closed before that day. So there's been a really confusing price action in Google Alphabet. And I think that, go ahead, Joe. I'd like to hear your thoughts, because that's a head scratcher.
No, you're exactly right. I mean, look at what Amazon did, right? Amazon had a 5 or 6% move after that announcement, and it's given a lot of that back. I mean, we talk about the Super 7, right? The Apple, the Microsoft, the Alphabet, Amazon, Tesla, NVIDIA, Facebook, and kind of the performance that you've seen after that. They got those big moves, for those companies that announced the stock splits, and then pulled back as the whole sector pulled back. And that's probably more of an interest rate story, or a Fed tightening story. Sure. They bounced back off those March 14th lows. But yeah, you're right. A lot of that excitement was kind of priced into that front running, that movement, and now that's abated a bit. And I look at it like this: who really benefits, from a stock split? You're right. It does open it up and helps retail a little bit more. But I think when you look at option activity, that benefits quite a bit, because a lot of people don't want to trade a $3,000 strike, but they're happy to trade. Or a $2,700 strike, but they're happy to trade a $135 strike. So it does open up a lot more option activity. I think you'll see tighter bid-ask spread. So I think it does help, the retail clients out just in general.
Yeah, think about it. If you have one vertical spread on, when this splits, you've got 20 on at the lower numbers, right? So yeah, there's a lot of things that could change, and people have to understand the change in delta. There could be gamma changes and things like that. So you've really got to pay attention to your Greeks. Now, I've traded from 20 years in the GE pit during the era of Jack Welch. I traded a number of stock splits over the years. Now, the new CEO has since erased those stock splits with GE, for the record, full disclosure. But we traded a lot of stock splits over the years in GE, and it certainly is a fun, because volumes explode and and the stocks can move because they look differently, Joe. But I looked at a trade here in Google Alphabet. And by the way, a quick note on Google Alphabet. GOOG or GOOGL, right? It trades two. What's the difference? GOOG has no voting rights. It's really just as simple as that. They created a different class of stock with no voting rights. So if you're trading the GOOG, which is what we're trading here today, that is a different class that doesn't have voting rights. Okay, that quick tidbit there. Now let's move on. Now, if you look where this stock traded during this time, it traded all the way up to 30.42. It's come back now. It's spent a little time just below 2,900. Now it's come back down to about 2,700. If you believe, and I'm not an analyst, I'm not recommending anything, if you believe that over time, Google could start to move back up towards higher numbers, whatever they are. What I've done here, Joe, is a 1 week. So it's the April 22nd to next week, April 14th, 2,800 calendar spread. Now, one thing about this that you'll have to know, these are not cheap, right? A 1 week calendar spread is about $11.50. If you were to expand that out to 2 weeks, go April 29th to April 14th, as you can see, it goes exponential. Why is that? Well, you have to be careful. April 29th, their earnings are the April 26th. So you've got to be real careful about trading into the earnings week. Those premiums, as you can see by the new number, explode in that earnings event week. So if you want to stay ahead of that, you can do the April 22, and you can see it's about a third of what the next week is because of that spike in implied volatility into the earnings event, Joe. So if you keep the calendar spread, you've got nice levels of theta, daily decay. You've got a delta move on the upside, and you're not just naked long options, right? You are collecting theta on a daily basis. Joe, give us your thoughts on trading calendar spreads into stock splits.
Well, we've been trading calendars all day, right? So evidently,
why stop now?
When we're kind of, I mean, look, when we're looking at any type of event risk or anything, whether it's earnings or a split, where there is, like I said, some exogenous factor that's going to cause that one that 1 month or that one leg of the spread to have a higher implied volatility than the other, what you're trying to do is you're trying to capture that, right? And you're trying to capture some of that time decay to fund the other side and give you the ability to roll. So, if your thought is that this stock is going to stay within a range, because, calendar trades really are range-bound trades, right? What they want to do is they want to slowly move towards a certain strike. And as you can see here, where the peak of that break even is, or excuse me, the peak of that profit and loss graph is, that's where you want the stock to go, and you kind of want it slowly to go there. Calendars work really well in that type of environment. Where they don't work really well is if you get a huge move either way that kind of takes you outside of those break evens. So if the thought is it's going to have a slow grind, then this trade should set up pretty nicely.
Yeah, as we get closer to April 26th and the earnings event, we'll certainly looking at the calendar spread that sells that event week and trading that, because think about it. If you just did on the short side, if you went into that April 29th and then did the next week out, right, the May 6th, now look at, now you're only trading, now you've got one several weeks out for only $9. Why? Well, because that earnings event week is a bigger implied volatility. And this time, rather than buy it, you're selling it. Now, it may be a little early on the calendar to do that spread yet, because that implied volatility into the event could be expanding even more. But that's another whole show that we'll do, and more lessons on stock splits, earnings events, and their relationship with calendar spreads. But we have a lot of fun doing this. We have a lot of fun looking at the different scenarios, because as you get more proficient in these, as you understand what makes options trade-offs and what makes premiums go big, go small, go medium, That's what your IQ, your options IQ keeps rallying. Joe Mazzola, Director of Trader Education for Charles Schwab. Thank you so much for coming on the show, as always. We always appreciate you having on a Friday, and you did extra work today, Joe. We appreciate it. All right. For all of us here at the TD Ameritrade Network, have a great day and a great afternoon. Have fun with the Masters. Next Gen Investing is coming up next with Alex Crawford. Have a great day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on TDAmeritrade.com.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the Watch List at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Happy Friday, good afternoon, and welcome to Next Gen Investing. I'm Alex Coffey alongside my co-host Jenny Horn. Jenny, it feels like a Friday.
It sure does. I feel like there is serious Friday energy in our office and what has been a pretty volatile week as we have seen now markets recovering a little bit here, Alex, in the green. Maybe my post-vacation rut in the market is coming to an end, but we are pacing for a losing week as investors have grappled with a more hawkish Fed.
Yeah, no doubt about it. The Nasdaq's been weak all day, continues to be weak, but well off the lows. It's been a choppy, kind of back and forth tug-of-war style trading session. So we'll see where things shape up. But closing out the week here, maybe on a little bit more of a positive note if it does hold as it is right now. But Jenny, there's tons going on underneath the surface.
Yes, choppiness even in this equity market as we are seeing movement all over the place today. Energy higher, banks higher, but then we're seeing, of course, a mix of lowers. We will get into all of the different movers. We'll go through our upvote and downvote segment. Following that, we will chart and trade our upvotes. Our FOMO discussion today will be focused on NVIDIA as Truist lowered its expectations on the semiconductor, several names within that space. Then we will preview Bed Bath & Beyond earnings ahead of their report next week. That will be on Wednesday. And last but not least, we will look at designer brands announcing updated objectives for its business during its investor day, and some positivity there, I think.
Yeah, no doubt about it. Looking forward to the show. Let's kick things off with upvote, downvote. Jenny, a good list of movers here. We're going to try to narrow it down.
Yeah, so our first name today is UPS, seeing two different pieces of analyst notes. Both, I would say, not fairly positive. UPS is down about 11% so far this year, but outperforming FedEx, who I'd say is its closest competitor, who shed about 21% year to date. But B of A downgraded UPS to neutral from buy with a $204 price target. And this was part of a broader note where they actually downgraded 9 of the 28 stocks in their transportation coverage. This analyst sees deteriorating demand and rapidly falling freight rates, said freight market signals have increasingly softened, and he added that the firm's truck capacity indicator, which measures the ability for shippers to find capacity, jumped to its highest level since June of 2020. Now, additionally, JP Morgan lowered UPS's price target to $229 a share from $262 with an overweight rating, and also used the same word as the previous analyst, which I thought was ironic, saying that truckload market conditions rapidly deteriorated. So if you could gather one thing from the analyst community today, Alex, it is deterioration in this space, which is nerve-wracking, clearly, as shipments are how consumers get their goods. Shipping is really the backbone of a lot of the economy.
Yeah, I think, well, first off, I'm going to say downvote here today. The stock, though, is reacting negatively to this news. Obviously, you have two analysts both saying a very similar message. But you look at the case of the JP Morgan analysts, they still have overweight. They just moved their price target down. So, again, this sounds a lot more bearish than the actual opinion that they have, given that they're saying that they're overweight this stock. But I think your point about the broader macro read-through, if this is ultimately true, it's not a good story to tell if you're worried about an economic slowdown or recession, as oftentimes transportation leads everything else, as first the goods have to move.
Exactly. And this is actually a nice transition into our next name, which follows this transportation story, as Walmart has announced expanding the pay for its fleet of roughly 12,000 truck drivers. And they said that they will raise wages to as much as $110,000 a year for the first year. Now, Walmart quoted data that showed the average truck driver salary currently stands at roughly $56,000. So this is about double that. Now, two Walmart executives said their transportation team will continue these forces behind expansion, which again just shows, I think, really the need for transportation and really just the demand that has surged in this space. Now, it also launched the Private Fleet Development Program, which is a 12-week training program that will help truck drivers get their commercial driver's licenses. And I didn't know this, Alex. Fun fact, these commercial driver's licenses can cost as much as $5,000. So this is a really great way for someone who's, say, unemployed or looking for just, a decent salary, my goodness, to get into this space. So I actually think this serves a greater good, really, because right now we know that times are tight with everything being so expensive.
trucking has always been near and dear to my heart. Is like my family has always been associated within this business, not Walmart or freight, but it's always been the family business is tied to trucking. You'd be surprised how much money is in that for a driver, but it's hard work, a lot of time away from the family, so it makes sense. It's not as easy or as desired for some as sitting behind a desk and watching a computer all day. So it's certainly well-earned money, but you can see there's a ton of demand for more drivers and not necessarily a huge supply of them. So this is classic, economics 101, low supply, high demand. It's going to move those wages up. I'm going to say upvote today for Walmart, though, not because of that story, because it has a nice move as of late over the last few months as it's soaring towards highs with the overall market still remaining quite choppy.
Yeah, Walmart has done a lot of good things in the last several months. I mean, they said on their last earnings call they were committed to maintaining low prices, which they're one of really the only grocery store chains that has said that, as Kroger has promised to raise prices, which the street likes. But as a consumer, you naturally tend to favor the more Walmart-esque narrative, keeping prices low. But now our next name today is Citigroup, sort of sticking with the broader economic theme today, Alex. Citigroup closed at a 17-month low on Thursday, as we have seen weakness hit the big banks pretty substantially, but higher today actually, and UBS trimmed its price target on Citigroup to 53 from 68 with a neutral rating. But why this name is on our radar, I think more importantly, is that it is expected to report its first quarter earnings next Thursday before the market opens. And earnings expectations for the major U.S. banks have been significantly dialed back amid, of course, geopolitical tensions as we've seen Russian sanctions weigh on these companies. Banks have been hit by their slowest quarter also of IPOs since 2016, plus the economic slowdown, plus the war in Ukraine. I mean, a lot of these issues, I think, that investors will be watching to see how it impacted these banks' first quarter, which will sort of start off next week, the unofficial start to earnings season again.
Yeah, I would say official start to earnings season, as the big banks typically are kind of that kickoff for the earnings season. Looking forward to it, I think a lot of focus is rightly on the big banks. But, post-great financial crisis and their role that they played in that, there's been scrutiny to some extent on them, more so than maybe some of their regional peers. I'm going to be watching the regional banks as well. We're just so close to it. I know some, it's just an event that's on the calendar. But for many, it's added volatility. That added uncertainty is enough for them to take a pause and at least wait till we're a little bit closer. I'm going to take that approach today and say downvote.
Yeah, earnings season is like the Super Bowl for me, so we will hold off on a lot of these earnings movers that will report next week, as there will be a ton to get through next week. Now, our last name today is Target. Gordon Haskett upgraded Target to buy from hold with a price target raised to $300 a share from $255, which implies roughly a 30% upside. They said traffic trends in February and March have been remarkably consistent at Target, with the later spring and Easter shift still on the horizon. This analyst sees these trends could actually inflect higher in the next coming weeks. He also expects multiple appreciation for the shares as the market gains more confidence in Target with the model in a post-pandemic world. He says currently sentiment is a little bit too negative actually on Target. But I have to say, given its returns this year, up about 1%, year to date, up 11% so far this week. It still, to me, seems like a bright spot in these markets. Maybe not as bright as this analyst would have hoped, but it's definitely been a consistent name over the last 2 years, and consistency is something that has been hard to come by this year, Alex.
Well said. We're going to say upvote. We're going to talk some Walmart and Target, kind of the oft grouped together names, but I think that there's interesting kind of discrepancies between the two companies, Jenny. I think an argument could be made that Walmart may be more of a staple, Target more of a discretionary, although it's almost as if you can't talk about one without the other. But I am going to say upvote, adding to our list with Walmart, Target.
The Amazon challengers, I'd say, that's probably the thing they have the most in common, is that they both have done a pretty good job wading the waters of Amazon. So props to them. But to tell us more on both Walmart and Target is Ben Lichtenstein, the host of Futures. Ben, we will start things off with Walmart. And I feel like there is a lot of, I'd say, speculation on this company. People are always criticizing Walmart, but I have to say that the shift they've undergone over the last few years, I've walked into Walmart and it almost feels like a different place But forget that, their e-commerce is actually incredible. So really their turnaround story has been one that's been fascinating to watch, and we're seeing that reflected in the share price now.
Yeah, I'd have to agree with you, Jenny. I think throughout the pandemic and as the dust settles from, one of the things for me that was most really compelling and kind of eyebrow raising was their ability to transition and the strength they'd seen in terms of digital sales. Now, we've seen some of that in terms of reflection of price activity as well, real strong stock relative to the broader market. This week, we've been talking a lot about auction market theory, the concepts and ideas associated with. I've been trying to get you guys to look at price through the lens of and sort of be able to identify those two phases, horizontal and vertical. Walmart's in a big vertical phase right now, breaking out. So we're going to get to talk a little bit today about what to expect in a high conviction phase and what to look for a little bit next week and in the months to come.
Talk to me a little bit about Target, Ben. I'm looking at this one, and I'm trying to think of it through the lens you're describing. I can't see. Is this horizontal or is this vertical, or is it a vertical within a horizontal? Help me make some sense of this.
Unfortunately, Alex, sometimes it's more well-defined than others, and we'll talk about how Walmart's a lot more well-defined than what we're seeing in terms of Target. It has been a bit of a laggard, as you guys mentioned, and Jenny, I was just looking, Target up to year-to-date 1%, but Walmart up something like 9%. So, I mean, a major shift there. But what I'm going to talk about today is, do we have the potential to see Target start to play catch-up? You talked about the analysts talking about how the market's been basically negative on Target for the most part, multiple appreciations expected for the shares. So, I mean, there is a potential here if Walmart continues and if Walmart's a better reflection of what to expect, again, in the weeks and months to come, well, there could be some upside potential here for Target if it's going to play catch-up.
And perhaps it's what Alex just said, that maybe Walmart is seen more as that staple, the more need to go to store, whereas Target, I just know personally, I spend way too much money every time I walk in, and it is not the economy for that right now. But Ben, we'll be sticking with you coming up next, hearing more on the technicals in both Walmart and Target. Alex and I will also be sticking around. More Next Gen Investing will be coming up next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the Watch List at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Welcome back. I'm Alex Coffey alongside Jenny Horn. You're watching Next Gen Investing. We're also joined by the host of Futures, Mr. Ben Lichtenstein, to walk through our upvotes. We've got Walmart and Target. Big box retail, massive stores. Walmart, though, unless I'm missing something, I don't think they really have presence in big urban areas. They're actually more suburban, maybe even rural, where Target is really, I think, focused on this urban brand. There's a lot of little kind of mini targets around Chicago. So I know we're oftentimes prisoners of our own situation. But that's my assessment of Target, what they're targeting, and what Walmart is focused on.
Okay, and they just opened that Target by us. That's like a mini Target. I had never been to a store like that before, and it's great because you can't get like overwhelmed because it's Target, but like a third of a Target. But Walmart, yeah, you don't really see those in the city, but I do have to say that going out of the city, they're pretty much everywhere, and they're massive, and the parking lots are always packed. And Ben, we're seeing shares now just around highs, so it's been a while actually since I could say that, as we have seen things just trend lower in this market. But Walmart has been a bit of an outlier, probably due to its low-cost offerings. But from a technical standpoint, what do you see here? Because again, I've been used to a bullish market. Things have changed a little bit, but Walmart nearly at highs.
Yeah, it hasn't changed much for Walmart, that's for sure. A well-defined trend environment to the upside, and it continues higher here as we've seen strength. Again, continuation of the bid. Now, take a look here at the chart here. First and foremost, the hourly time frame, the run-up we've seen, because while throughout the month of March there was strength in the broader market, again, it's really started to kind of lose some of that momentum to the upside. But as you mentioned, Walmart has yet to do so. Continued bid activity from 141, we're talking towards the end of the month of March. A strong run up here all the way up to $158.41 as of recent now. Wanted to kind of zoom out a little bit from this hourly time frame and move away from this most recent run up and take a look at the daily time frame, because this move that we've seen, again, off the March lows, Feb lows, has been significant, but it's only a part of this bigger move to the upside, as you can see. And I went ahead, as we've done throughout the week, kind of drawing these areas of consolidation, and you can see again the migration of value to the upside. But these are value areas, consolidation, horizontal development, where it's kind of limited in terms of directional conviction. You can see you test the upper extreme a couple times, test the lower extreme, but look what's been playing out in Walmart as of recent. As we just kind of take a look at the last few days, you can see a really strong breakout, a vertical type trend here, a vertical type move here in direction of the trend to the upside. So at this point, we're looking for follow through, directional conviction, energy, good volume, participation, and a lot of enthusiasm, a lot of talk, for example. And we want this to take notice. The bulls do, at least. Want this one to attract some attention. You want to see follow through at this point. That's going to come in the form of higher highs and higher lows. And ultimately, as we've seen in the past, eventually we'll find a stopping price. And what the bulls want to see is a new area of value forming at a higher level. So taking a quick look at the daily time frame in terms of where things stand, you can see, again, a good look at that breakout. You can see this horizontal phase that we've been in, basically hovering around 145, and you can see the conviction to the upside. Now, I also talk about how you have the upper extreme and the lower extreme, which are really important, but then you also have the middle. And notice how Walmart, again, end of February, kind of tested that lower extreme, failed to get down below 130. As you see energy and directional conviction through the middle of this range, which again has been established, we'll call it 129, 130, all the way up into this 153 level. As you build energy through 145, it favors a retest to the upper extreme, and this being a trend environment to the upside, that favors a breakout to the upside above that upper extreme. We always talk about continuation of trend, or the trend being your friend. In this instance, it has been.
Yeah, I mean, Ben, it has been a while since we've seen a stock in that consistent of a green candle and an uptrend. We've been looking at that stair-stepping down pattern all week, so it's a Good Friday conversation to look at that stair-step up for once. And Alex, when we're looking at trading this name, Ben highlighted, I thought, a really key area. He pointed out that it's not necessarily always about the upper extremes, lower extremes. Sometimes it's just finding that sort of middle range here, especially with the stock just nearing all-time highs.
Another thing Ben's really hammered into us throughout the week is this idea of horizontal and vertical phases. And so if the stocks were to continue in a vertical phase, that would be, of course, bullish for Walmart at this case. But if it were to turn horizontal, consolidate, that would be somewhat neutral. So I tried to combine those two together and create a neutral to bullish standpoint. So in two of the situations that are possible, we could possibly be profitable. And so went out to the May expiration. Of course, there's not a ton of volatility in Walmart as it's a consumer staple name. You're actually seeing volatility basically in line with the overall market, which is a little bit uncommon given that individual companies have more going on than the overall market that seeks to diversify some of that company-to-company risk. And so what I looked at was selling a put vertical in May, the 155, 150 for about $1.60. And so It's a $5 wide spread for $1.60. That means we have $340 in risk, and that, of course, takes place if the stock were to decline through 150. But if it stays above 155, be that 155.01 or 175, it really doesn't matter. We can make $1.60, which is $160, and that's represented, of course, here on our risk profile. If it falls in between, we do have penny for penny risk down to 150, with our break even being at 153.40 at expiration, Jenny.
So neutral to bullish trade, and as you pointed out, some of the price levels sort of staying at that upper echelon of the trend or the range that we've seen in Walmart that Ben highlighted. But Ben, next we have Target, very often closely compared to Walmart, but a tale of two different retailers here, I think, because Target has not seen the same strength consistently as Walmart. Target is up today about 2%, but not really the same chart. So I'm curious about your verticals, your horizontals here in Target.
Yeah, a tale of two different retailers and a tale of two different charts in many ways as well. Target exhibiting a lot less enthusiasm to the upside than we've seen as far as Walmart, and the chart really says it all. While if you're taking a look at the hourly time frame, you're going to see almost an identical pattern in terms of a bit of a breakout as we run up and through the upper levels that we saw back at the end of February, beginning of March, up around 232. But you can also see how over the last 3 hours or so, we've kind of lost some of that enthusiasm, that directional conviction follow through. Again, what we were talking about in terms of Walmart as far as that real participation to the upside, the energy, and again, follow through. But take a look here as we move away from the hourly time frame and just looking at this most recent run up. Here it is as we zoomed in on this 182 up to the 230 and the breakout. You can see that we're really right back to these levels here that we saw beginning of January. Still some hurdles to get up above, while Walmart is just rocketing to the upside. You can see Target is just kind of grinding relative to. Now, I also wanted to move away from the bigger picture hourly look and the move we've seen basically throughout this year, beginning in December, beginning of January, and some of the price decay we saw down to 182, and how we're really just kind of trying to claw our way back. Take a look at the weekly time frame, because remember, we were talking about Walmart before the break, and we mentioned how, well, if Walmart's a bit of a precursor in terms of what we could see from Target, well, this is what I'm looking at here. You've got a well-defined upper extreme 268. You've got the most recent lows that we just came off of and looked at, 183-ish, we'll call it 180, just to find a nice round number. I like to think of this as kind of like an area, again, in itself. I mentioned, again, with Walmart, as we built momentum through the middle of the range that we had been trading in, you see directional conviction come into play. You get that momentum follow through, opens up a door for a retest of the upper extreme. This favors, in many ways, the possibility thereof. If we see continued strength in Walmart, keep an eye on the 240, 245 area, energy, directional conviction through the middle of this range. Favors a test of the upper extreme, and if Walmart were to continue higher, if these two can track each other a little bit more closely than they have been, well, we could see some nice run up here, or a nice run up in Target as well. It's going to be interesting to watch over the next couple weeks.
Ben, I love that you bring the optimism on this very dreary Friday here in Chicago. Thank you, as always, for all of your insights. That is Ben Lichtenstein, the host of Futures. And Alex, when we're looking at Target, it is a different chart, no doubt. Has seen strength this year relative to the overall market, but Ben highlighted that 240, 245 level. And perhaps actually when trading this name, it could be an advantage that the stock isn't right at all-time highs.
I think that's the logic I was following with the trade illustration that we're going to look at, which is more of, is Walmart showing us what may happen in Target? Considering that it's come down pretty tremendously from that 268 mark that we set as a high water mark in December. So if we retest that area, we really have a lot of activity just below 260. And so what I've looked at here was the 240, 250 call vertical for about $3.50. And so the idea being that we wouldn't need, of course, some movement to take place. But in this particular case, as long as we do get a bounce, Ben had talked about 240, 245, and of course on to 260, 268 as being maybe some areas that we run into some hurdles along the way. We do have a break even that's above 240. So if we do this for $3.50, like I was looking at, the break even at expiration, Jenny, is 243.50, but we can make all the way up to 650. So you almost have a 2-to-1 reward to risk ratio as opposed to the other way around. And so that explains maybe why we need a $10 rally to break even. But if you do really get a sustained up move over the next month, and it does breach 250 to the upside, this can expand and we can make profits of $650. On the chart for illustration, this goes back to around October or so. So let's say it's the last 6 months. This yellow line represents the break even, which is where we do run into a little bit of activity. And then, of course, the green line, our max profit zone, where we run into the next area of activity. And so if you do see a continued up move, as long as it gets through that yellow line and hangs out around that, that would be favorable for this trade.
Another thing to consider in both of these names is they don't report earnings for the next month or so, as Walmart, I believe, is due sort of in the middle of May, Target at the end of May. So in terms of volatility, those events are sort of further away, considering we were talking about earnings coming right up. Those names have a little bit more time. But that does it for this segment. Coming up next, not to say we're going to be negative, but the story in NVIDIA isn't so positive as maybe Walmart and Target today. Shares down over 3%. We'll dive more into that move coming up next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Time for FOMO. Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, we're talking some NVIDIA, and for various reasons, this is considered one of the favorites among the retail investing community. First reason, it's done pretty darn well over the last decade or so in terms of stock price performance, but I would also add that it trades with some healthy volatility while also a very liquid name in the sense that the options markets are fairly tight in terms of bid-ask spread. You don't necessarily have a low volume days in NVIDIA relative to other names within the equity investing world. So it's popular in terms of activity. It trades with some volatility. And over the last few years, it's generally moved higher. I think that's all recipes for why this has been such a favorite amongst retail investors.
I mean, absolutely. I think in 2021, this name could do almost no wrong. It was like they'd have earnings or investor days, and it was just like the street would applaud everything they did. Now, sentiment has since shifted a little bit, as a lot of these growth names can't really seem to catch a break this year. But it's a good point, Alex. Its total addressable market is massive, and that's because it has its hand in so many important areas of tech. It's involved in video games, games, automotive tech, AI, and data centers. And let us not forget the metaverse, which I was actually reading a really interesting report that an analyst liked NVIDIA's entry into the metaverse better than actually Meta, saying they just have more experience in this area, which I thought was actually a fairly good point. But the news we got today was that a Truist analyst warned against the semiconductor rally, which, to interject, I would say it's interesting to call it a semiconductor rally, being that NVIDIA has shed about 20% this year. But they said that they've seen a sharp shift in demand that signals from computer to consumer and communication OEMs just very negative sentiment. They did mention this outlook, though, specifically pertains to the second quarter, but demand through the second half of the year remains strong. So this analyst adjusted its price target for several semiconductor stocks, including AMD and Intel, as well as NVIDIA. But NVIDIA was actually the only buy rating of the group, although this analyst did lower his price target to $298 from $347, which was still 23% upside roughly to the stock's closing price on Thursday. Now, this analyst prefers other semis like NXP, Analog, and ON Semi as more what he said were reliable options. But NVIDIA has still, I think, pleased investors so far this year. Their 2022 Investor Day was met with very high praise. They actually announced the goal of becoming the first semiconductor to be a $1 trillion company. So that was received very positively. But again, like the growth sell-off in a lot of these names has been pretty unrelenting. And I also have to say, Alex, the important thing here is performance. You know, you can say we're going to be a $1 trillion company, but it's sort of like put your money where your mouth is. You can make these targets that are huge, that please the street. But I think a lot of people now would like to see the stock price catch up with those lofty goals.
Yeah, and can we pull up the platform real quick and just take a look at it? Because I have a 5-year chart of NVIDIA pulled up here on the platform, and I think that this may put what you're describing as a vicious sell-off into context for the time, because it has been, and it's certainly gone down tremendously. It went from $346 down to below and almost $200. It's currently sitting at $230. So if you just look at it from high to where we're at now, we're down over $110 for a $340 stock. It's almost a third of its value. Let's call it 30%. Yet we started 5 years ago, of course, this is all split adjusted, below $25. So it's gone essentially 10x, and it's also 30% off the highs. So it just all comes down to entry point. It all comes down to time and perspective, because this stock has both been a massive outperformer to the upside and also kind of a pig to start this year in terms of how far it's come down. And so I would just put it all into context. There's a reason there's such a flock of activity into this name always, and it's because of this volatility.
Absolutely, and I would say, not to be negative, but with 22.7 times its sales multiple, NVIDIA does also face some substantial downside if we continue to see things sell off in the broader market. So, I mean, that is just the realistic thing here, is that you could look at this chart and say it still has room to move lower. Of course, it could recover, as we cannot predict the future, but you look at that chart and I think that things could still correct.
Yeah, and how I would describe it is that there's lofty expectations for this company. There may not be the wiggle room for lack of execution. There's so much optimism priced in, even when you look at this particular stock and it might be down, let's say 30%, just to use kind of some rough math from its all-time high. It's still lofty expectations, still not a lot of room for misexecution. And for you're talking about the company talking about being a $1 trillion company, well, it's got a long ways to go to get back to where it was, where it still fell short of that mark. So there's certainly room in both directions for some volatility. But I think in general, the fear of missing out here is not for some type of retracement of this last 3, 4, 5 year rally, but rather maybe a retest of that 300 mark or even beyond. And so I traded it, or look at a trade illustration, I should say, with that in mind, Jenny, which is that the optimism and the fear in terms of where you might miss here on this one, I think is an outperformance to the upside, not the other way around. And so, of course, we don't have to worry about earnings for a while for NVIDIA, as it's kind of a late reporter in terms of where it's slotted in the earnings season. But we went out to May nonetheless to get a little bit of duration here. And I set up what's referred to as a call condor. Another way to describe this would be that it consists of both kinds of call spreads. So we're both buying a call vertical and we're selling a call vertical, just using 4 different strikes all within the same expiration. And the way that we've set this up, we're buying the 232.40. That's a $10 wide call debit spread that we're buying. And then we're selling quite a bit out of the money $5 wide call credit spread against that to reduce the overall debit for the whole package down to $4. And so simple math here, you just add that 4 to the 230, that gets our break even at 234, is that's where the meat of this particular trade is, and that's where the break even is at 234. With this particular trade, because we're doing it for a part of this trade can expand to $10. That's our max possible gain would be 600. Because that 600 is greater than our risk to the upside, we have no upside risk other than we would give back part of those gains and lock in a $100 gain if it goes all the way through 270. But if it stops between 240 and 265 at expiration, you'd have both that debit spread fully in the money, which is best case scenario, and the credit spread fully out of the money, which is best case scenario. And that's where we capture the max profit of 600. So where both of those roll off in the way that we'd want it to. And of course, that of course is a $25 range, which is maybe asking for a lot when it comes to a name like NVIDIA that moves around so much, but it's still about a 10% kind of profit window in terms of the stock price where we're max profitable. So I think it's interesting. Of course, this is a bullish strategy though, Jenny. So for someone who has more of a bearish outlook, probably wouldn't want to implement this style strategy.
Yeah, that's a good point. And I also think it's important to point out that you mentioned this is a late reporter in terms of earnings, but we could also just see some added volatility in this names with earnings starting next week, as a lot of times earnings just generally shake up the market. We could see things sort of shift. So this trade, being as long-term as it is, going out until about May 20th, does encapsulate some of that volatility we could see starting next week, which I'm very excited about, as I'm sure you can tell.
Yeah, well, I think that's a really, really good point and kind of thought-provoking, because it's like that added duration gives us more time to be right, but it also gives us more time to be wrong. And so it works both ways, but with the longer duration, it's not going to be quite as binary. If this was a trade that expired today or expired next Friday, it's either, profitable or it's not, and you find out very quickly, and the option prices can move very quickly. If we pull up the risk profile real quick, just one more time before we close this one out, Jenny, is this purple line that you see running through the teal risk profile that represents expiration. That's how this trade's going to perform basically today in the near term. You can see it's a lot more flat. It's slower moving. Even if you saw a massive move, the theoretical numbers are saying somewhere like $150 if this was up to 270, and it's about $200 if it was down to 205. And so it's not going to move quite as viciously in the near term, but that doesn't mean that ultimately it doesn't work towards this risk profile as time goes on. And I'll show that real quick here too. As you can see, as I increase the time, and I'm just slowly kind of pushing this, you can see this purple line becomes more and more like that teal line.
Yeah, that's a really good thing to point out. And I also think it's important to keep in mind we're seeing shares lower today. You mentioned, of course, the downside risk and the upside risk to earnings. That is why we always hammer home the point of being risk defined, or at least assessing your risk before you go into every trade. But that does it for this FOMO segment today. Now, coming up next, we will be previewing Bed Bath & Beyond ahead of earnings next Wednesday, a name that has grabbed a ton of attention, sort of a meme stock. We'll dive into its recent price activity coming up next.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watch List live from the New York Stock Exchange.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim Mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, we're going to talk some Bed Bath & Beyond. Probably one of the most confusing stock tickers because I always get it mixed up with Best Buy, but this is triple B and then a Y.
And Bath & Body Works, the name of it throws me off. Yeah, this is a confusing one, but definitely its own company, and it has had a very turbulent quarter, to say the very least. Now, they report their fourth quarter earnings Wednesday before the market opens, so we have that earnings event coming up, but we do know that shares more than doubled in the month of March after hitting an 18th-month low at the end of February. And a lot of this is attributed to, I would say, some meme stock interest, as this has been pulled into that basket of Wall Street Bet's favorite stocks. But the CEO has also been leading a turnaround plan in Bed Bath & Beyond aimed at rebounding from 3 consecutive years of lower sales. Now, the plan is to refresh its most successful stores, close down its failing ones, and boost its e-commerce presence while also expanding its private label offerings. It also recently gained the attention of Ryan Cohen, who's the former founder of Chewy and the chairman of GameStop, who GameStop is also undergoing, I'd say, its own turnaround plan, really led by Ryan Cohen. But Cohen disclosed a near 10% stake in Bed Bath & Beyond last month through RC Ventures. And Bed Bath & Beyond then appointed 3 directors from RC Ventures to its board of independent directors. So we're seeing a lot of turnaround in this company. Prior to that, they hired the former COO at Stitch Fix. So they are trying here, I think, to really rebrand and rethink their strategy. But this is a company that has consistently missed on earnings. They missed expectations back in the third quarter and disappointed the street by announcing a lack of inventory, which is never what you want to hear, clearly. And we saw this it caused the company, they estimated, roughly $100 million, which forced it to cut its guidance for the full year. Now, what we're seeing ahead of this report is that the analysts are expecting EBITDA to fall 45% year over year and EPS to plunge 71%. And what I want to point out here is this would actually be the high end of the company's previous guidance. So that would be almost best case scenario. Now, they could always blow it out of the park. You know, we'll have to wait and see. But right now, expectations are very low for this company ahead of their most recent report. Now, on the positive side, their loyalty program, they say, is doing very well. But growth at Bye Bye Baby has also been a very big bright spot in this company. Now, that is a store, Alex, as much as I love to talk retail, that is a store I do not frequent. But Bed Bath & Beyond was one, I think, that really felt the Amazon effect. They have sort of, I would say, going back to school home goods products, but it was once like a going to college staple because you'd load up at Bed Bath & Beyond, and now you hardly see the stores anywhere.
Yeah, it's really funny you say that because that's like exactly what I did. I think even before I moved into like my first post-college apartment, like went there with the mom, had her pay for what was in the shopping cart, but I got some of the essentials that, of course, as a young man, I didn't know what to get, or at least that's the story I told, to not have to pay for some of the stuff. But one of the things you said, too, that I think is quite interesting is that you tied this to the meme stocks. And I wanted to illustrate that point a little bit further. If we could pull up the platform, I made an overlay, a comparison study on Thinkorswim here of GameStop. So that is represented by kind of that purplish violet color that we see, maybe even pink on our screen. And yeah, it's not a perfect one-to-one correlation, but you can see the pops in GameStop also were kind of accompanied by pops in Bed Bath & Beyond, and also the subsequent falls that took place after the fact. Even the one that we're seeing most recently also sort of tied together. So I thought that was quite interesting, and I thought that this was a good way to kind of illustrate that point, Jenny. But yeah, this is another one that I always associated, I think, as well with the seen on TV stuff. Like, you wanted to get the thing from the infomercials. Bed Bath & Beyond, after 6 months, carried all that stuff.
Oh yeah, they have a great selection of kitchen supplies and all of that stuff. So it definitely was it is a wonderful store. I just think the concern was prior to the pandemic, this was a name that was suffering. It was a name that was just gotten beat up. Then we saw the pandemic. We did see an initial surge, but now things are just sort of starting to normalize back to where they were pre-pandemic. I think it's concerning, honestly, Alex, that this was almost a failing name before COVID hit, because now can we expect them to be a failing name again? I mean, it's always a possibility.
Yeah, it really is. And you think about some of the trends in terms of where consumers are going, and you think about some of the things that they sell being kind of obvious, things like silverware, things like maybe like bed sheets, things like pots and pans, and the comfort that so many have now with just buying stuff online. Do I need to go see what forks and spoons look like in person, or can I just order a new set online? So I think it just depends. But again, if you got a car, you live in the suburbs, there's a Bed Bath & Beyond around the corner, it's probably not going to be that big of a deal to go there either. So I think we're all just tied to the areas of the world that we live in and how we approach things. But I did look at a trade illustration here, Jenny, go through that quick. Looking at this one, I went out to May. I know it has earnings well before then, but this allows us to give ourselves a little bit of room while still being risk defined. And it's been beat up a lot. Of course, you noted that it can go down a lot lower. It has gone down a lot lower, but it's come down quite a bit as well. And it does have its ties to the meme stocks. So if you think there's maybe more upside there, or you want to use some of that implied volatility, maybe to the advantage of the trader or investor, because it's so elevated, being around that space, I went ahead and I looked at a put vertical to 1712, so $5 wide, looking to collect about $1.25. This is exactly 1/4 of the width of the strikes, so we have $375 in risk for $125 in profit, with a break even at $15.75, and so it's about $4 below where we're currently trading. It's about, let's say, a 20% decline would be required in this stock for us to, basically be at break even. Certainly possible with the stock trading with 116% implied volatility, but still another trade asking the market to basically break the trade as opposed to needing something to happen.
Yeah, I think it's relatively a lower risk in terms of capital used here trade, as this is a lower price stock just relative to some of the other names that we discussed. And we will be watching this earnings event, which is of course next Wednesday before the market opens, as we could see some surprise to the upside. Things have been beaten up in this name for now 3 consecutive years, so I do think shareholders are hoping for some degree of relief maybe. But that does it for this segment. Coming up next, we are unintentionally sticking with our retail theme today, Alex. We are talking designer brands on some positive news today.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Think or Swim is right there with you to help you become a smarter investor. with an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Think or Swim by TD Ameritrade.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Welcome back to Next Gen Investing. I'm Alex Coffey, joined by Jenny Horn. As always, it's time for Under 30. And today, Jenny, we're talking designer brands. That's stock ticker DBI for those who are less familiar with this name.
This is, to me, DSW. I mean, it's the owner of DSW, but if you're familiar with DSW, which is more of that flagship name, this is DSW. This is all things shoes to me, I guess apparel, but this is an interesting name. It's up about 4% this year, so outperforming really on a retail basis. We also saw during its investor day, they raised their fiscal 2022 outlook, as well as reinstated their dividend of 5 cents a share. And also a really important piece of information here, Alex, is their CFO will be joining Market on Close today at 4:10 Eastern Time, 3:10 Central Time. So definitely stick around to catch that, as I'm sure he will have a lot of interesting thoughts for us. But to tell us currently more on designer brands is Jeff Pierce, TD Ameritrade Network contributor. Jeff, designer brands was a name that I used to really, really enjoy when I lived in the suburbs. It has since, I think, further away from me in distance since I moved to the city of Chicago. But they did give some positive news today, and we're seeing the stock price reflect that.
Absolutely. It looks like the company's seeing an upbeat outlook as we see them raise their 2022 earnings outlook from 180 to 190, up from the 175 to 185 they had previously, and that's above a lot of analyst estimates out there around 182. They also, as you pointed out, reinstated their quarterly dividend about 5 cents a share. That'll be the first one that the company has had since March of 2020. They've also pointed out that they plan on seeing more growth from their in-house or owned brands. They expect to double sales of these brands by 2026 from 19% to nearly a third of the company's total revenue. On top of that, they said that they see plans for revenue at $4 billion by fiscal 2026. They're targeting earnings of around $275 to $285. That mixed with gross profit margin of around 33% and operating margin of around 9%, which would be an improvement of about 200 basis points.
Jeff, all the activity that you mentioned, the way that they've gone about this in terms of upping that guidance, reinstating the dividend here, talking about really leaning into its portfolio of brands, these are all things that a company does when they're very, very confident in their execution going forward. So you look at a space that maybe has some uncertainty in terms of consumer spending concerns down the line. Certainly, it sounds like designer brands doesn't see that as a risk.
Yeah, I think it's a lot of what we've been talking about with how is the consumer reacting right now versus how they're going to in the future. We've seen the consumer continue to buy. Prices don't seem to be getting too much in the way of that. But here you've got a company that, really kind of prior to the pandemic, they had started to see an uptick in their per share price. It started to move on the upside. They certainly had a few rough years prior to that. But we've seen analysts come in, weigh in on this as well. UBS last month raised them from $13 to $15, kept them at a neutral rating. Deutsche Bank, $17 to $20, kept them at a hold rating. The company has closed some stores down along the way. They have a plan to close more stores. But what we're seeing is a company that is kind of moving towards their in-house brand. They are certainly talked a lot about moving online. And if the consumer is out there looking for a lot of choices, this is one of those stores which has more than just one brand to offer.
Now, Jeff, that brings me to my question, actually. Talk to me about DTC here, because we saw Nike announce that they were going to withdraw or pull a lot of their products from Foot Locker, and shares absolutely tumbled and really haven't since recovered very strongly. Why is this not an issue for designer brands? Because I have to think that the DTC push is also hurting them.
Well, certainly it's, I would say, a concern for a company like this, right? You know, Nike's one of them. We've seen Adidas, we've seen Under Armour, other brands start to kind of really go to that direct-to-consumer side, get out of that wholesale business. But for a company like, DSW, they are focusing on margins as well. And we know that a lot of times in-house products are going to give you a better margin. So part of this move might be because they have to, right? Because some of these big name brands are starting to move out of wholesale. But the other part is going to be able to focus on that gross margin piece. We know that the company's been really pushing for that for a long time. It looks like that they have not changed course at all, even after seeing that pullback in their share price during the pandemic.
Speaking of kind of the margins and margin pressures, Jeff, is there any commentary in terms of the inflation narrative and how that's impacting this company? I'm thinking in two ways. One is the wholesale style business that they have with DSW, but even with their in-house brands that they own, costs are kind of across the board right now in terms of commodity prices. Things like cotton going up higher, of course, labor costs. And so you start thinking, for a company that seems to really lean on the fact that they're kind of a discount brand, I feel like that's the part of the market that, while maybe it's a little bit more resilient to economic downturn, is most exposed to rising prices.
Well, there is an exposure there. When we think about some of these brands out there, whether it's clothing or primarily shoe wear, you know, the exposure from the discount side is that their margins might be much tighter. Having said that, if there is some sort of an economic pullback, if there are concerns from consumers out there that money is going to continue to get tight or become tighter, they may be looking for some of these brands. I mean, you think of some of the discount retailers on the clothing side that we've seen out there that have done fairly well when the economy has started to struggle. There hasn't been a lot coming out from the company on this, but when you look at the last earnings report, you see comp sales growing 36.9%, gross profit margins expanding 870 basis points to about 30.9%. On top of that, comp sales for the year were up 51.6%, and gross profit was up 240. Now that's in comparison to what we were seeing in 2019 and 2020. But having said that, when you've got those sort of numbers coming in, you could see where a company would feel positive about where the consumer is right now and how they're reacting to what they're selling.
So maybe some cautious optimism here on designer brands today, Jeff, although I do know that people love to spend top dollar on their shoes, which may be a benefit to this company as that is their primary offering. But thank you so much for joining us and giving us all of your insight. That is Jeff Pierce, TD Ameritrade Network contributor. Now, Alex, we are still seeing markets in that rat are a little bit mixed, actually, still pacing for a closing week out in the negative territory.
Yeah, markets losing some momentum that they had earlier in the day. Still 2 hours left, though, to get things in green territory. We'll see how it closes. The watch list is coming up next with Tom White, the host today. Thanks so much for tuning in, and we'll see you on Monday.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act, Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Good afternoon and welcome to the Watch List. I'm Tom White, filling in for Nicole Petalides. It's 1 p.m. here in Chicago, and stocks are ending the week on a slightly positive note as U.S. equities gained and the Treasury curve continued to steepen following declines sparked by the Federal Reserve's plan for an aggressive monetary policy tightening. Meanwhile, Treasuries declined, with inverse yields spiking in the wake of Wednesday's Fed minutes, which outlined plans to reduce its balance sheet alongside interest rate hikes. Global equities are nursing losses for the week as markets grapple with the Fed's campaign against elevated price pressures and Russia's grinding war in Ukraine, along with China's COVID lockdowns. Now let's take a quick look at the markets with only 2 hours left in the trading day. The Dow Jones Industrial Average leading to the upside, up nearly 0.7%. S&P 500 just slightly in the green in off a session highs, up 0.1%. NASDAQ 100 still under pressure, down 0.9%, and the Russell 2000 just slightly in the red as we hit the halfway mark for markets today. But let's take a closer look at today's top stories with Ben Lichtenstein, host of Futures here on the TD Ameritrade Network. Ben, we're seeing some inverse moves. Crude oil kind of going positive, negative, but I think the big story today that we should be focusing on, Ben, is those interest rates. We saw the 10-year yield hit the highest level that we've seen since March of 2019, putting pressure on the NASDAQ not only today but this week, hitting a lot of those growth names. What's the story here in yields?
Well, I'd have to agree, Tom. This has been an ongoing discussion basically since the beginning of the year. Keep in mind, mixing a little bit of geopolitics and everything else that's been going on. And you have, well, what we've seen in terms of the recent move off the all-time highs and the fact that the market continues to kind of struggle for direction since posting those upper levels, the middle of November for the NASDAQ, beginning of the year for the indices. But take a look at some of the selling we've seen in the bonds and a reflection of the Fed minutes this week, a little bit more information in terms of the taper and what to expect in terms of the Fed reducing their balance sheet. You can see futures to the downside. This is a look at the bonds, a longer dated. What was interesting is this week, that's what it was really about. It seemed like the shorter dated has been on the move lower, but take a look as we bring all four into the view here. You've got the bonds in the top left corner, the 10-year in the top right. So the longer dated at the top half and the shorter dated along the bottom half. You've got the 5-year and the 2-year, which didn't really participate along the same lines as the 10 and the 30, the ZB and the ZN. But here you can see as we take a look that, again, this has, well, rates to the upside. Anytime you're talking about treasuries and that trend lower, you've got the 30-year on the left, the 10-year yields on the right. So look at the 10-year up and through 2.7, Tom. This is going to start to raise some eyebrows and weigh on, as you mentioned, the NASDAQ. Take a look at the bottom half of the screen. I mentioned it's come off those mid-November highs, but it just recently took out the March highs, or I'm sorry, the Feb highs in the month of March, but so far throughout the month of April, follow-through has been limited.
Yeah, Ben, and I think, we've been talking about inflation for the last month with oil prices hitting up near 130, now back below $100 a barrel, which should put some, easing pressures on inflation that we've seen. But the outlook for oil right now, Ben, you have to look at Ukraine and Russia as the catalyst moving forward. So to say there's going to be a pullback from demand destruction in crude, which we haven't seen yet, it's all going to be reliant moving forward on the crisis over in Ukraine, correct?
Yeah, in many ways a volatile situation as well still, Tom. Sanctions this week. I mean, it'll be curious to see if Putin responds. Somehow he's been fairly quiet for the most part the last couple weeks. Combine that with the IEA and the U.S. releases some strategic petroleum reserves. And as you mentioned, we're back down below $100 a barrel as we head into the end of the week. Take a look at the daily time frame first, though, and the run-up that we've seen. Crude oil, a big part of those inflation concerns, rates on the rise, and what we were talking about here. Again, the daily really says it all. Up to 130 with the geopolitical tensions coming into play. And as I mentioned, Putin's been kind of quiet, and as we've added some supplies recently, we've come off. But one thing I'm noticing, Tom, as you take a look, natural gas, a big move up this week. So it's not just crude oil when you're talking commodities and feeding into that inflation narrative. We talk about grains a lot on the Futures Show and some of the other markets that have been and continue to be higher. I just want to point out as we take a look at natural gas here, this is the daily time frame breaking out up through 650, but take a look, we're all the way back to levels we haven't seen since, 2008, Tom, the end of the year 2008, beginning of 2009. So this is something to keep an eye on. Again, crude to the upside, energies in general. But here, lastly, take a look at this chart. Crude now back down below the 50-day moving average this week. The one thing that comes to mind is oftentimes we talk about crude oil, the relationship that it shares, well, prices at the pump ultimately. So we'll see if they start to come off a little bit. We joke around about how they go up a little bit more closely tied to crude futures. When they come down, it seems a little bit more slower in terms of the pace and the relief thereof as far as us as consumers.
Yeah, earlier this morning I interviewed one of the analysts at Gas Buddy, and it's elevator up as far as fuel prices go and escalator down because we continue to see that as it works through the system there. But one area that I think is putting pressure on equities, and it gets ignored quite a bit, Ben, is that rising dollar. It hit levels that we haven't seen since May of 2020. So a strong dollar putting some pressure on equities here, and I think that gets lost in the weeds as far as what market watchers are talking about.
Yeah, I want to talk about the dollar, Tom. I also want to talk a little bit about gold here real quick. So let's do both while we have a couple minutes, because gold has been one of those products that oftentimes you talk about influenced heavily by the dollar. And it seems like after a recent run-up, it's been kind of getting a little bit of a bad rep. Many have been disappointed that it was unable to take out that all-time high that we saw, if you remember, up around 2078-ish, around the 2100 level. Here you can see that most recent move. I'm talking back, we failed around to take out the August 2020 highs, and here we are around 2078 coming off. This is the 60-minute time frame. Sideways consolidation since, well-defined upper and lower extreme here at this point, but take a look as we move away from this hourly time frame and look at the daily. We're holding above the 50-day moving average. So gold, bottomed out here pretty well for the most part at 1,700 and found support. And this is, again, I want to remind everybody, just shy of these historic all-time highs. So it is a pretty good hedge. Oftentimes people kind of debate that. But I also wanted to point out, if you're taking a look at gold, I think it's important to, take a look at the dollar. As you mentioned, some of the strength there, we've seen it break out, which is interesting because this week, the dollar probably a little bit more closely tied to rates than it has been in a long time. There's been a little bit of a disconnect recently, but with some weakness in the euro currency, weakness in the yen. Well, take a look here. The TNX, we were talking about it. It's in the candles in this instance, up to 2.7% this week. And look at the dollar, which is now starting to inch its way higher as well. Now, still shy of highs we saw, if you remember, earlier back in August of 2020. But this will be key to watch here in terms of this move up here, if we can get some follow through here and some continuation. I'm sorry, gold, I meant to say, back up to these levels as the dollar has rallied and the rates have as well. So a lot to focus on here in terms of products, in terms of markets as we head into next week, and a busy week at that.
Yeah, definitely. And I think people should heed the warning that the dollar is reflecting at this point. Even with gold moving higher, typically we see the dollar and gold move inversely, but we've definitely seen them start to rise together, putting pressure on the equity market. All right, great stuff as always. That's Ben Lichtenstein, host of Futures here on the TD Ameritrade Network. But now let's take a look at the bigger picture. Our next guest is David Struczewski, CEO of Sound Planning Group. Welcome to the show, David.
Thanks for having me.
All right, so markets are pretty volatile. Inflation's white hot. Now, does this equate to a slowdown in the economy? Because it still seems like the consumer is stronger, but we've seen some revisions to GDP growth out of a bunch of analysts and economists lately. Do you expect that to continue?
Well, you're right. Most economists today are forecasting a positive GDP here ending 2022, although there are some that are negative. I think that we can talk out of both sides of our mouth here as we understand the ripple effect ultimately that takes place when we have so many different moves coming together all at one time frame. But yeah, we've been talking about the Federal Reserve, we've been talking about interest rates, we've been talking about inflation, the average consumer here today. One thing to know is that the goal actually of the Fed right now is to slow down the demand, because we don't have these supply portions of our economy correct. And so what happens if the supply is not there? Well, the demand is high and the price goes up. If we had the supply chain fixed, we would have a different situation potentially with inflation. But what the Federal Reserve needs to do right now is they're trying to curb our spending, which ultimately means actually a weakening of the average American's bank account. So we haven't seen it significantly happen because the average consumer was positioned really, really well coming into COVID. We were the strongest economy that we've ever had, and now we've seen a couple of years of this 7% plus inflation. The energy prices going through the roof. What's going to be taking place here with farming and fertilizers and all this as we get into our summer seasons here in the United States. So I think that there's quite a number of things that we are trying to be tracking right now. And be candid with you, it's a little difficult to stay on top of all of them.
Yeah, and I kind of wanted to hit on the Fed's role in this, because I have a theory, and I've stated it many times on the network here, that the Fed is behind the curve, and they have been for the last 6 months. But now they're trying to play catch up, and that swift policy change to becoming more hawkish is the reason that we're seeing some consternation and volatility in the equity markets. As they start to play catch up, we're probably going to get a 50 basis point hike here in May and maybe even in June. Is that the reason that markets continue to gyrate at these levels?
Yes, the markets are trying to metabolize what the Fed's going to do. We're all trying to forecast. And if anyone thinks that they have the next 2-3 years figured out, I'm going to tell you that's probably not someone that you should be listening to, because there's way too much that's in flux. The Fed is supposed to be the best ones at predicting this. And candidly speaking, they've not been great predictors of anything beyond like a 12-month cycle. So we're finding ourselves in a place right now. Yeah, hey, there could be as many as 7 increases this year. Now, I agree with you that we're probably going to see more like 50 basis point increases take place here in the near term, because they need to kind of shock our system, given that we haven't seen significant response back on some of it.
Yeah, and David, if you look at maybe the market rotation that we've seen over the last couple of months here since the start of the year, you've seen flows into utilities, healthcare, consumer staples, a lot of these safety plays, and it kind of highlights the fact that the market needs to adjust and rejigger basically where they've been going over the last 2 years since the pandemic started. What's your outlook for equities moving forward into 2022? Are we going to continue to see volatility, or do you see some reprieve here where the Fed's going to create this soft landing for us?
Well, I would love to say that the Fed can be able to create a soft landing. Obviously, they have extended this bull market significantly through accommodations, here since the turn up in March of '09. But ultimately, I think that we are going to see continued volatility. There's just so much that's taking place and so many things that are converging right now. I mean, I just want to mention this one right now: bonds and understanding what's going on with the yield curve here have signaled for us the most accurate indicator of equity declines. The last 8 declines have been marked by these inverse relationships when short-term debt is worth more than long-term debt. And we do see the consumer right now getting really short because we know that some of this is taking place. So I think people are definitely looking more defensive. We've got more baby boomers right now retiring. Last year was the Great Resignation, and we found so many now just not even participating in the labor market going forward. And so they have questions now. How do we create income? Where do we go? Where's safety? And obviously the equity markets with this inverse relationship with interest rates, 12 to 18 months tends to be when we see these significant equity declines. And so frankly, we're due for one. I think it's healthy to see declines. We shouldn't think that the market should just always go up and up and up and up. We need to be prepared for both sides. So offense and defense, and there's definitely strategies that people should be deploying today and conversations they should really be having about their risk, about their horizons, about how to create income and how to ultimately ride the bull markets and tame the bear markets.
That's right. Rebalance is the key here moving forward. All right, David, thanks so much for the conversation. Have a great weekend.
Pleasure's mine.
All right, that's David Struszewski, CEO of Sound Planning Group. But later this hour, the fintech stocks remain under pressure as investors become more skeptical for growth prospects. Dan Dolev from Mizuho will break down the sector and give us his top picks. Then we'll cover utilities with Jay Ram from Reeves Asset Management. And we'll take a look at some stock picks and the overall market sentiment with our panel. But up next, Matt Tuttle, the CEO of Tuttle Capital, will give us his take on markets. The watch list will be right back after this short break.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
away.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back to the watch list. I'm Tom White, filling in for Nicole Petalides. Let's take a look at the biggest movers in the market right now. Target shares are higher after an upgrade from Gordon Haskett. The analyst stated traffic trends in February and March have been remarkably consistent at Target, and with a later spring Easter shift still to come, these trends could inflect higher in the next coming weeks. He upped his price target to $300 from $255. And NVIDIA shares are down over 3% today and 12% off this week. A Truist analyst lowered the firm's price target on NVIDIA to $298 from $347 and keeps a buy rating on the shares as part of a broader research note on the semiconductors. The analyst cites hard evidence of a sudden negative shift in demand signals from a wide range of businesses, driving his recent 2023 models to contemplate negative growth and lower earnings multiples for the industry. And Tesla shares are off over 1% after the company's Cyber Rodeo event last night. Tesla will start selling its delayed Cybertruck electric pickup in 2023, along with numerous other products. But the event doesn't seem to be lifting investor sentiment. And finally, JP Morgan shares are up nearly 2% today as Treasury yields spiked to 3-year highs. The stock is still down over 1% this week and down over 15% so far in 2022. The company reports quarterly results next Wednesday to unofficially kick off earnings season. And now let's take a look at Bitcoin. Bitcoin is reversed from gains earlier on in the session, now down 1.7% on the session, giving up a little bit of risk on in the cryptocurrency at this point in the day. All right, now let's get to our next guest, and that's going to be Matt Tuttle, CEO and Chief Investment Officer at Tuttle Capital Management. Welcome to the show, Matt.
Thank you for having me.
All right, so markets continue to gyrate without any sustained direction. You know, what are the biggest risks to the markets that you see at this point?
So hands down, it's the Fed, and you know what the Fed does and why they have to do it. That's the biggest risk by far. I mean, what's going on in Ukraine obviously is awful, but you know, for the most part, barring something totally unforeseen, I think Ukraine is priced in.
Now, when you talk about the Fed, we covered this earlier in the show about the hawkishness and the pivot that we've seen from them. Now, my theory is that they're behind the curve by 4 to 6 months. They should have gotten rid of all accommodation by the end of last year. And now they're starting to play catch up because they didn't see the signs that it seems like everybody else did as far as inflationary pressures, Matt. Is that your take here, that the policy mistake might be the reason that we might see a recession later on in 2022 or next year?
Yeah, so, you know, two things. Yeah, I mean, I think they screwed up, and they screwed up royally. Now, the other issue you have is, does anybody trust the guys who messed this up to raise rates in a way that A, brings down inflation, and B, doesn't put us into a recession? I'm kind of thinking it's C, they do both, and we end up in stagflation. And you know, I hope we don't, but certainly a lot of signs are pointing that way.
Now, Matt, some of the sectors that you've highlighted in your notes, and this kind of goes into the theme that we've seen out of a lot of the analysts across Wall Street, is the fact that, you know, you don't want to be in home builders at this point. Consumer discretionary has been taking hits. We're getting price targets cuts across the board in these spaces. Do you expect that to continue and put pressure on the equity market here?
Yeah, I mean, the market is telling you something is going to be horribly wrong with the consumer, meaning the market is believing that we're going to be in a recession and the consumer is not going to have that discretionary income. And you've got now all these sectors that are just uninvestable: home builders, you know, transports now, consumer discretionary, the financials, and the semiconductors they just took out in crush this week as well. And, you know, unfortunately, we're going to keep seeing that.
Yeah, and I keep on hearing the rhetoric, you know, some of these market watchers are saying, oh, there's some good opportunities here at this point. But at the same time, if you see that deterioration, demand deterioration from the consumer moving forward, that's going to negatively affect all of those areas that you spoke about. And we've already seen a massive slide in a lot of those stocks in those sectors. But what type of stocks are you looking at on the positive side here moving into the middle of 2022?
So here's the problem. There are a bunch of sectors that are doing well. Unfortunately, they're all extended at this point. Mm-hmm. So, you know, things like utilities, things like healthcare, defense stocks, consumer defensive, gold miners, and REITs, we'd be looking to get into on pullbacks. that stuff has had an amazing week. I wouldn't just go out and just buy it at these levels. The other thing to look at is these beaten down growth stocks will have bounces from time to time. You've got to be nimble. These are not, stocks making new highs. These are, recovery type bounces that will eventually be retraced. But, there can be some nice gains over a week or so here and there if you're nimble in these stocks.
Yeah, and I think a lot of investors, got hung up with markets continually going up from, basically the end of March of 2020 at the start of the pandemic until the end of last year, basically just buying anything and everything because it was going up. So is cash an option right now for a lot of investors? Because as you mentioned, some of the areas you want to be in on the defensive side have already run up, extensively at this point.
Yeah, I mean, cash is my favorite asset class. And you brought up a great point. The average investor really has only been investing since the Fed has been accommodative. And once the Fed goes from being accommodative to not accommodative, the rule book changes. The whole, hey, buy the dip and, and all the stuff you saw in growth land since 2009, that doesn't work anymore.
Mm-hmm. Yeah. And I've been through many of those cycles in my trading career, Matt, so I'm kind of used to it at this point, but maybe that makes me a little more skeptical than most. All right, great discussion here, Matt. Have a great weekend.
You too.
All right, that's Matt Tuttle, CEO and Chief Investment Officer at Tuttle Capital Management. But coming up next, Dan DeLev from Mizuho helps us break down the fintech space and gives us his specific stock picks in the sector. The watch list will be back after this short break.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave them thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watch List live from the New York Stock Exchange.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to the Watch List. I'm Tom White, filling in for Nicole Petalides. Fintech stocks remain under pressure and have been in a downtrend over the last 7 months or so. To tell us more, let's welcome in Dan DeLev, Senior Fintech Equity Research Analyst at Mizuho. Welcome to the show, Dan. So, Dan, I like your conversations. You're an active analyst here in this space. I read all your notes that come out, it seems like on a weekly or daily basis. And I like the fact that you're pivoting based on a lot of the data that you're receiving. But one of the stocks I kind of wanted to hit on first is Square/Block.
You raised your price target recently on this a couple times in the last few weeks. What are your thoughts here in this name? Because it's been under pressure with the rest of the fintech space over the last several months.
Yeah, thank you for reading our stuff. Teamwork here. I appreciate it. I've always known someone reads it, so I appreciate that you do. But look, to be serious about Square, I still like to call it Square if I may, but
yes.
To be very serious about it, so we did a very detailed work on Square, like a deep dive, a top-down and bottoms-up work on Square. The key debate on Square is the strength of the Cash App. And what we think is consensus these days, the true core Cash App consensus is around 2.5 billion this year. They're going to have an analyst day on May 18th. We are seeing at least 2.7 or 2.8 billion this year, and I think that's a conservative estimate because we don't take into account a lot of the Cash App for teens or the 13 plus, which we've done survey work that shows you that's actually a massive share gainer and huge success. So that's what makes me excited about Square. Now, on top of it, you've got the buy now, pay later, afterpay, the point of sale business. But I'm just talking about the Cash App because that really drives the multiple of the stock right now.
And that Cash App, it's the growth engine of this company moving forward. Do you see, basically the opportunities in this space? Now, if we get that pullback in the consumer like we have and the adoption rates and the growth rates start to slow, and I think that's what a lot of Wall Street had problems with moving forward after their last couple of earnings events. But is that going to be the driver, or do they have other levers to pull moving forward?
It's a great question because it's widely known that the Cash App, as good as it is geared towards more lower income people, right? So you've got this sort of tug of war between Venmo on the more upper end and then the Cash App on more, that. So if the consumer is weaker and that part of the consumer is weaker, on a very near-term basis, there's definitely some worries about the Cash App. But I view this more of a macro situation, right? A macro. So there'll be a lot of stocks that will suffer if there is a recession, right? So we're not calling recession here. I'm just saying on a relative basis, Square is a massive, Block is a massive share gainer, and they keep coming up with new products and services that can more than offset some of the weakness on the consumer side. But again, the consumer we can't control. That's a macro situation.
Gotcha. And now another name I wanted to kind of hit on was PayPal. One of your notes said you see 4 silver linings in PayPal's earnings report, their past one. Are those still coming to fruition at this point? Are you seeing any changes there?
Yeah, it's a little bit harder to pound the table. I still like PayPal long term. I think it's, the checkout button is a huge asset. Venmo is literally a one-of-a-kind asset. I think if you think about more near term, I'm maybe a little bit more reserved on PayPal, right? On some recent conferences, they sounded at least a tone from management's perspective, and that's what we're hearing from investors. The tone wasn't as strong, so I'm a little bit more worried or less upbeat about the near term. It's more of a long term. It's more of a long-term play for us on PayPal right now. So the silver linings are there, but there's still a lot of issues with with their ability to sustain their share, vis-a-vis Apple Pay and Shop Pay and all these other solutions which are out there.
Are they more susceptible to a slowdown in consumer spending than Block is?
Actually, that's a really interesting point. They called it out on the fourth quarter results. We've looked into that, and I don't cover other sectors, but I've asked analysts and investors in other sectors. They're pretty much the only ones to call out that weakness early on, and I wonder if some of that weakness was maybe more idiosyncratic than anything else, because I haven't seen that. So in theory only, the Cash App should have more exposure to that type of weaker consumer than Venmo, just because of the income bracket that are in those. So I wonder, what they're seeing and why they're calling it out. It's still a little bit of a mystery to us.
Yeah, hopefully we'll get some clarity on that next quarter. And real quick, Dan, I wanted to hit on Coinbase a little bit, down over 35% so far this year. It's kind of, disconnected from, crypto and Bitcoin at this point. What do you see here for Coinbase moving forward?
not great things. I mean, Coinbase were pounding the table not to own.
Okay.
And I think I think Coinbase is one of those stocks that it will be remembered as sort of this, the epitome of the zeitgeist of this era. But if you think about their number one problem, which I don't see them getting around, is that institutional take rates are 2 basis points. Retail take rates are over 100 basis points.
Yeah.
Retail take rates are going towards institutional take rates, not the other way. So at the end of the day, they're still getting, they're making a lot of money, but they're investing a lot of money, and they're investing money in NFTs, which we've done, research on, and it shows you like the curve or the interest in NFT has plummeted in the last few weeks. So they're investing a lot of money in something that's dilutive to their ARPU, or the average revenue per user. So I'm not bullish, or I would say even bearish on Coinbase long term.
Yeah, costs are going to go down for that retail customer as far as Coinbase. That'll shrink their margins, and they're investing in something that's not completely monetizable at this point. So we'll have to wait and see in that. I like the outlook here, Dan. One positive, one relatively neutral on PayPal, and a sell on Coinbase. Stay away. All right, great stuff as always, Dan.
Positive long term, a little bit more, wait and see near term on PayPal.
Okay, got it. All right, Dan, have a great weekend. Thank you so much.
Thank you.
All right, that's Dan DeLev, Senior FinTech Equity Research Analyst at Mizuho, breaking down the FinTech space. But still ahead on the second half of the show, we'll take a look at the utility sector, which is at all-time highs, and our panel will focus on tech stocks. As we head to break, let's take a look at some of today's winners and losers in the S&P 500.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to the Watch List. I'm Tom White, filling in for Nicole Petalides. With just 90 minutes left in today's trading session, let's take a look at the 4 major indices, which are starting to weaken further as we speak. The Russell 2000 now in negative territory. To the downside, the NASDAQ 100 is leading losses. You can see they're down 1.3%. S&P 500 now back into the red, down 0.2%. Dow Jones Industrial Average hanging on to gains, up 0.4%. And that Russell, as I mentioned, down 0.3%. But now let's bring in Michael Keeley, a contributor on the TD Ameritrade Network, to help us break down UPS and the transports, which are getting hit pretty hard this week. Now, Michael, welcome to the show. We've got a downgrade on UPS. Second one this week. B of A put a price target down to neutral from buy, $204 price target. This seems to be the theme right now, Michael, because I've seen a lot of analyst notes out over the past several days that freight rates are going down, demand, destruction for the consumer. Is this a warning sign for the sector?
It absolutely is, Tom. You put your finger on the pulse really well there, because while there's some benefits to business conditions in the big transport companies, the driver recruitment is getting better, wage inflation is abating somewhat. Those are the positives. But you said it. It's the demand side of the equation that's really thought to be, a huge impediment. on this go-forward basis, to that degree that the analysts are pretty much falling into alignment with dropping price targets. You've got 10 holds and 10 buys on UPS at the moment on the sell side. And they're noticing that, the capacity part of the equation is interesting because there's a fragile balance of adding capacity, as the transport companies were attempting to do, in the midst of what is now seen as a more overheated freight market that is waning in strength. And so, a traditional recourse for investors, Tom, when we go back through market history, is a defensive posturing to favor the rails and to dump the truckers, because the rails are seen as a more defensive safety play. And to that end of things, the rails have done a bit better. They're still under pressure. And you would think that if demand is going by the wayside, that's going to impact the rails as well. But they're not going to be as sensitive to this. And UPS, we should point out, has had very strong pricing power. They've been capable of keeping prices high, in fact, lifting prices even recently. But that's where the analysts are really saying, we have to consider that the e-commerce giants are increasingly trying to insource the transportation side. And a notable example of that would certainly be Amazon, which is a major point of supply for UPS. I mean, they have a major contract. And so, the UPS is seen as more, as more weakened by the insourcing that may take shape with e-commerce giants. And it looks like that wave is beginning to take further traction at this point, Tom.
Yeah, who can afford to buy anything with fuel prices the way that they are? But both of the notes today, Michael, I thought were, you see the word deterioration on both of these, rapidly deteriorated. You don't like to hear that. This stock has outperformed FedEx, but back to 6-month lows here today and down over 7% so far this week alone. All right, Michael, thanks so much. Have a great weekend.
You too, Tom.
All right, that's Michael Keeley, contributor on the TD Ameritrade Network. Now let's shift into the utility sector. Talk to Jay Ram, CEO of Reeves Asset Management. S&P 500 utility sector hit all-time highs today. Our previous guest, Jay, stated that maybe some of these areas that people are going into for safety starting to get overbought here. What are your thoughts of this sector?
Well, I think, there's really a lot of reasons why utilities have done pretty well. And, if you I think if you knew at the beginning of the year that the U.S. 10-year would be at 2.7% in April, you'd be pretty shocked to see that utilities were the second best performing sector year to date. So one, I think, valuations matter. The utility sector had underperformed the S&P 500 by the most over the last 3 years since the late 90s tech boom. So valuations were pretty cheap coming in this year and still are attractive today. Secondly, I think that utilities are always a defensive investment, and the kind of fear of recession has really outweighed the reality of rising rates so far. What's really interesting is so many companies have gone through these series of simplification transactions that have really de-risked the business models. And so what was actually a very defensive sector has become even more defensive just in recent years. And then finally, I think that, a lot of fixed income investors are in the middle of some pretty steep drawdowns. And, they might be looking at a sector like utilities with a high initial yield, the ability to grow those dividends over time, and seeing that as pretty attractive, an attractive income stream, especially in inflationary times. So certainly a lot of reasons why they've done well, and I think could continue to do well too.
Yeah, and we have seen that drawdown in the Treasury market with those yields popping. 10 years up 120 basis points so far this year. I remember early on in my trading days, that would be a year's type of move, and we've seen that over the last 3 months or so. But when you look at this, they pay high dividends. People are using it as a safety play. But are the fundamentals there for this this sector, especially at these levels where, a lot of people are calling for it to be overbought at this point. But if the overall market starts to pull back, you might still want to be in here.
Yeah, well, I think fundamentals have actually improved a lot. The visibility into growth has kind of increased over the last couple of years, and it's driven, primarily by the shift to renewable energy. In a way, that's helped keep inflation down for the sector because, if you think about the switch from coal-fired generation to wind and solar, a company doesn't have to go buy the fuel. You have less employees to work it. Maintenance expense is very low. And so utilities have been able to kind of make these investments to be able to keep operating expenses down. So that's helped keep inflation down. But what that's done is that it's made, a fairly economic decision to be able to invest in renewable energy. And, obviously costs, generally continue to get cheaper. And so you just have a lot of visibility into growth over the next 5 to 10 years that you don't really see in many other sectors. So, for now, that visibility into growth and earnings and consistency of earnings is driving valuations.
Yeah, getting rewarded for investing in your business when you're switching to more of an ESG type of balance sheet, it might be a positive for these stocks moving forward. But when you look at the sector as a whole, based on the recessionary fears that are out there on the street at this point, do you see a recession coming, for one thing? And is this the place that maybe investors should be rebalancing their portfolios even at these levels?
Well, I don't really have a view on whether we go into recession or not. But it's, with the underperformance of the last several years for the sector, the sector remains, fairly cheap relative to historic standards. Certainly, even with interest rates increasing, relative to where interest rates are today, the dividend yields on many utilities are pretty attractive. So there's certainly a place in that in people's portfolio for a sector like that.
Yeah, it's definitely outperformed the overall market pretty significantly so far this year, and it's been leading this week especially. All right, great stuff as always. Jay, thank you so much. Have a great weekend.
Thanks, you too.
Jay Rame, CEO of Reeves Asset Management, joining us breaking down the utility sector. But still ahead, we're going to bring in our panel to discuss this tech sector with some individual stocks to cover. The watch list will be back in 2 minutes right here on the TD Ameritrade Network.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
I'm Jenny Horn. Here's a few more intraday movers to keep on your radar. JP Morgan reiterated Constellation Brands as a top pick, saying that the beverage company is growing at a reasonable price in their universe with top-line momentum in its beer sales. The firm highlighted Constellation Brands' 100% U.S. exposure and committed capital allocation framework, which makes shares attractive. RBC Capital initiated coverage on Raytheon as Outperform, noting that the defense sector has benefited from a positive re-rating. The analyst said Raytheon is establishing a new standard for end market exposure from defense and aero that will benefit from stronger defense fundamentals as well as the commercial aerospace recovery. And Baird kept its Outperform rating on both Caterpillar and Deere, saying both companies should benefit from an inflationary environment. They highlighted the equipment company's direct exposure to commodity extraction customers, which is pacing to disproportionately benefit from an inflated market. Both companies are trading higher today. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Tom White.
In for Nicole Petaliti. Look, let's at the tech sector. Let's bring in our panel. We've got Mark Cash, Senior Equity Analyst at Morningstar, and Melissa Armo, the founder and owner of the Stock Swoosh, joining us. Mark, I'm going to go to you first. You've got a lot of names on your list that you sent us, but the first one I wanted to kind of hit on was HPQ, Hewlett Packard, and in that Dell realm, we had the Buffett investment into this company. Does it change the bottom line or the metrics for this company? Because I've seen a couple downgrades this week. What does this say for you for Hewlett Packard?
Yeah, so our thesis moving into this is that there's been some exuberance in PC, and so they've had record demand for HP and Dell for notebooks with remote working or remote schooling, but at some point the party's got to end, and so we've been kind of cautious about this, that the demand will normalize, and we think it's coming pretty soon, and so the pricing environment will start to get more challenging versus really no discounting that's had to happen in the last couple quarters. And so, what's interesting about HPQ, and you saw it, Berkshire taking like 11% stake in the company, and so building that up, and so obviously investors like to see that. I mean, a track record like Warren Buffett taking a big stake like that, but so we're still just a little more cautious though. HP and PC and printing demand we think that there's some headwinds in the longer term besides this great time right now, and we think the company's doing the right moves, returning capital to shareholders, but we're just a little more nervous long term.
Yeah, and I think softening demand in some of the lower end PC is what it is highlighted on the street. But Melissa, when you look at these names, whether it's HPQ or Dell, I always think about them as legacy hardware makers. Does this investment change anything for you as far as these two stocks go?
Well, HPQ had a nice gap up. It was around 35 and then gapped up over 40 just this week. So that was a nice move for the stock. It's the strongest. If you compare HPQ to Dell, Dell is a lot weaker. But again, you've got to look at the overall market and how these stocks are faring with the overall market. The overall market is not at the highs. So you can't expect these stocks to be at the highs either. And again, we're still in problems with getting parts and things like chips. There's still supply chain issues going about. It's not like people are going to stop buying computers. It's just that these stocks are struggling right now, but so is the overall market.
Definitely the overall market, especially the tech space. But Mark, another name that you've got on your watch list here is Cisco. The stock's been in a tight range over the last couple months. Are they doing anything to improve their bottom line? Because it seems like the revenue generation that this legacy player makes doesn't seem to affect the stock. Is the outlook for this company moving forward a positive one?
Yeah, so if you look at the strategy of Cisco, it's all about software and services and recurring revenue and growing that, becoming more, durable company for investors, less, more insulated from IT spending shocks and lulls. So Cisco has definitely made strides in that direction. The majority of sales coming from software and services now, and that the software is mostly subscription based, and so that's great to see recurring revenue. And so this is also helping, the margin standpoint. And we think Cisco is a very solid operator. It knows it's not a high growth company, but it does find pockets of growth here and there, and we do like that. It's finding success with the hyperscale cloud guys. So Amazon's of the world, as they're building out their next big data centers, Cisco's actually into this wave of spending where it missed the last one. So it's got some good things. It's a key component of hybrid work, and so as you push more bandwidth through these pipes, as people are more distributed, you're going to have to update your infrastructure to all these offices. So there's definitely some good things going for Cisco, but on the flip side, Cisco competes against people who are best of breed, and they're always under attack. So it's kind of this give and take with Cisco. We obviously think it's a great shareholder name because it's very friendly to shareholders, returning 50% of the cash flow, through its dividend and its buyback program. So it's a name that, it's kind of trading around our fair value of 56 right now. So it's a name we'd kind of look for if there's a pullback. We think it's a great solid operator.
Yeah, been consolidating at these levels. At 2.8% dividend yield that you mentioned is definitely a positive in a falling tech environment right now that we're seeing. But Melissa, when you look at a name like Cisco, does it excite you at all, or do you see just more consolidation for this name?
Again, that's nowhere near the highs either. That could consolidate or have a big move, which could be down or up in the earnings. Remember, next week, 1 week from today, or actually Wednesday next week, earnings season begins. So it's really going to depend on how these stocks fare in the earnings. If you're going to invest, though, if you really want to buy something that's going to move big, even though Cisco isn't going anywhere as far as the company goes, I mean, Microsoft is a lot better investment in something like that in that sector. As far as I'm concerned, it's a lot stronger of a stock. It's been at the highs. It has much, much bigger moves in a stock at Cisco, even though it's pricier, it's more expensive. If you're really looking to get in something in that sector, then I'd look for something like Microsoft or even NVIDIA. NVIDIA is another really strong stock, even though that's falling today too. You got to watch the stronger things, even though they're more expensive, if you want to get in something for a big, big move. And I'm talking about if you're a short-term trader, if you're a swing trader, if you're in options and you want to get big moves and stuff quick in a week or two. Those are the things that I would be watching.
All right, Microsoft back under 300, NVIDIA down 12% so far this week. Maybe some opportunities there. But Mark, you've got some other names here, some secondary names, F5 Networks, ANET. Which ones do you like out of that group?
Yeah, good question. So, looking at Arista, I think, they're obviously a huge beneficiary of big data center spending. So Meta and Microsoft rolling out data center initiatives. So they're one of the key suppliers there. So they're riding that tailwind. Just like other companies we mentioned earlier, it's just record demand. The question is, how soon can they ship and deliver? So we like that, but we think there's been some maybe too much exuberance with Arista. And then for F5, we think it's a company that can be misunderstood at times. It definitely has pivoted to software, and it's doing a great job with that pivot. So we expect growth to actually accelerate as they grow that recurring revenue base. And they've actually, they're pretty leveraged to security now. So we like that aspect. Security of applications is not going anywhere. F5 is front and center of there. So you kind of peel back the onion of what F5 is doing and moving from this hardware company to more of a software and security company. We think there's some good things to see here.
All right, and Melissa, finally, is there any other stocks on your radar moving into the kickoff to earnings season next week?
Well, the big ones to watch are the financials, because you're not going to have the market go back up and over the highs without the financials, and they have really been falling. Goldman Sachs charts, it's been selling off. JPM has been selling off. The banks are selling off. I'm watching the financials, which are at the beginning of earnings season, to report. And if they do not report well, or they react negative on a good report, remember, we're in an environment with rising interest rates, then that's not going to fare well for the market going into the spring.
Yeah, banks doing well today with those rates rising. All right, great stuff as always from our panel. That's Mark Cash, Senior Equity Analyst at Morningstar, and Melissa Armo, founder and owner of the Stock Swoosh. That's going to do it for the watch list today, but stick around right here on the TD Ameritrade Network, because Market on Close is coming up next with Caroline Woods hosting. Have a great weekend.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the Watch List at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Good afternoon. It's 3 p.m. here in New York. I'm Caroline Woods filling in for Oliver Rennick. This is Market on Close. With 1 hour left of trading, let's check in on how the markets are doing right now. Looking like a mixed picture still. Seeing some gains across the Dow. It's up 0.6%. Meanwhile, the NASDAQ is the clear loser today, down 1%, led lower by tech, especially weakness in chip makers. Energy and financials leading the way for the Dow. Meanwhile, the S&P 500 basically flat on the session, and the Russell just a little bit below the unchanged line. Here's a look at what's ahead on today's show. We have plenty of stock picks from today's guests, including some strategies for ESG themes and long-term picks in today's volatile market. Later, we'll check in with Morningstar's analyst on Simply Good Foods. The stock hit an all-time high today. And don't miss our chat with Designers Brand CFO Jared Poff. The company raised guidance and reinstated its dividend payment today. We'll get all the details about 10 minutes after the closing bells. But before we get to all of that, let's bring in Kevin Hinks, the co-host of Fast Market. Hey there, Kev. Thanks for being here with us on this Friday afternoon. I know you always like to see what happens in the final hour of trading, so here we are. I mentioned that energy and financials outperforming today. Also healthcare, we're seeing that defensive posturing again. What do you make of that, Kev?
Yeah, interesting market. This market feels like a marathon runner struggling to the finish line of the week, Caroline. It looks like it's just looking to eke over the finish line here. We've got the Dow hanging in there because there's a little bit of healthcare in there, a little bit of consumer staples, and you're right. Healthcare in the S&P 500 seems to really be helping, but the NASDAQ and those tech-heavy names that are not only in the NASDAQ, but a lot of them are in the S&P 500, that's weighing on all these markets, Caroline. And it's just, going to be a tough last hour for these to get into the green. You already mentioned the S&P 500 is really close to unchanged. The Dow's up about 0.6. The NASDAQ is down about a little over 1%. The Russell and the S&P pretty much unchanged. This is turning into just a, depending on what sector you're in, you're either relatively strong or hanging by a thread, Caroline. So you mentioned healthcare. Is that a defensive play? It's kind of tricky. I can make a case for some good defensive plays in some of the discount retailers. We covered some of them today on Fast Market. Healthcare, I don't know. I think they've got some good news that they like, and they've been strong all week, Caroline, as you know. So it's a little trickier for me to connect the dots on healthcare. Some of the retailers, I get it though.
So we'll talk about some of those retailers. We see the Regeneron chart up. That hit an all-time high today, but we also saw some discount retailers hit an all-time high today. We saw Dollar Tree and Dollar General, both are up today, hitting all-time highs. Do you think that this is some preparation for a consumer pullback, or maybe looking for cheaper price points, maybe recession-proof stocks? How should we look at that?
Now, this is a much clearer picture in my eyes. I can really connect the dots pretty easily. We covered Kroger, which got an upgrade today on Fast Market, and you look at Kroger surging higher, Walmart surging higher, Dollar General, Dollar Tree surging higher, and we made the case today that you could see leaving the restaurants, more buying groceries and cooking at home kind of scenario if this economy were to start to slow down. So I get that part, right? I get the grocery store overall discounters versus maybe restaurant stocks and eating out. So I like that as a much clearer picture of possibly people getting ready for some defensive trades if this market this economy does start to slow down, Caroline. I think that is a pretty clear picture being made by the market.
Another area we're seeing some interest is cybersecurity. That's really been in focus since Russia invaded Ukraine. CrowdStrike in particular, it's up about 0.4% today, but that got some price target hikes from a few different companies today.
Yeah, CrowdStrike, Deutsche Bank raised them from 240 to 270. Baird raised them from 225 to 275. Deutsche Bank gave them kept a buy rating. Baird kept them on outperform. Not really surprising, right? With everything going on between United States, Russia, Ukraine, Europe, cyber has been threatened to be used. It's such a popular weapon now to use from country to country. Not really surprising that some of these these protectionary names, these cybersecurity names, not really surprising that they're finding some strength here and some popularity. So again, that's another one with the geopolitical events going on in the world. I can see easily why some of these stocks are having a good run here, Caroline.
Yet tech in general is really what's dragging the NASDAQ lower. So do you think that, again, is this rotation away from tech in anticipation of the Fed? Because we started seeing renewed interest, and especially in some of those higher quality tech names.
Yeah, what I like to do, Nicole, I like to look at the heat map on the Thinkorswim platform, and that top and the left part are all those high profile NASDAQ names, those big tech names, and that's what's clearly in the red today. It's that bottom right where we found some strength in some of the consumer discretionaries, the healthcare that you mentioned. But yeah, if you look at the heat map of the S&P 500, these names are such a big fraction of the index that it's going to be very hard. Remember, and they take up an even bigger percentage of the NASDAQ. So it's going to be very hard for this market. Like I said, this last hour, we'll see if it's able to eke out an unchanged day or slightly in the green. But right now, like I said, this market looks tired, Caroline.
I feel its pain. Yeah, NASDAQ down about 1% today,
Yes.
so not really inching any closer, but at least off the lows. We'll leave it out there on that bright spot, sort of. Kevin Hanks, thanks so much. Have a great weekend.
Have a great weekend, Caroline.
All right, now it's time to bring in our next guest, John Qualey, Chief Investment Officer of Trillium Asset Management. Thanks so much for joining the show, John.
Hi, Caroline. How are you?
I'm great. So you've provided us with some thematic investing strategies. We were talking about cybersecurity with Kevin, so why don't we start there? He was talking about CrowdStrike, but your pick in this industry is Palo Alto Networks. Why do you like that? Why is it on your radar?
Certainly from a fundamental perspective, it has the characteristics we like as a long-term core diversified growth and thematic investor. It has certainly the organic growth, the margin profile. From a secular perspective, it's certainly the Russia-Ukraine is just yet another example of the importance around protecting cyber and cyber assets. From an ESG perspective, as you know, we're one of the oldest ESG investors in the U.S. From an ESG perspective, they're quite good in human capital management, recruiting. They really value their employees. So put those two together, it is a stock that we favor, and certainly in a secular trend that's quite topical, as your previous commentator said.
And it's outperforming the market this year. It's up about 10% year to date, almost. So still room to run. You'd be comfortable getting in here.
Well, to be fair, it has run, and thank you for bringing up valuation. It is at the very top of the valuation limits. Free cash flow multiples nearing 40 times. That can get quite excessive for some investors. So I'll say we're confident in the 3 to 5 year story. The short term volatility is anyone's guess, but the valuation is approaching fullness.
All right, let's move to ESG. Broadly speaking, before we get into your picks there, what's the upside case for ESG? Because I know you're bullish on this one.
Sure. So it's all we do here, and so ESG. We look for ESG leaders and companies that embrace the acknowledgement, the transparency, the management of ESG risks. Think about this as environmental risks or labor force risks. Those are quite acknowledged and prevalent by any type of investor. But also the flip side is opportunities. What are companies doing to improve their workplace, improve their environment, improve their supply chain? So it is fairly logical, fairly detailed work that a lot of investors now incorporate ESG characteristics into their analyses. We like the mitigation of risk, but we also like the embrace and the opportunistic capitalization on opportunity, whether that's new products, whether that's new services, whether that's new business models that pivot in some cases to a lower carbon, more energy constrained future.
Obviously, the Ukraine war has sent oil prices spiking, and it's made, energy independence a hot topic again. So how much has that, do you think, set us back in terms of ESG investment and making that a priority for a lot of investors?
Yeah, so it's certainly an interesting observation because we're in the throes of this war 60 days in, and there's a lot of volatility and there's a lot of operational challenges we have as a society, as a world, with our energy ecosystem. So we have to acknowledge that and to fix that in the short term. We need to be functioning in a healthy and hopefully fully democratic societies. That being said, the prevalence in the secular change towards lower carbon energy sources, electric vehicles, renewables, those are secular changes that happen over decades. We're talking about replacing assets that have depreciable lives of 30 and 40 years, 50 years even. And so that process is still moving unabated. For us here at Trillium, we not only invest in energy companies that have a commitment to a lower carbon future, but we also look at adjacencies, companies that are in market today, enabling, optimizing, and cleaning fossil use. And so one of those companies is a group called Darling Ingredients that we find attractive, the secular and the fundamental trends.
So that's another one that's higher this year, so outperforming the market. It's only up about 0.2% today, but at 8% year to date. So how do you look at that one from a valuation perspective, just to make sure we touch on that?
Yeah, so thanks again. And there we have a little bit more room to grow in our valuation work. That one is much more of a 8.5 times EBITDA type of name, very consistent for a commodity-linked company. That we believe is a little bit more attractively priced in the short term. Again, as 3 to 5 year investors, we don't put too much stake on what's happening today or the next quarter, but their distribution platform, the strength of their balance sheet, their worldwide capabilities, their ability to, again, make BTUs, British thermal units, cleaner, very attractive in the long term in our eyes.
All right, and then in terms of medical devices, I'm assuming this is a play off of COVID. Your pick is Thermo Fisher. Tell us why.
So certainly in the last 24 months, the company's benefited. They're a leading scientific and medical instrumentation analytics company. Certainly the last 24 months have been positive, but even before that, they have a heritage and a pedigree of innovation and equally as important, servicing their client base. The concept of diagnosing, being accurate with the diagnosis, and delivering analyses is incredibly important for access to medicine as well as continued research. So it predates COVID a bit. Certainly COVID has accelerated that, I would say, as a society, access to medicine. I think most of us can really see the value in that. This is a company that enables it not only in the United States, but in other countries worldwide.
All right, and that one is basically flat today, but down about 8% year to date. We have to leave it there. John, thanks so much for joining us. Really appreciate it.
Thanks very much. Have a great weekend.
That was John Quayle, Chief Investment Officer of Trillium Asset Management. All right, coming up, has recent market volatility provided an entry point on some long-term opportunities? We'll get a few actionable ideas from our next guest and several names to add to your watch list. So stay right here on the TD Ameritrade Network. Market on Close will be right back.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like calendars and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on thinkorswim for the full options for volatility course and a whole lot more.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watch List. When the default list appears, select the name box, then Create Watch List. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to think or swim, head to the Education Center on tdameritrade.com. Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust the time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Welcome back to Market on Close. It's time for Options Corner. Alex Coffey, co-host of Next Gen Investing, is here today to share a few trades from today's action. Alex, let's start with Apple. It's a loser today along with the broader tech sector, but tell us what stood out to you about this trade.
Well, first off, what stood out here, Caroline, is just the sheer notional value and size of this trade. Clearly, some type of an institutional money manager of sorts, I would guess, just simply off the sheer size. But looking at this trade, it's in some circles referred to as a risk reversal trade, or in others maybe a combo. It consists of both selling a put and buying a call in a particular name. But what stuck out to me as well is it goes out a few months here in duration, goes out to July, so it's quite a bit of time until expiration, and it's done for a credit overall. So earlier today, 6,900 of the July 160 puts alongside the 195 calls, which they were selling the puts, buying the calls, went off for a 402 credit. Brings the break even to the downside of 155.98, where this trader or investor or manager or fund manager, whatever they may be, would potentially be on the hook to buy 690,000 shares of Apple at that price below 160. It's a bullish trade because it doesn't actually have a theoretical max profit. Is once through the 195 calls, it will kick in and actually has theoretically unlimited profit or loss here to the upside. So a very interesting trade. You can see it reflected there on that risk profile, but notably massive max possible loss here, and that's the total notional value of this trade at $107,626,200. That of course would be if Apple went to zero, so that would of course have to take place, but you can see just how much stock that really is.
Apple going to zero, the likelihood seems very, very low. But just in terms of anything we can draw from this, we know we're heading into a higher rate environment. I think the expiration on this was 98 days, so the Fed will have likely hiked by 50 basis points then. Just in terms about what it could tell us about Apple's direction going forward, or no?
Well, of course, we don't know who actually put this trade on, what they think they know, what they do know, what they're perceiving may or may not happen. But one thing's for sure, obviously, it's a large notional trade coming through. Apple is widely traded, of course, widely held in many institutional funds. So not uncommon to see big trades take place in this name. But given the setup of this trade, that it's done for a credit, and of course they're selling that put below the market here, Caroline, what I would note is that the break even is 155.98. So this particular investor is putting a sizable bet essentially, or wager or investment in Apple staying above that price. Otherwise, potentially on the hook for some sizable losses. So I would just say that maybe that they are, of course, confident that Apple will do well, and that's why they buy that out of the money call for that theoretically unlimited upside potential. But more about the fact that they maybe just see things holding stable, as the break even is quite a bit below where we're currently trading at 170.81. It's almost, a full $15 below where we're currently trading. So I would say that the investor is probably just looking for more of the same, some stability. And if you got a big upwards move in Apple, next leg higher to a new all-time highs, that would almost be like a cherry on top.
Although I'm just looking at the chart, really, Apple was trading around 155 just back in early March. It wasn't all that long ago. So I guess another one to, keep on our watch list, or continue to keep on our watch list. Another name you spotted, ConocoPhillips. Tell us what the trader was doing there.
Yeah, this one's a little bit more interesting, of course, Caroline. We know that the energy sector, as a byproduct of kind of the crude oil markets and what we've seen through the energy commodities as a whole, has been tremendously volatile, and that's exactly what this particular trader is looking to capitalize on continuing. So this particular trader goes out into the August expiration, so a month further than our Apple trader went out, and so interesting kind of duration here associated with this one. And they're doing what would be referred to as a strangle trade, but they're buying this strangle. So what this means, Caroline, is they're buying the 90 put and they're buying the 120 call. With ConocoPhillips currently trading at 103, they're going to need some movement to take place. You can see the break-evens in that August expiration are 82.70 to the downside and 127.30 to the upside. So this one is interesting. In terms of its outlook, it's hard to even say for sure if it's bullish or bearish. It's in fact just looking for volatility to continue. They either want a massive up move or a massive down move. They really don't care one way or another. You can see that expiration is 133 days away. A pretty big trade though. 5,383 times this particular trader did this, which corresponds to just under 4 million in terms of a max possible loss, which is a very realistic possibility given the fact that you see those break-even points. If this stays between 120 and 90 over the next 133 days, this would be a max loser trade in which the trader would stand to lose 3.9 million on this particular trade. So looking for continued uncertainty within this space, be it to the upside or the downside. One narrative associated with that would be an escalation in some of the geopolitical tensions, or sanctions could lead to continued uncertainty in the crude oil markets, sending prices higher. And then as a byproduct, ConocoPhillips may be benefiting from that in terms of stock price, or of course, maybe there's a quick resolution, even a retracting of some of those sanctions, or whatever it may be, a downwards move in crude oil, then potentially sending ConocoPhillips lower as well. So doesn't matter which happens, or as long as one happens as far as this trader is concerned.
Yeah, or there's that recession forecast that people are talking about, not probably soon enough in terms of it playing out for this trade, but we know what impact that could have on oil. But we'll have to leave it there. Alex Coffey, thanks so much. Have a great weekend.
You too. Thanks, Caroline.
Joining us now, Amber Fairbanks, Portfolio Manager of Morova US. Amber, thanks so much for joining us this afternoon.
Yeah, my pleasure. Thank you for having me.
So Amber, we were just talking about oil. So before we get to some of your actual stock picks, let's talk about ESG, because I know it's a segment that you're bullish on. Why do you think it's important to integrate ESG into portfolios right now?
So from our perspective, it's both a risk and an opportunity to integrate ESG. Obviously, we need to become more sustainable as a world. So companies that are really addressing that, we expect to experience economic tailwinds. From a risk perspective, if you look at the S&P 500, for example, if you look back at 1975, about 15% of the S&P 500 was tied to intangible assets, with the rest being tangible assets with regard to value. If you look today, it's 90% intangible assets. So things like brand and reputation. So really it becomes increasingly important for companies to address this, as brand image can so easily be destroyed through a tweet because of a bad ESG practice that is then spread across the world. So really that's increasingly important, we see, from a risk perspective.
All right, so let's talk about some of your ESG picks on an individual stock basis. First stock, Aptiv. It's gotten hit hard this year. So what's the case for some upside from here?
So if you look at Aptiv, it's really positively exposed to autonomous driving through advanced safety systems like radar, also electric vehicles through electrical distribution systems, very strong long-term secular trends in our opinion. The stock's off 30-40% year to date, but we really think that's short-term concerns, really driven by the Russia-Ukraine conflict, what's going on there, the impact they could have on supply chain with regards to automobiles. So really looking at the long-term view here and just see valuation as not at all reflecting the long-term value of the company.
Speaking of autos, I know you also have Mercedes-Benz on your list. Is that an ESG play and expanding into EVs?
Yeah, they are. They're doing broad expansion into EVs. We added that to the portfolio last month. They've committed to 50% of sales by 2025 in plug-in hybrids and electric vehicles, and 100% by the year 2030 in electric vehicles. They've committed to spending 40 billion euros in CapEx to build battery capacity, to retool factories, and to step up software efforts. So really see that as a strong growth story going forward. Also, valuation is just ridiculously cheap. It's trading at a PE multiple of less than 6. It had substantial free cash flow. Again, I think it's just the issue with short-term concerns are really covering the long-term value of the company.
So you would look at some of the weakness that we've seen this year as a good entry point. You'd buy the dip, essentially.
Yeah, I think as long-term investors, the best returns are born out of volatility. So we're really seeing this volatility as an opportunity. In the words of Warren Buffett, you should really be fearful when others are greedy and greedy when others are fearful. That's how we think you make the best returns. Having that longer-term view, be able to discern which data are changing the value of a company and which data are just short-term concerns.
All right, so speaking of stocks that are out of favor that you also like, eBay down 17% year to date. Why is that a buy right now?
eBay is just really positively exposed to that long-term secular trend around e-commerce. Again, an inexpensive stock trading about a 12 PE multiple. They have a new management team that's really focused. So I think that they're going to start to drive the value of high-value users. They're going to focus on certain categories like auto parts. I think that they have opportunities as well in advertising. It's just a stock that shouldn't be trading at a less than 12 PE multiple, in our opinion.
So if you go by Warren Buffett's advice of investing when others are fearful, we also have to note, obviously, that there are so many headwinds and risks in this current market. So I guess how are you weighing those in terms of what's priced in? We're hearing recession, stagflation, bear market. Are you expecting any such thing? And so just overall is now a good entry point, or would you wait to see maybe another leg lower?
There's so much uncertainty right now with inflation, with interest rates, with the duration of the Russia-Ukraine war. So I think having that long-term value, it's always difficult to perfectly time the market. We have no idea if there's going to be a recession. I don't think that anyone does at this point in time. But I think having that longer-term view, being willing to be patient, I think that's what you need here. So hopefully there's no recession. Hopefully all of this clears up. But I do think it's still a couple quarters of increased volatility before we have more economic certainty.
All right, so keeping that long-term outlook. Amber Fairbanks, Portfolio Manager, Morova US. Thanks so much.
My pleasure, thank you.
Coming up, we'll turn our attention to treasuries and the bond market. Larry Shover is here with his Friday check-in as the 10-year yield spikes to new highs. Plenty to discuss there. Stay right here on the TD Ameritrade Network. Market on Close. We'll be right back.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watch List live from the New York Stock Exchange.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
I'm Jenny Horn. Here's a few more movers to keep on your radar into the close. A Citigroup analyst lowered his price target on SoFi Technologies to $17 a share from $20, while maintaining his buy rating. He said that while the stock will most likely be negatively affected near term from the student loan extension, the value that SoFi derives from the creation of the flywheel pulls in high earnings members compared to financial services. Oppenheimer lowered its price target on Carvana to $220 a share from $430 with an outperform rating. The analyst said that while pandemic-related disruptions likely impacted used car sales and fulfillment, headwinds are now ceasing, giving way to strengthening underlying demand and leading online-focused used car sellers to continue to control a small portion of the overall domestic market for pre-owned auto sales. And Coterra Energy is pacing to close the day over 7% higher after Mizuho raised its price target to $44 a share from $38, while reiterating its buy rating. Shares of energy stocks are a bright spot in today's market amid ongoing supply concerns, with energy leading the S&P 500 sectors up almost 3%. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Caroline Woods.
Welcome back to Market on Close. Larry Shover, Chief Investment Officer of D. Alexander Capital, is standing by to chat about this week's move in yields. Hey there, Larry. Thanks for being here on this Friday.
Yes. Yeah, no, great to be here. And just think, the week ahead, the market is tasked with absorbing next week's big auctions, a 10-year, a 30-year, incorporating the March CPI into the broader macro outlook, geopolitics, all with the backdrop of the Fed balance sheet runoff. It's going to be an interesting week.
It certainly will be. Investors are basically prepping for a tighter monetary policy from the Fed, both in terms of higher rates, but also in terms of the balance sheet, as you said. So first want to get your take on that 10-year yield spiking higher this week. What does that tell you? What conclusions can you draw from that at this point?
Yeah, at this point, not much, except that that whole fear of missing out doesn't seem to be present right now. I think consensus is allowing yield to continue higher, and perhaps we'll see a concession and some buying interest after the auctions. But until then, I think people realize that the combination of deficit funding and SOMA runoff resulting in Treasury funding needs of like $5.3 trillion. I mean, that's twice the amount that's been issued in the private market over the last 3 years. So that said, the least path resistance seems to be for yields to go higher. And I think the only thing is how much of that is baked into the market currently.
How much do you think is?
Well, I look at like the fourth quarter of 2018 and see we're basically the same as we were then, except for inflation. So I do think there is room to run. There doesn't seem to be a whole lot of buying interest at this point. the inflation narrative is the big difference from the fourth quarter of 2018, but we were running between 3 and 3.25%, with metrics just about the same as they are today.
Well, speaking of inflation, next week we have a CPI report as well as PPI. Do you think that we're nearing a peak for inflation, or do you think it's going to run hot for a while?
Yeah, I think it's going to run hot for a while. And I do think the bigger story for investors and traders to look at is like any divergence between the headline and the core. Because if inflation is running hot only due to food and fuel, which are two of the gigantic components, however, everything else is moderating, that could very well keep the Fed from being as hawkish as they are right now. Like right now, they're in full hawk mode, but if we continue to, or if we see a divergence or a cooling off of ex-fuel and energy, ex-food and energy, then perhaps that might be a case for the Fed to say, we'll hike 50 basis points, but not every month.
Well, I think that would be ideal, right? But how successful do you think the Fed will be in terms of taming inflation with its aggressive monetary policy stance?
Yeah, so, they don't have a good history of being a great or even a good inflation fighter. It's so complicated, and nothing against the Fed per se, but I think just going into full hawk mode, but also being very data dependent, it may help them go from having an emergency landing to a soft landing. And what I have to think is that when I look at risk assets around me, and you see the stock market, the S&P 500 is only down 5% for the year. It seems like that the risk assets and the yield curve are both pretty sure that the Fed's going to be able to accomplish this in a good way.
But if they don't have a good track record, we're hearing a lot of calls for stagflation, recession. How should investors be thinking about safety and finding safety in this market?
Yeah, so I think the thing is, like, just try not to overthink it, because every time we overthink it, at least for me, it's typically a bad decision. I mean, I'm still thinking we're going to see 5% earning per share growth this year. We're going to see 20 times forward earnings, PE earnings, which is about the average, as we're going to have, a downshift in consumer sentiment, consumer spending, offset by really strong commodity producer profits. And there's other things that go along with that. And I just think, like, stay the course, stay diversified, and just try not to outguess the market.
In terms of staying diversified, obviously bonds have been beaten down, but are there opportunities there? How should investors think about the bond position of their portfolio right now, given this rate hike environment?
Yeah, well, it's almost too late to think about that, unfortunately. But the fact is that bond sliver is in your portfolio for a reason, and it's worked well for a very, very long time. And we have to come to terms with the fact that rates have started at a very low rate to begin with. And so where they are now, it seems like really high, but they really aren't compared to historical evidence. So keeping that bond allocation in there as a diversifier still makes sense, although I do believe that the equity market will continue to outperform.
All right, we'll leave it there. Larry Shover, Chief Investment Officer, D. Alexander Capital. Thank you so much.
Thank you.
Up next, we'll close out the trading day with a look at Simply Good Foods, ticker symbol SMPL. We've hit a new all-time high today. We'll find out what moved the stock higher this year. More Market on Close after this quick break.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watchlists from the Market Watch tab. After creating a watchlist, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Welcome back to Market on Close. I'm Caroline Woods filling in for Oliver Rennick. It's time to focus on consumer staples stocks. Simply Good Foods. For that, we turn to Rebecca Schuneman, equity analyst at Morningstar. Thanks so much for joining us to wrap up the week, Rebecca.
Yes, thanks for having me. Happy to be here.
So we're talking Simply Good Foods. Morningstar has a 2-star rating on the nutritious food and snacks brand. It's at an all-time high, though, so why only 2 stars? What's with the low rating?
Yeah, so it's purely a valuation call for us. You know, we really like the company. It has fabulous growth prospects, whereas overall packaged food averages about 2% annual growth. We're expecting about 7%, annual sales CAGR over the next 10 years. So, really fabulous growth prospects, but we just think that shares are a little bit rich right now.
What's driving that growth?
Yeah, so in the quarter that they just reported earlier this week, they had 29% sales growth, which is just fabulous. And about 10 points of that was driven by the rebuilding of inventories. Retailer inventories have gotten pretty tight with some of the supply chain disruption that we've had. But even on top of that, consumption growth, which is the retail sell-through, grew 20% in the quarter, which is just really fabulous. And there's a couple things driving that. First of all, they're seeing a recovery in some of their on-the-go formats, such as snack bars and everything, post-pandemic, which had gotten consumption for those products had fallen during the pandemic. So those are recovering. And on top of that, they're launching new products in terms of cookies and chips. And so, just in the early stages of these new products, they're really seeing fabulous growth rates.
That makes sense because the only staple, but eating healthy or being on a diet, necessity, that's more discretionary. So would you look at this as a consumer staple or a consumer discretionary brand?
Yeah, we do consider it a consumer staple brand. And if you look at, their products, that the sales does tend to be pretty stable. So, I think that consumers are really prioritizing their health, especially during the pandemic. Just health and well-being has really come front and center. So we do think that consumers are going to continue to focus on their health and well-being.
All right, I should note you have a fair value price of $32 a share for this one. It currently trades at almost $42. It actually dipped lower, about 1% lower as we head into the close, but still up a little bit year to date. So you need it to get back down. So you wouldn't buy here except for on a pullback.
Absolutely, that's absolutely right. So yeah, like I had talked about, they had a fabulous growth quarter. So there's a lot of excitement in the shares right now, but I think it's not a great time, but this is a great company, and I think that it's one to keep your eye on. And if there is a pullback in the shares, down into the 20s, I think it would be a great investment.
Do you have any picks in this space that are more attractively priced, that are better values at this point?
Yeah, absolutely. So, ConAgra, that's a stock that we're currently recommending. That's a 4-star. They also reported earnings this week, and we just think that the management, while they're also facing a lot of the same headwinds in terms of inflation and labor shortages and supply chain disruption, we really think that management's doing a great job of controlling the things that that they can, the things that are under control. They've overhauled their brand building processes. So, they're really doing data-driven innovation. So they're developing products that are on trend. And they've also, kind of overhauled their marketing practices as well. They've shifted significant advertising dollars to some digital mediums, which tend to be more effective.